Hello everyone, good morning, good afternoon, good evening to all. Welcome to Harrison Academy, guys. So, good news to all CMA final students. In this attempt, we are going to upload CFR marathon, SPMBB marathon, as well as cost audit marathons, also, guys. So, good news to all students, guys. So, one more point I want to discuss. Many of the students getting difficult about this cost audit, CFR subject majorly. Okay, guys, so why are you feeling difficult? I am not understanding. So I can say that simply CFR subjects is a exemption subject, guys. Exemption 75 plus is a very easy, guys. It's very easy, guys. Seriously. Okay. So this is not a difficult subject. So please go through the flow, whatever I am going. So please go through that. Definitely you will get a good marks, guys. Seriously, it's very simple subject. So why are you feeling difficult about the subject? First, ignore that mindset, guys. First, a mindset వదిలేయండి. ఓకే. ఫస్ట్ ఆ మైండ్‌సెట్‌ని వదిలేస్తే డెఫినెట్‌లీ యూ విల్ గెట్ సక్సెస్. ఓకే. సో, ఆల్రెడీ ప్రీవియస్ స్టూడెంట్స్ ఏం చేస్తున్నారంటే డెఫినెట్‌లీ వాళ్ళు సో, సబ్జెక్ట్ ఈస్ వెరీ డిఫికల్ట్. దే ఆర్ రిపీటెడ్‌గా మీ మైండ్‌లో అది ఇచ్చేస్తారనమాట. సో, దట్స్ వై యూ ఆర్ ఫీలింగ్ డిఫికల్ట్. దట్స్ ఇట్. అదర్‌వైస్ దిస్ సబ్జెక్ట్ ఈస్ వెరీ ఈజీ గైస్. వెరీ ఈజీ. ఓకే. సో, స్టార్ట్ చేద్దామా? లెట్ అస్ స్టార్ట్ మై సిఎఫ్ఆర్ క్విక్ రివిజన్ క్లాస్. So before going to that, I will discuss as usual paper pattern. So I'm going to give a clear cut clarity for every question we are going to get in our final exam. Clear. I have analysis the past few papers. So coming to first question, guys. So this paper pattern is similar for every subject. Everyone knows about it, but this is somewhat very important, guys. Please listen. Please listen. Yeah. Question number one, MCQs. So completely MCQs, everyone knows about it. So we are getting almost 15. How many questions, guys? 15 questions. 15 to 30 marks. Correct? Yes. Out of 15 questions. So in every attempt, we are getting at least 5 to 6 questions as a theory questions. Sometimes 7 questions also we are getting. Okay, if you got 7 questions, that's a bonus to us. It's like a bonus. Correct? So see, guys, if you properly thoroughly read, I mean study my MCQ booklet or MCQ classes, definitely simple, guys. It's a direct questions, guys. These theory questions are completely direct questions from a booklet. Yes, I can say that. Please go through that. Okay, you need to spend just 1 or 2 minutes to complete this 5 to 6 MCQ questions. 1 or 2 minutes only. In 1 or 2 minutes or 2 minutes simply. Okay, easily will get a 12 marks. In 1 or 2 minutes, at least you can take 2 minutes also. In 2 minutes, you are getting 12 marks, guys. Damn sure. Direct questions you will get. Okay, so remaining questions also we are going to cover. Okay, sometimes similar questions will come, sometimes numbers will change. Okay, anyway, at least 12 questions directly we can get from MCQ booklet. Okay, easily you will get a 24 marks easily, guys. Very easy. Very easily you will get 24 marks, guys. If you follow my classes completely thoroughly, definitely you will get 30 out of 30. That is the second scenario. Okay, clear. So this marathon I'm going to discuss by keeping mind in mind as a all students, all different, I mean many of the students getting classes from different faculties. So I don't know that, I don't care also. Just go to this marathon. Okay, even if you have taken classes from number of different faculties also, no issue for me. Just go through this marathon. Definitely you will get a clear cut clarity about the subject, as well as you will easily will get a 60 plus marks, guys. 60 plus marks is damn sure. Pakka, guys, pakka. Ready? Let us start together, everyone. Guys, clear? Okay, so coming to remaining questions. Out of 8 questions, we need to attempt 7 questions or 5 questions. Sorry. Out of 7 questions, we need to attempt only 5 questions. Each question carries a 14 marks, correct? A, B questions will be there. Okay. So coming to question number 7 and 8, first point. So I want to discuss this 90 plus strategy also here. Okay. See, 7 to 8 questions. 7 and 8 questions completely theory, as well as a EVA, MVA. Sometimes they will ask like goodwill question also, purchase consideration. The basic question also they will ask. Sometimes only. Okay. Clear? So how many marks, guys? 2 14s are 28 marks. Out of 28, if you are good at theory, okay, if you studied theory very well, definitely you will get at least 20 to 24 marks, guys. In worst scenario, I'm taking in worst scenario, at least, okay, 20 marks. In worst scenario, I'm saying, guys, worst scenario. Clear? So here in MCQs, in worst scenario also you will get 24 marks. In worst scenario, I'm saying. Okay, clear, clear. I'm first of all I'm talking about the average students, or otherwise few of the students were not able to complete your syllabus in time. Okay, for that students I'm talking about, not uh, other students, not about other students. Okay, I think many students already complete the syllabus and everything, revision classes, exams, everything. That is okay. I'm not talking about those students. I'm talking about other than those students. Okay, who are not able to complete the syllabus in time. Okay, clear. So we are done with two questions. So we are getting 20 marks here. Here already 24 marks. Okay, total how many marks? 44 marks. Pass. Okay, you can take only 20 only. In worst scenario also. Okay, 40. Yes, I am passed. I got passed. Okay, in examination also your mindset should be like this only, guys. Your mindset should be like this only. Yes. Okay, you need to keep the target, just you need to pass. Even if you want to rank also, please ignore that mindset, guys. Please ignore that mindset. Just apply your mind. Okay, so before in 15 minutes you need to select which questions you need to attempt, correct? So otherwise you can go through this marathon, sorry, MCQs also. Out of 15 MCQs, in that 15 minutes easily you can attempt 12 questions, guys. 12 questions easily you can attempt. So once they have given the answer sheet, that directly you can in 5 minutes, I think within 5 minutes easily you can get 24 marks in 5 minutes only, guys. 5 minutes. This is the way of preparation, way of a mindset in during your examination. Please be like this, guys. Very simple, guys. Okay, so 7 and 8 questions blindly they will give theory questions only, along with EVA question, maybe practical question, or MBA question maybe. Okay, correct or not? In government accounting theory, sustainable, the basic theory questions. Every time I'm giving the important theory questions list. Out of that questions only we are getting the questions. Correct or not? Yes, obviously. So this 28 marks easily we can get. 28, guys. If you're not good at theory also, in worst scenario also you will get 20 marks out of it. Here already you got a 24 marks, at least 20, 40 marks pass. And coming to next scenarios. Yeah, if you are good at valuation of a shares, or NBFC, or 10932 financial instruments, and business combinations. That's the basic. Business combinations very important, guys. Please don't ignore this topic. Okay. So otherwise, if you want to go to Ind AS, yes, you can go to Ind AS also. That is also okay for me. So we have complete one question, 28 out of 28. They will give Ind AS questions only. 16, 32, 36. Okay, 21, 12. So only those questions, those in from those Indias they are giving the questions. Okay. Otherwise, in question number 3, so basically, they are going to give index 10 to share based payments, or a fair value measurement, or next leases question, revenue from contract with the customers. So index 115. So only from those indices they are going to give a question from 3A, in 3A. And coming to B, valuation of a shares compulsory question, guys. In every attempt, they are giving the valuation of shares compulsory question. It sometimes this question may be difficult also. Okay, sometimes, guys, sometimes. Okay, next coming to fourth question, they're giving a NBFC question or 109. Yes, 4A. 4B complete internal reconstruction they are giving from last 3 attempts. Okay, we can expect from business combination only. Yes. Question number 5 completely business combination. Question number 6 completely consolidation. Okay. So out of these, how many questions? 5 questions. Just you need to attempt only 3 questions. Only 3 questions. Correct or not? Yes. Yes, yes, yes. Correct. Yes. See, if you want to attempt from valuation of a shares, yes, 3 we will get 7 marks out of it. Index 10 to the basic question, 113 basic questions, 115, 116 directly they are giving the direct questions only, guys. Direct questions. Okay, sometimes lazy question maybe not lazy questions, 115. Okay, so they are giving the out of the box question, but still, as per my expectation, this time they will give question from uh, I mean, they are giving the direct questions only. Okay, definitely that questions will be in my book only. Yes, I can say that will be in book. My book is not my own preparation, guys. Clearly, I'm saying I have taken questions from board book, CMA board book, as well as CA final questions. Not every questions I'm taking from CA final, guys. Clearly, I'm saying. Okay, some few examples. So majority of the questions I am going to cover in during my examples, guys. In regular classes, I'm saying. Okay. So better regular classes, that is different scenario. So as of now, we are at marathon class. Okay, please go in that way only. Okay. Yes, coming to question number 4, NBFC 10. Definitely you will get 7 marks out of it. Okay. Internal reconstruction, that's the basic question. Easily you can get 7 marks from it. And question number 5, business combination. Okay. Very easiest topic is business combination. Very easy, guys. So majority of the people, they will ignore about the business combination as well as the consolidation. But if you want to ignore the CFS, that is okay, guys. That is okay for me. But business combination, please don't ignore, guys. Sometimes they are giving for 30 marks also. 24 to 28 marks also they are going to give. So that's why please don't ignore this business combination topic. Very, very important, guys. I'm clearly saying very important. Okay. So as much as possible, I'm going to cover in this marathon. So clear. Next, coming to, yeah, see, just wait. Okay. Yeah. So if you attempt a question from 3A or 3B, nothing but if you prepare these topics, you will get at least in worst scenario also 20 marks. Out of 28, I'm saying, is out of 28, easily you can get 20 marks. So just you need to prepare these topics and theory as well as MCQs. For MCQ purpose, you should have knowledge about the business combination and consolidation also. That concept, everything will be available in that MCQ session also. Not 100%, but yes, definitely I can say that you must have some concept. Otherwise, we cannot get 30 out of a 30 or 28. Okay, so I'm clearly saying, just if you prepare these topics only, na, question number 3, 7 and 8, question number 1. Here only we are getting 16 worst scenario, guys. In worst scenario, I'm saying, suppose example, if you get full marks out of it, 25, here 25, here 26, at least here also 24. How much total, guys? Almost 72 marks, more than 70, guys. So in this way also, if you think like that, for every subject, 70 is the basic marks, guys. Basic marks, 70, 65 is the basic marks in every subject, guys. Every subject. Okay, now. So this is the way of preparation, guys. And then if you prepare the business combination very well, and definitely will get how many marks? Sorry, here not 25, right? 14 marks. Sorry, here 14, guys. So we did a mistake, huh? Okay, here also 14. Here also 14. Sorry. Next, business combination also 14. So 14, 14. I'm saying 24 marks totally. Question number 4 and 5, and question number 3. That's it. From these three questions, easily you can get how many marks, guys? 14, 10, 10, 10. At least in worst scenario also 30, 30, 30 plus 20, 50, 50 plus 20, 70. This is the way of preparation, guys. This is the way of preparation. Easily, sir. 70 plus is a dead easy marks, guys. Yes, it's possible. Please don't get fear about the subject. First point. Ignore the fear. Apply your mind. Okay. Go through the classes. Definitely will get it. Okay. Clear. So I don't want to waste my time. Till now I have wasted my time, 10 minutes of a time. So now I don't want to waste. Okay, hi guys. In this video, I'm going to cover the topics like Ind AS introduction, Ind AS 16, 23, 36, 38, 113, as well as 102, guys. So remaining topics like 115, 116, and Ind AS 103, 32. I mean, business combination will come in part 2. Okay, so actually because of the time issue, guys. So this uploading taking a lot of time. Okay, that's why. Okay, so this video will upload on 14th November. Okay, so I mean 14th November morning. Actually, I thought 13th only. So 14th November morning. So I mean 16th or 17th, mostly 17th or 18th. Hardly 3 to 4 days. Within 3 to 4 days, I am going to release the part 2. Okay, along with, and also I'm going to release the BV marathon also. That will take another 3 to 4 days, guys. Another 3 to 4 days for BV marathon. Okay, SPM marathon will release by tomorrow, or I mean 14th or 15th. Okay, this is the classes, I mean marathons, like a revision classes update. Okay, thank you guys. directly go to the marathon. Okay. So in this topic, I'm going to discuss only the examination point of view, not going to discuss more than that, guys. So these are the topics we are going to cover in this introduction: 16, 23, 36, 38, 113, 115, 116, 102, 32, 109, and as well as valuation of a shares topic also, income taxes, business combination, restructuring, consolidated financial statements, NBFC, theory and government accounting. So almost all the topics we have. So except in first video, except consolidation, okay, and theory, we are going to discuss all these topics. Okay, ready everyone? Clear? Yes. So I don't want to discuss more things, guys. Just completely examination point of view. This is more than enough, guys. This is more than enough. Coming to India's introduction, so we may not get any question from this topic, but still I want to discuss one thing, guys. Okay, initially IC has initiated this process of shifting towards IFRS, guys. IFRS means International Financial Reporting Standards, in collaboration with some government bodies like MCA, NSES, etc. Okay, so initially who initiated this? ICA, guys. ICA. Who issued, guys? IASB has issued. Please remember this point. IASB, International Accounting Standard Board. So basically these standards are converged standards with IFRS. Converged means in the sense, see, coming to India's 101, IFRS standard number is 1, 1, 101, 2, 102, 3, 103. Like that they have framed the standards. Okay, standard numbering. So that's why we can say it's a converged standards. Okay, yeah. So basically, India is applicable in the following phases, guys. I don't want to discuss these phases. Just give a single reading, guys, because examination point of it is not required. Okay, if they want to give any single question, they will give for one MCQ only. One MCQ. Other than that, not required. Just go through this. I don't want to discuss this. The regular class already available in my YouTube channel. So if you want, you can go through that. The basics, for the basics. Okay. Just one point you need to remember: calculation of net worth, guys. Calculation of net worth. See, for calculation of net worth, paid up share capital plus all reserves created out of the profits and security premium, nothing but revaluation reserve is not included in this, guys. Revaluation reserves, please don't include in the all reserves, ignore that. Next, accumulated losses should be deducted. Accumulated losses should be deducted, and if any deferred expenditure and miscellaneous expenditure is not written off, which means a fictitious assets, guys. Fictitious assets, if you have any assets like that, so you can deduct from the paid up share capital, nothing but. Okay, so please tell me the net worth formula, guys. Net worth formula, what is the formula? Paid up share capital plus all reserves out of the profits and security premium minus aggregate value of accumulated losses minus deferred revenue expenditure not written off. Clear? Clear everyone? Yes. So please remember that that is a different thing. If you want this explanation and all, I don't want to discuss here. That is already in my YouTube channel. If you want, you can check the regular class lecture number 1. Clear? Okay, so coming to next standard, Ind AS 16, guys. PP. Yes, examination point of important. So we can get a 7 marks question from it. 7 marks question from it. Okay. So first of all, basic definition, guys. PP means, PP are the tangible items. Yes, held for the using the production or supply of goods or services, or for rental to others, or for administrative purpose, and condition is very important. It should be expected more than one accounting period. Yes, suppose example, simple example, I don't want to discuss more things here because it's a basic definition. Suppose example, if you have a machinery, by using that machinery we will produce the goods. Yes, and that machinery should be expected to be used more than one accounting period. Yes, we can say it's a PP. Okay, clear or not? Yes, suppose example, if you have a building, I'm that building I'm going to give for a rental to others. Yes, if you want, you can give, you will get rental income. Yes or no? Yes, and that building should be used more than one accounting period. One accounting period. And for administrative purpose, suppose example, office purpose, I am using one floor. Okay, yes, we can say that building is comes under PP. Okay, we have some exceptions also, we'll discuss later. Okay, not required here. Okay, here it's a basic definition, guys. PP are the tangible items held for using the production or supply of goods or services. Next are for rental to others or for administrative purpose, and expected to be used more than one accounting period. This is the compulsory condition. And condition means important condition. Okay, clear? everyone. Yeah. Next, coming to bearer plant, guys. Bearer plant. Bearer plant means bearer plant is a living plant. Okay. So it is used in the production or supply of agriculture produce and is expected to be produced more than one accounting period and is likely remote likelihood is being sold as agriculture produce except for what is that incidental scrap sales. Guys, for bearer plant I'm giving the best example is coconut tree, guys. Coconut tree, yes. So coconut tree is a living plant. It is used in the production or supply of agriculture produce. Yes, it will give coconuts, correct or not? Yes. Next, and expect to be bear produce more than one period. Yes, it will produce more than one period. And also remote likelihood to sell as an agriculture produce. Yes, we are selling that. Yes or no? Yes, we are selling. Also all conditions they are satisfying, so we can say it's a bearer plant. So one more point I want to discuss. This India 16 is not applied for biological assets. This India 16 is not applicable for biological assets except for bearer plant. That's why I'm going to discuss this bearer plant. Okay, sometimes they are giving it as a MCQ definition also. Bearer plant. That's why I have given that definition. Okay, so see, please remember this point. India 16 not applicable to biological assets. Okay, except a bearer plant, which means bearer plant is also a biological assets. Okay, now the cattle, pigs, something we have. So for that, this stand is not applicable. For that, other stand is applicable, which is India 41. That is nothing but agriculture. The standard name is agriculture. India 41. That is applicable, not this standard. So please remember this point. Biological assets. For biological assets, India 16 is not applicable except bearer plant, which means for bearer plant, India 16 is applicable. That's it. That's the point I want to say. Clear. Next, coming to recognition, guys. If you want to recognize the PPE, the cost of PPE shall be recognized as an asset only if and only if it must satisfy two conditions, guys. What are the two conditions, guys? It is probable that future economic benefit will be flowed to the entity as well as the cost should be measured reliably. Yes, if these two conditions are satisfied, then only we can recognize it as asset in our books of accounts as a PPE. Yes, it is probable that future economic benefit should be there. If you take any example like fixed assets, building, yes, future economic benefit will be there. Obviously, yes, suppose example, I have started one education institution. I have taken 5 floor building. By using that 5 floor, I will get a benefit for a number of years. Yes, future economic benefit will be there, and cost should be measured reliable. That's the most important. If you are not able to measure the cost, then we cannot say we can. Please don't recognize in your books of accounts. That's it. Clear. That's recognition, guys. So initial recognition always at a cost only, guys. Initial recognition always at a cost. Clear, everyone. So I will discuss one more point here. So I have missed that point in the material, I think. Just wait. This point I have missed, guys. So please take a screenshot. Please take a screenshot. Okay, in marathon material it is not available. So this is the regular material. So coming to initial recognition, it is always at a cost. Initial recognition of a PP always at a cost. We are following the cost model. So for that, this is very important, guys. So purchase price minus trade discount or rebate, but not cash discount. If there is any cash discount, please ignore that. If there is only trade discount or rebate, so please that only we need to reduce from the purchase price. Yes, non-refundable taxes. Non-refundable taxes only we can add because that is only the cost. If there is any refundable cost, please don't add that, guys. Please don't add that. Please ignore that. Suppose example, purchase price equal to 10 lakhs. It includes refundable tax 2 lakhs. So this 10 lakhs includes already refundable tax, which is 2 lakhs. So what we should do? What we need to do right now? So we need to reduce the 2 lakhs because it's a refundable tax. Please ignore that. Please don't consider it as a cost. If you're already considered as a cost, please don't please remove that. That's it. That's why I'm removing this 2 lakhs from it. Understood or not? This 2 lakhs refundable tax already included in the purchase price. That's why I'm removing. Suppose example, purchase price is 10 lakhs. Non-refundable tax 2 lakhs. Refundable tax 2 lakhs. What we should do? See, guys, tell me, this is refundable tax 2 lakhs. Non-refundable tax 2 lakhs we have. Okay. What's the next step? Can you please tell me? Now what we need to do? What's the cost of PP? 12 lakhs or 14 lakhs? So please ignore this 2 lakhs. So our cost of PP is 12 lakhs only. That's the point I want to convey. That's it. And cost directly attributable to bring the asset to the location and condition. These are the cost. Okay, like employee cost, cost of preparing the site, freight and delivery cost, and installation assembly cost. Okay, cost during the test run. Okay, as well as the professional fees, consultancy fees, legal fees, direct material, direct labor. So all these costs we need to add, guys. Add to the value of a asset. Okay, these are the directly attributable to bring the asset to the current location. And also the special point is estimating dismantling cost, which is nothing but it's a present value. So we need to add only the present value of dismantling cost only, not dismantling cost. In questions they are going to give dismantling cost is 10 lakhs, present value of dismantling cost is 5 lakhs. So which amount we need to add, guys? Only 5 lakhs we need to add, not 10 lakhs, because this 10 lakhs is total value, not the present value. So we need to add only present value. In the given question, they are not talking about any present value, nothing. Simply they are giving the dismantling cost equal to 10 lakhs. Now what we need to do? Assume that this 10 lakhs has a present value, then add 10 lakhs. That's it. I think everyone have a clarity. Okay, now clear. So I think for my class the 1.52 speed is not required. So my class always in my 1.5 speed only. Okay, clear. If you keep 1.5 speed, it will come to 2 speed. Clear? Yeah. Come to marathon material. Sorry for this point. If you want, you can take the screenshot. So for that, we have one small basic question, guys. So let us solve the question. ABC Limited is installing a new plant in its production facility. It has incurred these costs. Cost of the plant, cost per supplier invoice plus tax is how much? 25 lakhs. Initial delivery and handling cost is 2 lakhs. So initial delivery cost. For the treatment, guys, we need to add or not? Yes. Cost of the site preparation. Yes. Consultant user for the acquisition of the plant. Acquisition of the plant means directly attributable cost. Yes, we need to add this also. Interest charges paid to supplier for the plant for deferred credit. Basically, interest will be charged for deferred credit. If you are paying lately, then you need to pay the interest also, right? So that should not be included in the cost of the PP. Correct or not? Yes. Next, net present value of estimate dismantling cost to be incurred after 7 years. How much? 3 lakhs. This also we need to be add. And operating losses before commercial production. Sir, in cost excludes, we have a few points I want to discuss before that. See the point, guys. Cost excludes administration and general overheads. Next, advertising and promotion cost. Nothing but inauguration cost or opening ceremony cost or staff training cost. Okay, these costs please ignore from the cost of the PP. And cost of relocating from one place to another, shifting. Correct. Initial losses when the asset is operating at a low level. So nothing but operating losses also ignore, guys. Incidental cost not directly related to installation. If any supporting cost we are incurring, but it is not related to installation, then please ignore that. So please don't add this cost in the cost of a PP. So please ignore that. So that's why please ignore this operating losses also. So then tell me the cost of the PP now. Everyone, 25 plus 2, 27. Next, plus 6, 27 plus 6, 33. 33 plus 7, how much? 40. 40 plus 3, 43. So 43 lakhs the cost of the PP. Yes, that is the cost of PP. Simple, guys. Simple question, guys. Basic question. Clear, everyone? Yes. Coming to subsequent model. Basically, for subsequent recognition, we have two types of models, guys. One is cost model. Second one is a revaluation model. Cost model means simply, guys, cost minus depreciation minus impairment loss. Cost minus depreciation means accumulated depreciation. Impairment loss means accumulated impairment loss. Okay. Then you will get the book value. Basic point, guys. Suppose example you purchased PPA for 10 lakhs. Okay, first year depreciation equal to 2 lakhs. Impairment loss, assume the 2 lakhs. The balance how much? How much? 6 lakhs. This is the net book value. This is the net book value. So basically, this impairment about this impairment loss, I will give a clear clarity during my Ind AS 36 standard. So before that, I'm going to give a simple point. So please remember this, guys. So please remember this. Okay, first of all, Cost of the PP equal to 10 lakhs. Assume that cost of the PP equal to 10 lakhs. Depreciation equal to 2 lakhs. What's the value? 8 lakhs. This is the book value, guys. Basically, everyone knows about this book value. Correct or not? Yes. This is the book value. So, suppose example, if I sell this asset, nothing but the realized value should be, assume that is 7 lakhs. Assume that. So, here the book value means carrying amount. Correct or not? Book value means carrying amount. So, carrying amount equal to 8 lakhs. Next, recoverable amount equal to, if I sell the asset, I will get only 7 lakhs only. Recoverable amount equal to 7 lakhs. So, if the carrying amount of the asset is more than the recoverable amount, if the carrying, please keep in your mind clearly. If the carrying amount of the asset is more than the recoverable amount, then the difference is nothing but impairment loss. Because the book value is 8 lakhs, guys. If you sell it, you will get the loss. That's why if you sell it, which means it is not exactly you are selling. Okay, just it's a assumption, guys. It's completely based on provision. It's nothing but like a provision, guys. Okay, because as per prudence concept, we have one concept, prudence concept. What the concept is saying, conservatism also. We can say that these two names we have. So prudence concept, what it was saying is estimated losses should be recognized immediately, but not profits. So here, if you sell the assets, you will get a 1 lakh loss. So that's why please consider that loss in your books of accounts as per this concept. That's why now the asset value will becomes how much? 8 lakhs minus impairment loss. How much? 7 lakhs. This is the revised book value. If there is an impairment loss, then the book value is 8 lakhs only. Students will get doubts. So suppose example, if the recoverable amount is not 7 lakhs, it is 9 lakhs. So 1 lakh is impairment gain. Can we add it? No, guys, no. As per this concept only. So please consider only estimated losses only, not profits. Correct or not? Impairment gain means profit, nice profit, right? So that's why please don't consider that. As per this concept, only loss only we need to consider. There is then a reversal of impairment loss. Everything is there. Yes, we have. We will discuss in Ind AS 36. Wait for that. That's it. I think everyone clear about this point. So now I'm talking about basically not initial recognition, guys. Actually, in 1/1/2025, okay, I on 1/1/2024 I purchased the PP. Okay, for year ending I need to recognize in my books of accounts because in balance sheet I need to show the PP. Correct or not? Yes, obviously I need to show in my balance sheet. So PP cost equal to 10 lakhs, depreciation 2 lakhs, so balance is 8 lakhs. Basically, we are showing this value, right, in balance sheet. Suppose example, this is called subsequent recognition, guys. This is called subsequent recognition. In secondary running also, we need to show in our balance sheet if the asset is exist in our company or organization. Definitely, we need to show in our balance sheet as an asset. Correct or not? Yes. So that is called subsequent recognition. Subsequently, not initially. Subsequently, we need to recognize. We need to show in the books of accounts. That is called subsequent recognition. For that only we have two models. That is called cost model as well as the, what is that, guys? Revaluation model. So what are the formulas? Cost minus depreciation minus impairment loss. Second one, revaluation, fair value minus depreciation minus impairment loss. Fair value. So I will give small example for this also. Suppose the example, cost of the PP equal to 10 lakhs, depreciation 2 lakhs, balance is book value equal to 8 lakhs. First running, I want to revalue this asset. Basically, generally, if there is any indications, we will revalue the asset value, right, based on the market conditions. Suppose example, I revalued this 8 lakhs to 12 lakhs. Now the value of the asset is 12 lakhs. Now we need to recognize, we need to calculate depreciation on not 8 lakhs. We need to calculate depreciation on 12 lakhs only. This 4 lakhs is nothing but revaluation surplus. This is the second, I mean, next topic. We'll discuss about this. Okay, now just remember the point. The fair value on this date is 12 lakhs, so we need to calculate depreciation on 12 lakhs only, not on 8 lakhs. That is the point. Clear? Okay, so addition of capital expenditure to A and B. A or B, expenditure which enhance the revenue generating capacity, cost of replacement, major inspections and overhauling expenses. Okay, now clear? Everyone, guys, clear or not? Okay, these are the basic examples. Okay, we can also add this cost to the PP, basically replacement cost, inspection cost, overhauling expenses. So all is borrowing is nothing but renovation expenses, everything we need to add it to the cost of the asset. That's it. Okay. So revaluation of asset increase or decrease. So I will discuss this point. Yeah, revaluation. Okay, click on like. Please click on like, guys. I think everyone like this video. That's it. Okay, and also subscribe the channel. Okay, guys. So let us start with the revaluation topic. So basically, guys, generally every year end the asset value will get revalued, guys. Revalued. So in case of a revaluation, the asset value may be increased or decreased. So in that scenario, how to do the treatment. So that's what we need to learn right now. Ready, everyone? So I'm taking a simple example, guys. So just by using this example, we can easily understand the topic. Ready? Suppose example cost of the PP equal to 10 lakhs. How much? Cost of the PP equal to 10 lakhs. Okay. So depreciation assume that 2 lakhs. So what's the balance? 8 lakhs. So this is the book value. Correct? This is the book value. So year, this is nothing but year 1 ending. First year ending. Okay. This is starting. So year ending, the value of the asset is 8 lakhs only. So now I want to revalue the asset. So assume that the revalued figure is equal to 11 lakhs. This is the first case. Case number one, the revalued figure is 11 lakhs. Now what is the revalued amount? How much revalued, guys, from 8 lakhs to 11 lakhs? How much? 3 lakhs. That is nothing but revaluation surplus. What is that, guys? That 3 lakhs is nothing but revaluation surplus shown under OCI. OCI means other comprehensive income. Clear or not? Says sir, everyone knows about it. This OCI. Other comprehensive income. Basically, unrealized amounts will be shown under the head. Okay. So other comprehensive income. So how much, guys? 3 lakhs. Clear or not? Yes. So we need to transfer this 3 lakhs to revaluation surplus account. Nothing but OCI. Clear? Or revaluation reserve also we can say that. No worries in the name. So now what is the entry? Anyone? Please tell me, guys. Anyone? Entry. So now the asset value will get increased. How much increased? 3 lakhs. So PPE account debit 3 lakhs. 2. It should be transferred to revaluation surplus account. How much, guys? 3 lakhs. Simple. Yes or no? Yes. This is the basic entry, guys. So when the asset value got increased, revalued increased, then that difference amount, nothing but difference between the book value as well as the revalued figure, nothing but fair value. Nothing but fair value. This difference should be transferred to revaluation surplus account, nothing but OCI. Everyone clear about this? This is the first scenario. Suppose example, if the book value is 8 lakhs, now the revalued figure, fair value equal to 6 lakhs. This is the second case. Now tell me, anyone? Yeah, correct, guys. So the difference should be transferred to P and L account. P and L account. How much, guys? 2 lakhs. How much? 2 lakhs. Yes. So now what is the entry? The asset value increased or decreased? Increased or decreased? Decreased. So asset should be credit. Nothing but 2 PP account 2 lakhs. P and L account debit 2 lakhs. This is the entry, guys. This is the basic, guys. If the asset value gets increased, then it should be transferred to revaluation surplus account. Asset value got decreased, then it should be transferred to P&L account. That's it. This is a basic scenario. So coming to year 2. So initially the value gets increased. Now the value gets decreased. Suppose example in second year, what is the fair value here as of now? 11 lakhs. Correct or not? Yes. Assume that the depreciation is 2 lakhs. So difference how much, guys? 9 lakhs. So this is the year ending value. Second year ending value how much? How much, guys? 9 lakhs. Correct or not? So this is the 11 lakhs, guys. Already increased to 11 lakhs. So 2 lakhs is a depreciation. Assume that. So there is no calculation. I'm saying simply the depreciation is 2 lakhs. So how much the balance? 9 lakhs. So this is the as of now value. Correct or not? Yes. Now see the value gets decreased from 9 lakhs to assume that 7 lakhs. Now second year ending also I got revalued the asset value. So the value gets how much? 7 lakhs. So how much decreased, guys? 2 lakhs got decreased. Then what is the treatment? Initially decreased. Now asset value got decreased. Initially increased. Now the asset value got decreased. Now what is the treatment? Everyone, anyone? So P and L to PP na 2 lakhs, correct? Wrong. Guys, first of all, in this scenario, okay, if you need to check if there is any revaluation surplus. So you need to check if there is any revaluation surplus exist in the previous year. First of all, we need to adjust that revaluation surplus and the balance only should be transferred to P&L. That's the point. So then what is the entry now? Guys, asset value got decreased. How much? 2 lakhs. So see the point. First of all, how much revaluation surplus we have? 3 lakhs revaluation surplus, which means to the extent of 3 lakhs, we can reverse it. So now the entry will be revaluation surplus account debit to PPE. How much? 2 lakhs. Suppose example, if this value decreases from 9 lakhs to 5 lakhs, assume that. How much decrease now? 4 lakhs. Now what is the treatment? Tell me, everyone. Tell me, everyone. Revaluation surplus account debit 3 lakhs because we have 3 lakhs only. So that should be reversed. And now the extra amount should be transferred to P&L. This is the treatment, guys, to PP. Understood? Everyone understood or not? So what is the conclusion point? Means in case of in first year if the revaluation got increased, in next years if the revaluation nothing but revaluation asset value got decreased, first increase and then decreased. In this scenario, what we need to do? In second scenario, first of all you need to check if there is any revaluation surplus exist in the previous year. So first of all you need to adjust that revaluation surplus and the balance only should be transferred to P&L. That is the point. In this scenario also same, guys. In this scenario also same. Already 2 lakhs transferred to P&L. Now the if the asset value got increased, in this scenario increase to assume that increase to, as of now what's the value? 6 lakhs, right? So fair value equal 6 lakhs. Depreciation 1 lakh. How much? 5 lakhs. So this 5 lakhs got increased to 8 lakhs. How much increase, guys? 3 lakhs got increased. Now what is the treatment? First of all, so already we have a P&L debit balance is 2 lakhs. First of all, please reverse that and the balance should be transferred to revaluation surplus. Don't transfer 3 lakhs directly to revaluation surplus. That's the point I want to convey you. That's it. So entry will be PPE account debit 3 lakhs to P&L 2 lakhs to revaluation surplus 1 lakh. That's it, guys. This is the treatment. Everyone must have a clarity about this concept. Very, very important. Clear? Everyone? Yeah. Depreciation always charged on the revalued figure only. That is the point I already discussed. Clear? Yes, I don't want to discuss more. If you want, you can just repeat the video. That's it. So one more point, please remember the revaluation surplus in respect of a PPE transfer directly to retained earnings over a period of the life of the asset. Suppose example, revaluation surplus equal to 5 lakhs. Assume that. Special point, guys. Okay. So if the life of the asset is 5 years, the remaining life is 5 years. So every year out of this 5 lakhs, 1 lakh should be transferred to 1 lakh should be transferred to where, guys? Retained earnings. Retained earnings. That's it. Clear? That's the point they want to say you. Okay. Suppose example revaluation surplus equal to 1 lakh, life equal to 5 years. So 20,000 per year will be transferred to retained earnings. Clear or not? At the end of the fifth year, nothing will be in the revaluation surplus balance. Yes or no? Yes or no, guys? Yes. Yes, this is the point I want to discuss next. Okay, coming to problem number 2. So we'll discuss this later. Coming to problem number 2. A Limited purchased an aircraft at a price 6,300 crores that requires a major inspection and overhauling for every 4 years. Okay, the estimated life of the aircraft is 15 years. Sir, guys, I already discussed about this point. So, inspection charges. So, inspection cost are nothing but overhauling charges, overhauling expenses, nothing but next. One more point what we have discussed, guys, revenue earning capacity, correct or not? So all these expenditures should be capitalized, correct or not? We already discussed this point. Yes or no? Capitalized means value added to the value of the asset. So this question is about this topic only. Okay. Yeah. Please pay attention. A Limited purchased an aircraft at a price of 6,300 crores that require major inspection and overhauling for every 4 years. It requires major inspection and overhauling expenses for every 4 years. So they need to incur this overhauling expenses for every 4 years. Correct or not? Yes. Okay. The estimated life of the aircraft is 15 years. The aircraft was purchased in 2015. When the aircraft got purchased, guys, 2015, and the major inspection and overhauling expenses made in 2019 at a cost of 100 crores. So major inspection and overhauling expenses made in 2019 again after 4 years, because for every 4 years we need to require to, I mean, incur that expenses, right? So that's why at a cost 100 crores. In 2020, A Limited further incurred repairs and maintenance in the engine to raise its capacity by 10%, amounting to 70 crores. What is the point, guys? Repairs and maintenance in the engine to raise its capacity. If the expenses incurred to raise the capacity of the engine, then it should be capitalized. Correct or not? Yes, capitalized means added to the value of the asset. On that value also we need to calculate the depreciation. Correct or not? Yes. One worn out component in the wing is replaced in 2020 at a cost of 80 crores. So one worn out component means, suppose example is the machine. Okay, this part of the machine was replacing. Okay, this was not good, so that's why I'm replacing that. Okay, so one of the worn out component in the wing was replaced in 2020 at a cost of 80 crores. Guys, one point, can you please tell me? This is the machine. I want to replace this part, engine part. It's very important. See, now in this case, what is the treatment, guys? Simply, I'm saying I want to remove this from the asset. I want to add one more part. This is the new part. So for new part, I need to incur cost, right? So cost of the new part should be capitalized, should be added to the value of asset because it is a part of the asset only. So we need to remove the this part of this old part of the old component part should be removed. Correct or not? Yes or no? Yes, but which value? Which value? Tell me which value? Cost or book value? Book value. Correct or not? Because suppose example, I'm removing this part after 5 years, so I need to remove the asset value. Which value, guys? Only book value, not cost, guys, not cost. So for this part, I need to calculate the depreciation for 5 years. Correct or not? Yes, yes, guys. Yes or no? Yeah. If the question is nothing saying any when the asset got purchased, any information, nothing. I mean, they haven't given any information about this part. So sometimes they will give directly the old, I mean, old component carrying amount directly given in the question. So simply you can take that. Clear. So now what the treatment means? New part of the component, nothing but new component of the asset should be capitalized. Old component carrying amount should be de-recognized. Nothing but remove from the balance sheet. Nothing but reduced from the asset value simply. Okay na? Suppose example asset total value 10 lakhs. Add new cost, new part value 2 lakhs. Assume that old part value 1 lakh. So the balance how much? 11 lakhs. That is the value of the asset. So you need to add the new component of the asset. Nothing but new part should be added. Old part should be deducted. That's it. Old part should be deducted at which value? Carrying value. Carrying value. So majority cases they will give in the question directly. Otherwise you need to calculate. That's it. Clear? This is the point regarding replacement. See here, the carrying amount of the old component was 30, scrap release is 12 crores. So old component value directly given in the question. How much? 30 crores. Find out the amount to recognize as an expense and asset in 2019 and 2020. Also show the carrying amount. The aircraft residual value is 300 crores. Okay. Ready everyone? Clear. So I will solve now. So we have already solution. Just I will show and explain. Okay. Okay. So come to solution guys. First of all, what is the cost of aircraft? 6,300 crores. Correct? Everyone. Yeah. So when it was purchased guys, the estimated life is 15 years. Okay. So asset purchased in 2015. So the question is asking about in which year? About which year? 19 and 20. Okay. Correct? So which means first of all we need to calculate. They are asking treatment about 19 and 20. So first of all we need to calculate what is the asset value at the end of the 31st March 2018 first of all. Okay. So this is December or I mean calendar year or financial year. First of all we need to check guys. So they're asking about 2019 and 20 which means it's a calendar year. So nothing but you need to calculate 31st December 2018 what is the book value of the asset. Okay. So as of now the first um, hint in this question is the asset purchase date. What is the date guys? 2015. Correct or not? So assume that it is from starting Jan 1st. Assume that 2015 Jan 1st. How many years guys? Till 18. 15, 16, 17, 18. How many years? 4 years. So first of all you need to calculate the depreciation for 4 years. Correct? Yes. What is the asset value? 6,300. We have a residual value also given in the question guys. What is the residual value here? 300. So we need to calculate the total depreciation as a whole guys. 300 divided by how much? 6,300 divided, sorry, 6,300 minus 300 divided by how many years? 15 years. For how many years we need to calculate the depreciation? 4 years. How much? Tell me. 6,000 by 15 means 4 into 400. 400 into 4, 1,600. That is the depreciation for 4 years. Correct or not? Anyone? Please tell me guys. Correct or not? So the major inspection overall expenses incurring for every 4 years only. So in first scenario you need to calculate the depreciation as a whole. So then please tell me guys, depreciation. So cost of the asset 6,300, depreciation equal to 1,600. How to calculate guys? 6,300 minus 300 divided by 15 into 4. For 4 years we need to calculate nothing but 15, 16, 17, 18. 4 years. Correct or not? So 31st December 2018, what is the carrying amount? 6,300 minus 1,600. How much? 4,700. This is the carrying amount. Correct or not? So see guys, in the given question they have given the uh, points, nothing but additional points from 2019 and 20 only. Correct or not? See, the asset got purchased in 2015. Major inspection overhauling made in 2019, not in 2018. If the question is saying about 18, then we need to calculate depreciation for 3 years only. Correct? Yeah. So that's why. So 2019 they have incurred 100 crores of overhauling expenses. How much? 100 crores of overhauling expenses. So overhauling expenses should be capitalized or not? Yes, capitalized. So major inspection and overhauling expenses in 2019. How much? 100. How much? 100. So total 4,800 as of now. Correct? So first point guys, basically this overhauling expenses we are going to incur for every 4 years, not for 15 years. Correct or not? So that's why the part of this asset, okay, for this part we need to calculate depreciation for 4 years only, because we need to incur for every 4 years, which means we need to calculate depreciation for 4 years only, not for 15 years. Correct or not? Because it is, because we are going to incur, we are not incurring for every 15 years, we are incurring for every 4 years only. So we need to calculate depreciation on this part for every 4 years. So that's why for, sorry, for not for every 4 years, the asset got, this cost got incurring for every 4 years, which means you need to calculate depreciation for 4 years only. That's it. So how much depreciation guys? 100 divided by 4. How much? 25. Correct or not? Yes. 100 divided by 4. Along with that, we have already asset value, how much? For every depreciation, for every each year depreciation, how much, guys? How much? 6,300 minus 300 divided by 15. How much? 400 for every year. Correct or not? Otherwise, you can calculate like this also. 4,700 minus 300 plus divided by 11. Sorry, 4,700 minus 300 divided by 11. Why 11, guys? Because we already done with 4 years. Total 15 years, 4 years already done, which means 11 years only pending. So 4,700 minus 300, which means how much? 4,400 divided by 11. How much? Again 400. So 400 plus 25. 425. This is the depreciation for 2019. Correct? Sorry, guys. How much? 425. In 2019, is there any treatment is pending? No. We are going to 2020. That's why first of all calculate the carrying amount. So carrying amount 31st December 2019, how much? So 4,700 plus 100, 4,800 minus 425. How much, guys? 4,375. 4,375. This is the carrying amount on 31st December 2019. Coming to 2020, we are incurring, what is it, guys? Repairs and maintenance, engine capacity increasing by 10%. How much? 70 crores. So 70 crores is a major repairs in 2020. How much? 70 crores. Along with that, we are replacing one asset. One worn out component is there. Nothing but, so one worn out component is there. So what is the treatment, guys? Old component carrying amount should be deducted. New component cost should be added. Correct or not? Yes. Cost of the new component, how much? In the given question, it is 80, right? It is 80. So this should be added. And old component carrying amount is 30. That should be minus. Same thing. Yeah. Plus 80 minus 30. That's it. Plus 80 minus 30. We are done with the treatment as of now. Clear or not? Everyone. This is everything has done in 2020 only, guys. That's why I'm saying I'm adding in 2020 only. Now the asset value is 4375 plus 70 plus 80. Total 150 minus 30. How much? So please calculate. If you have a calculator, please calculate. 4375 plus 70 plus 80 minus 30. How much? 4495. Correct? 4495. See, we have a one more point in the given question. What is it, guys? The scrap realized is 12 crores. So now the asset getting for that old component, we are selling at a scrap. So we are getting 12 crores, which means how much loss we are getting here? The value of the asset is 30. The old component value is 30, but we are selling at 12 crores. So how much loss we are getting? 18 crores. Correct or not? That is the loss or not? So yes, sir, loss on disposal of the asset, nothing but 18 crores. So that should be treated as an expense only. Correct or not? Yes. The loss on disposal of old component is 18 crores. Clear or not, guys? Clear or not? Yes. I'm not considering about in the asset value. This is not I'm considering in the asset value, guys, because I already deducted the 30 crores value. Because the carrying amount of the asset is 30, so I deducted that value. This is not related to asset value. This is completely as loss. Loss, depreciation, nothing but. Not depreciation, it's a completely loss. No, what is the assets with me as of now? One is aircraft. Next, overhauling expenses. Next, repair, new cost of a PP, nothing but new worn out component, as well as repairs cost. These are the new assets, right? Nothing but asset value. The value of these costs should be added to the value of the asset. Correct or not? These costs are added to the value of the asset or not? Yes. So now we need to calculate the depreciation. Yes or no? Yes. This 150 crores we need, it will carry out for 15 years. Nothing but till the end of the asset. Nothing but till the end of the asset, these expenses will carry out. Correct or not? Yes. But coming to this overhauling expenses, that is for only 4 years. Correct or not? Yes. In first year we already done with 25. In second year also we need to calculate the depreciation on it or not? Yes. How much? 25. Next, coming to aircraft, for every each year what is the depreciation, guys? 400. Yes, 400 will continue. 400 will continue. Plus 25 is related to 25 is related to, tell me guys, please. 25 is related to which asset? overhauling expenses. Along with that, we have incurred 150 asset value. What is the depreciation? On this 150, what is the depreciation? Now tell me how many years pending, guys. How many years we are at 2020, right? As of now. So please calculate and tell me. Total 15 years. Okay, 15 years out of that. How many years pending for the aircraft as of now? 10 years, correct or not? So for the 10 years only, we need to calculate the depreciation. How much? 15. That's it. 400 for aircraft. 25 relating to overhauling expenses. This 15 relating to repairs as well as the, what is it? Major repairs. Major repairs as well as replacement of a cost of a PPE. So total depreciation how much, guys? 425, 15. How much? 440. Correct or not? Say yes or no. 440 or not? Yes. Yes. But you will get one doubt here. What is that doubt, guys? First of all, 4495 minus 440. How much? 4055. Correct or not? Please pay attention here, guys. Is here very important point we have. I think everyone have a clarity about the 70 and 80. These are the costs we need to capitalize. Nothing but, correct or not? Yes, we need to capitalize. That is okay. So on this, the depreciation is 15 because the remaining life of the asset is 10 years. Okay. So the balance, what is that pending depreciation? What is it, guys? Overhauling expenses. How much? Depreciation 25 because 100 is the cost. 25 for 4 years. So 25 is the cost. And this 400. What is this 400? Aircraft, related to aircraft. In this 400, that old component part also included. Say yes or no. In this 400 depreciation, the old component that is also included or not? Yes or no, guys? This 400 already calculated previously. So 4700 minus 300 divided by 11. How much? I got 400. So this 400 includes that 30 crores of old component. Correct or not? Yes, it included. Correct or not? Yes. No, the asset is not there. Then why I need to calculate the depreciation on that 30 crores? So how many years pending? 10 years. So 30 divided by 10, how much, guys? 3. So I need to reverse that 3 crores. Think but deduct the deduct the, what is that? Depreciation. Reduce the depreciation. So as of now, I have calculated the depreciation. How much? 440 minus 3. How much? 437. This is the total depreciation, guys. This is the total depreciation. So then please calculate here. 4495 minus 437. How much? 4495 minus 437. 4058. Yes. This is the carrying amount on 31st December 2021. 2020 or 2021? 2020. Not 2021. 2020. Yes. 4058. This is how to calculate, guys. The depreciation old component is 3 that should be deducted. So please don't ignore about this point. Okay, now. So please don't complicate the calculations also. Clear? So I think students will forget about this 3 here. This depreciation, nothing but. Students will definitely forget about this point. So please don't forget, guys. Please remember this point. That's it. I think everyone have a proper clear cut clarity about this question, this topic also. Correct? Everyone. So any questions? Clear, everyone? Okay. We don't have a lot of time, guys. Yeah. Next, the basic question I want to discuss here. What is it? Yeah. This is the exchange of a PP, guys. Exchange of a replacement. Nothing but exchange of a PP with another PP. Okay. Okay, guys. So this concept I haven't given in the marathon book. Okay. But if you want, you can take a snap. Measurement of PP in exchange of another asset. See, guys, cost of such PP measured at fair value given up or received is whichever is more reliable. So basically, when we are exchanging one PP with another PP, then we need to calculate at a fair value only. Generally, fair value, unless we have some conditions. Exchange transaction lacks the commercial substance. If the exchange transaction lacks the commercial substance, then don't 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 measure at fair value. Okay, and or fair value of the neither asset received nor the asset given up is readily measurable, then the measured carrying amount of the asset given up. First point is, if the asset lacks the commercial substance, what the commercial substance, guys? First of all, the position of the company remains the same before and after the barter. Cash flows expect remains same pre and post barter. Barter means exchange of asset only, right? So before and after the cash flows expected from it is remains the same, then it is not a commercial substance. If you are getting more than that, then it's a commercial substance. That's it. Correct? Yes. Benefit, guys. Benefit. If there is no benefit, then we have then don't consider it a fair value. Okay, and second point is, if the asset value received or given up, so for the both the values we don't have any fair values available, then we need to consider the carrying amount of the asset given up, not received, guys. So I'm giving one asset, so please consider the carrying amount of the asset given up. When there is no when the fair value is not available, fair value is not available for both the assets. That's it. Okay, otherwise measure it a fair value. That's it. So this is the order to follow. First of all, fair value of the asset given up. Second, fair value of the asset received. Third, carrying amount of the asset given up. Okay, if these both values are not available, then carrying amount of the asset given up, because that is already, that is pakka available in our books, right? That's why carrying amount of the asset given up. Clear? This is the order you need to follow. Clear? Okay. Everyone, guys, come on, come on, come on, guys. Yeah. So Pluto Limited owns land and building which is carried in the balance sheet at aggregate carrying value is 10 lakhs, 10 millions. The fair value of the such asset is 15 million. It exchanged the land and building for a private jet which has a fair value of a cash. Apply necessary provisions of India 16 for the above transaction pass journal entries. Simple, guys. Here Pluto Limited owns land and building. So we have land and building. So carried in the balance sheet at 10 millions. The fair value of the such asset is 15 millions. Okay. It exchanged land and building for a private jet. Okay. Other asset is private jet. We are taking private jet and giving the land and building. So fair value, which has a fair value of a cash. How much? 3 millions, guys. So the question has something is missing the question. Just wait. Just wait. Just wait. Something. Yeah, guys. So please make some changes in the question. Fair value of 20 millions plus additional cash 3 millions. So please change the question. So which has a fair value of a 20 millions plus additional cash. How much? 3 millions. Yeah, this is the question. Clear? Yeah, coming to the point. So first of all, we have a fair value of a two assets is available. Okay, given up asset value is 15 millions. Next, receiving asset is value, fair value is 20 millions. Correct? Yeah, that's okay. So the first priority giving to giving asset, nothing but the fair value of the asset is 15 millions. Correct or not? Yes or no, guys? Yeah. So and additionally, we are paying 3 millions in cash. Additionally, we are paying 3 millions in cash, guys. So total, how much we are paying? Nothing but 18. Correct or not? Yes. If you want to ignore the 3 millions cash, so ignore that. Okay, ignore that. But basically, the entity should recognize the private jet at a cost. How much? Sorry, where is that? Yeah, how much? The entity should recognize the private jet at 18 millions only. 15 plus 3 millions cash. 15 plus 3 millions cash. And now, can you anyone please tell me what is the profit or loss on disposal of land and building? Anyone? Anyone please calculate and try to tell me what is the profit on sale of land, nothing but disposal of land and building. Anyone? Tell me, guys, please. How much? Tell me. You recognizing the private jet at 15. Now, what is the carrying amount of the asset given up? How much? 10 millions. Correct? Yes, what is the value? 5 only. Yeah, that's it, guys. Simple, guys. Simple. See, the recognition of fair value of asset acquired 15 plus 3,000 total 18,000 minus carrying amount of the asset to dispose of 10,000 minus cash paid 3,000. If you want to calculate like this also 15,000 minus 10,000, then you will get a profit on exchange of asset. How much? 5,000. This is also okay. No worries in that. Now, can you please tell me the entry, guys? Entry. So, PP account debit, how much total? 18,000. We are paying cash 3,000 to, so to cash. To land and building, how much? 10. And profit on disposal of land and building, how much? 5. Correct? Yes or no? Yes. So, please write the entry to cash. So, we have entry here, I think. Yeah. To cash, to profit on exchange of asset, 5,000. Everyone have a clear or not? So please, students will get a doubt about this cash point, guys. If you want to ignore in calculation of profit or loss on asset, yes, you can ignore, but in case of entry, please don't ignore that, guys, because we are paying cash. Yes, we are paying 3,000 cash. That also you need to consider, because see, we are exchanging asset with asset. Along with it, we are paying cash. Yes, you need to consider that cash also. That's it. So please don't forget about that point. Everyone clear about this? So I have taken almost 35 minutes that for this in day 16 only. Okay, if we have a time, we'll discuss, because on this topic we got a question in 2024 June attempt. We got a question from this topic. So because I'm not expecting a question from this topic, but still, if you have a time, I will discuss on this topic. Okay, thank you. So let us start with the topic in days. What is the next standard, guys? 38. 38 or 36? Okay, guys, coming to next standard in days 38. So, examination point of view, yeah, important for every 2 to 3 attempts, they are asking one question, 7 marks. Okay, so first coming to the objective of the stand is simple, guys. The objective is to prescribe the accounting treatment for intangible assets that does not specifically covered in any another standard. Means if any intangible asset is covered under any other standard, like goodwill in case of a business combination, okay, that is covered under Ind AS 103, not under Ind AS 38. Clear? So like that, if anything is covered under any another standard, that is not comes under this standard. That's it. So come to the definition. An intangible asset is an identifiable asset, non-monetary asset, and without physical substance. Identifiable asset means, guys, simply it's separable, guys. Separable. Okay, nothing but separated from the entire, divided from the entity, and then we can sell it, transfer it, license it, or exchange it, so etc. Or we can do it as a rental basis. If we are able to do this, then we can say it's an identifiable. Suppose example, I have my own patent rights. Yeah, suppose example, the example is patent. So I found one pharma drug, nothing but one drug. So I have taken a patent on that particular drug. It's a new new invention by me only. Okay, I have taken a patent on that. So if I want to give it as the, that formula, can I give it to as the other, nothing but can I give as a license? Yes, it is possible. If I want to sell it, yes, it is possible. So which means separated from the entity, as well as I can sell it, I can exchange it, I can license it, I can rental, I can give it on rental basis. So everything is possible, correct or not? Yes, we can say patent is an intangible asset. Yes, and also it should be non-monetary asset. The value becomes changes, guys. Yes or no? Sir, no, guys. Yes, the value becomes changes based on the demand. Okay, so and without physical substance, obviously it does not have any physical substance. That formula. Yes or no? I have taken right on that particular formula, nothing but. So it does not have any physical substance. Patent rights does not have any physical substance. Yes. Okay. Yes. Coming to suppose example one, and one more example like trademark. So suppose example Apple logo. Correct. Yeah. Next, coming to Nike logo. So McDonald's. So every company have different logos, right? So that is nothing but trademark. So they have to register first of all. Okay, so if anyone used that particular logos or patent rights, nothing but anything, if anyone used, they have a right to file a case on them. Yeah, they can suit a case. It's possible, yes. Yeah. So That is the point. And one more point I want to discuss, like copyright. Suppose example, okay, suppose example, I wrote a one particular story, movie story. Okay, so I'm doing my own production, so I have only the right on that. So I need to take a copyrights on that particular production. Sorry, particular story. Okay, so a particular movie, film, nothing but. Okay, so on that I only have a right. Correct or not? If any misuse, for example, you can see in YouTube strikes will, you are getting some YouTube strikes, like if you are using any copied content, so YouTube will strike, I mean YouTube will strike on your channel. Correct or not? Yes, that is nothing but copyrights. Yes. So all this does not have any without physical substance. Everything, everyone has a thing but non-monetary asset. What do you mean by non-monetary asset, guys? Non-monetary asset means not determinable in a fixed amount of a money. Suppose example, it's nothing but non-cash. Yeah, non-cash, it's not a fixed amount of a money. Cannot determine a fixed amount of money. That is nothing but non-monetary asset. Clear? So this is the definition for intangible assets. If you want to recognize intangible asset in your books of accounts, definitely it needs to satisfy two conditions, which is already discussed in Ind AS 16. The same conditions, guys. It is probable that future economic benefits will be flow to the entity, as well as cost of the asset can be measured reliably. Same points, guys. Okay, initial recognition, subsequent recognition, same as a Ind AS 16, but little bit a few other points also included in here. So see, guys, purchase price, yeah, trade discount, import duties and taxes, registration charges, non-refundable taxes, government grant as per not AS 12, it's Ind AS 20. Yeah, Ind AS 20 government grants. Okay, so basically this point they're not involving. I mean, they haven't asked any point like this till now in our exams. And directly attributable cost, like professional fees directly bringing to the assist working condition, cost of testing. Next, employee benefit cost as defined in days 19. Okay, arising directly bring to the assist to the working condition. So everything should comes under directly attributable costs only. Correct or not? If it is directly attributable cost, then only you need to include it. Otherwise, don't include consultancy fees for implementation. Yes, yes or no? All this comes under the cost of the intangible assets. Here, guys, everyone. Okay, this is the cost of intangible assets. Few of the costs should not be capitalized, guys, which means selling overheads, administration overheads, cost of introducing a new product. Okay, cost of connecting business in a new location, a staff training cost, operating losses, entry tax, expenditure on relocating on reorganizing part or all of the entity. So relocating the expenditure, nothing but our business relocating from one place to another. Okay, expenditure on incurring on that, so that should not be included in the intangible assets cost, which should not be capitalized. They're clearly saying, please remember all these points, guys. Definitely will get one MCQ question if they ask. So they're having a chance, some chance in that, in this area. Okay, please remember staff training cost, operating losses, entry tax. So everyone does not include in the cost of the intangible asset, which means it should not be capitalized. Yeah. So coming to subsequent recognition, we have two types of models, which is already discussed in India 16, same as India 16 here also. Okay, so the revaluation model and revaluation concept, everything same, guys, everything same. Yeah, suppose example, we have some more definitions, guys. In case of a fixed assets or PP, we can say it's a depreciation. Depreciation means decrease in the value of asset. In case of a intangible assets, we are using the word amortization, which means systematic allocation of the depreciable amount of intangible assets over its useful life. Over its useful life. Same point, guys. Like a depreciation, amortization. So one more point, please tell me, what do you mean by depreciable amount? Depreciable amount equal to cost minus scrap value or residual value. Please remember this word. Okay, depreciable amount means cost minus scrap value or residual value. Correct? So monetary asset means are the money held and assets received in fixed or determinable amount of money. Non-monetary means other than fixed or determinable amount of money. We already discussed. And one more point, in case of other intangible assets, we have two types of phases, guys. One is research phase, second one is a development phase, guys. Development phase. So research phase means it's original and planned investigation undertaking in the prospect gaining new scientific or technical knowledge and understanding, charge to P&L. Suppose example, I want to find out one software something. So as of now, it is in research phase. Okay, during research phase, whatever the expense you are going to incur, or whatever the expense you have incurred, that should be charged to P&L only. After research phase, okay, once you are going to start the development, okay, when during the development phase, whatever the expenses you are going to incur, that should be capitalized. That's the point it was saying clearly. So development expenses should be capitalized, or research expenses should be charged to P&L. If any question given like this, research and development cost 10,000. So what we need to do here? Charge to P&L, guys. Research and development charge to P&L. Research expenses charge to P&L. Development expenses, it should be capitalized, provided it should satisfy five conditions. If these five conditions are satisfied, then only you need to capitalize. Otherwise, don't capitalize. Okay. If nothing is given in the question, assume that it is these five conditions are satisfying. Understood? So technical feasibility should be there, and intention to complete the intangible asset and use or sell it, ability to use or sell the intangible asset, and probable future economic benefit will be there, and cost should be measured reliably. These are the five conditions, guys. Please remember for theory question also. Okay, not that much important, but just give a single reading. Technical feasibility. Okay, next intention to complete the asset, use or sell it, and ability to use or sell it. Okay, and probable future economic benefits, cost should be measured reliably. These are the five conditions you should remember. Okay, if these five conditions are satisfied, then only the development expenses should be capitalized. Otherwise, don't capitalize, charge it to P&L. That's it. Everyone clear? So 1.5 speed or 2 speed is not required for my class. Correct? Yeah. So amortization. So meaning, it's a we already discussed the meaning. Okay, allocation of the depreciable amount of the intangible asset over the useful life. Next, when we need to start the amortization. So when the asset is available for use. When the asset is available for use. Yes, when we need to stop the amortization, guys. When the asset is classified as held for sale, or when the asset is de-recognized. When the asset is de-recognized. So in these scenarios, okay, in this scenario, which means when the asset is available for use, yes, you can start the amortization. When the asset you need to stop the amortization, means when the asset is classified as a held for sale, or when the asset is de-recognized earlier of the date, whichever is earlier. So de-recognize means remove from the balance sheet, remove from the balance sheet. So for example, you are selling the asset, you are selling the intangible asset, so you need to remove from your balance sheet, correct or not? Yes, that means de-recognize. Okay. Yeah. So I already discussed one point. Whatever the expenses we have incurred during the research phase, that should be charged to P&L. What are the expenses you are incurred during development phase, that should be capitalized, provided five conditions should be satisfied. Correct? Yeah. So coming to problem number one. Expenditure on new production process 2001 and 2. 1st April to 31st December. How much, guys? 2700. 1st January to 31st March 900. Total 3600. Correct? The production process met the intangible asset recognition criteria for development on 1/1/2022. So which means from this date, so the development criteria, we have five conditions criteria, right? So that is satisfying, which means up to that date, which means 31st December. What are the expenses we have incurred? That is nothing but which phase? Research phase, which means research expenses should be transferred to P&L. 2700 should be transferred to P&L, and this 900 should be capitalized. So the cost of intangible asset should be 900. Is that clear? Okay, coming to the amount estimated to be recoverable from the process is 1,000 rupees. Basically, we need to discuss Ind AS 36 also. After that, I will discuss. Then only you will get a clarity from this point. Okay, what is it, guys? So in case in this scenario, basically in case of intangible assets, we need to uh, calculate the recoverable amount of that particular intangible asset, guys. Recoverable amount. What do you mean by recoverable? And everything we'll discuss there only. Okay, Ind AS 36. So just wait for that. So as of now, the value of the PP, sorry, not PP, intangible asset is 900, but the recoverable amount is 1000. I already discussed, if the carrying amount is more than the recoverable amount, then only impairment loss concept will come into picture. Otherwise, it will not come, correct or not? See here, the book value is 900, but the value of recoverable amount is 1000. So, which means it is more than, carrying amount is less than recoverable amount. So, there is no impairment loss. Yes, as of now, the intangible asset value is 900 only. Next, expenditure incurred for the development of the process 2002 and 3, which means next year 6000 they have incurred. As of now, the value of intangible asset is 600, 900 plus 6000. Additionally, they are incurring, right, during 2002 and 3. So total 6900. Correct? So asset was brought into use on 2000. 3 March 31st and is expected to use it for 6 years. So from this date, you can able to use the asset, which means you need to start the amortization. From this date only, you need to start the amortization, not from 900. Because when the asset is available for use, asset is available for use from 31st March 2013. Means from this date only, you need to calculate the amortization, correct? How many years? 6 years. Is there any residual value? Nothing. Nothing is there. So simply you can calculate 6,900 divided by 6. Everyone, 6,900 divided by 6. How much, guys? 1,150. Yeah, 1,150. Correct. 1,150. Clear? So that is the amortization value. Then what is the difference amount? 5,750. Clear? Everyone, say yes or no, guys. 1,150. Yeah, 5,750. Clear. Next, see the guys. In this year also they have given the recoverable amount from the process is 5,000. So as of now, the value is 5,750. Carrying amount is 5,750, but the recoverable amount is 5,000 only. They're clearly saying 31st March 2014, the recoverable amount is 5,000 only. So here the carrying amount is more than the recoverable amount, which means the difference is nothing but impairment loss. Yeah. So how much impairment loss, guys? 750. That should be transferred to P and L. Clear? Everyone. So as of now, the net revised carrying amount should be 5,000 on. This is in days 38. This not, I mean, this concept is more than enough for your exam, guys. Everyone clear? Okay. Okay, guys. Next standard in days 36. Okay. So before going to the standard, so click on like the video first of all. Okay. Next, coming to Ind AS 36, impairment of a asset. First of all, impairment means decline, guys, decline or reduction in the value of asset. Simple. So just I will give a brief explanation about Ind AS 36. What is 36? Impairment of assets. Impairment means reduction in the value of asset or decline in the value of asset. Simple. So basically in this scenario we are going to discuss only about impairment loss. As per which concept, guys? I already discussed about this. As per prudence concept only, expected losses should be recognized immediately but not profits, correct? So as per that principle, so impairment loss we need to recognize in our books of accounts but not impairment gain, because the principle is saying that what the concept is saying, prudence concept is expected loss should be recognized immediately but not profit, so gain should not be considered here, correct? Yes, impairment loss. When this impairment loss will comes into picture? Simple, guys. The difference between the carrying amount and recoverable amount is nothing but impairment loss, which means if the carrying amount is more than recoverable amount, then the difference is nothing but impairment loss. I think I already discussed about this, so we need to discuss more about this recoverable amount. We'll discuss later, just wait for that. So first of all, carrying amount means cost minus depreciation. Then you will get a carrying amount, correct? So that carrying amount should be more than a recoverable amount. Then the difference is nothing but impairment loss. Suppose example, 10 lakhs is the carrying amount and recoverable amount equal to 8 lakhs. So what is the difference? 2 lakhs. Can we consider it as impairment loss or not? Yes, impairment loss, because here the carrying amount of the asset is more than the recoverable amount. Correct? Everyone clear, guys? Yeah. Next, second point. First of all, okay, we are done with already carrying amount, right? So coming to recoverable amount. What do you mean by recoverable amount, guys? Recoverable amount equal to, as per Ind AS 36, fair value less cost to sell or our value in use, whichever is higher. Please remember this, everyone. Everyone, please remember this, guys. Recoverable amount equal to, what is the formula, guys? Whichever is higher, not lower. Whichever is higher. Fair value that is given in the question. Cost to sell for that asset. Okay, cost of selling. Okay, some brokerage expenses we are going to incur. So we may incur, correct or not? Yes, that should be direct from it. Selling expenses, guys. Simply selling expenses. Okay, or value in use. Value in use means we'll discuss later. Just wait for that. Whichever is higher. Can you please repeat the formula? Recoverable amount equal to fair value less cost to sell or value in use, whichever is higher. What do you mean by value in use, guys? Value in use is nothing but present value of future cash flows. Present value of future cash flows from that asset. Suppose example, my from my asset, I'm getting 1 lakh income, 1 lakh cash flow for every year. Every year I'm getting a 1 lakh income. So for 5 years, so I need to bring that 1 lakh to the present value. So present value of a future cash flows, that is nothing but value in use, whichever is higher. Then you will get a recoverable amount. This is the basic question. We can expect the MCQ question from this. Yeah, MCQ question. Clear? So can you please repeat the formula? Carrying amount minus recoverable amount. Carrying amount means cost minus depreciation. Recoverable amount means fair value less cost to sell or our value in use, whichever is higher. Value in use is nothing but present value of future cash flows. So clear, everyone? Next, coming to one more definition here, cash generating unit. What do you mean by cash generating unit, guys? It's the smallest identifiable group of asset that generates the cash inflows that are largely independent of the cash flows from other assets or a group of assets. What is the meaning of CGU? I will explain with a small example, guys. So we have a group of assets, guys. Suppose the example, this is one building. Okay, we have a total 4 floors. Okay, 1 2, this is ground floor, 1 2 3 4 floors. Okay, so these 2 floors I am using for CA purpose, these 2 floors I am using for CMA purpose. Okay, clear? So I'm taking admissions separately for CA as well as a CMA. Okay, clear? So for these two floors I can segregate the income for from CA students. I can segregate it. I can separate the income from CA students with the CMA students. Okay, suppose example, from CMA students I'm getting, suppose example, 20 lakhs per year. Assume that we are not getting. Just I'm taking an example. We don't have any building also. Okay, no, just assumption. So assumption should be high, right? So that's why. So suppose some CA students also I'm getting 20 lakhs. Okay, equal amount I'm getting. Okay, see the difference. See the definition. Smallest identifiable group of asset. Smallest identifiable group of asset. Here the building is a one asset. Okay, out of this building I have separated 2 floors in one go. I mean one part, and other 2 floors in second part, which is for CA as well as the CMA separate courses. Okay, see the point. See the definition once again. That are largely independent of the cash flows from other assets or a group of assets. So if these 2 floors getting income, I mean cash flows getting by from CMA students is different from. Okay, so cash flows from CMA students is independent from cash flows from CA students. So now I can say it is one cash generating unit, and these 2 floors I can say one cash generating unit. Suppose example, if I am not able to generate independent cash flows, okay, if I am not able to generate independent cash flows from other assets, okay, now simply I can say this total building as one CGU. One CGU. Suppose example, I can calculate, I mean, each floor independently, if they are able to generate the cash flow, yes, this one floor is nothing but one CGU. Second floor CGU 2. Third floor CGU 3. Fourth floor CGU 4. The smallest identifiable. If you are able to calculate, okay, if you are able to calculate the cash flows independent of other assets, yes, we can call it as one CGU. So for example, this is first floor. Okay, in this floor I have a 4 rooms. Assume that I have a 4 rooms. Okay, if the each room can independently generate the cash flows, yes, I can say each room is there's a one CGU, CGU 2, CGU 3, CGU 4. If each room is independently if each room can independently generate the cash flows, then I can say it is also one CGU, one CGU, one CGU. If 4 rooms we cannot, I mean, independently cannot generate independent cash flows, sorry, cannot generate independent cash flows. Total 4 rooms, which means first floor totally I can call it as a 1 CGU. Are you able to understand the point, guys? So go to smallest level, smallest level. So for example, in each room, I have a different benches. Okay, I have a benches, I have a projector, I have a system, laptop, mics, everything is there. Okay, for each bench, if if I can calculate the independent cash flows, okay, if it can generate independent cash flows, I can say bench is one asset, one CGU. So basically, that is not possible. So for your understanding, I'm saying this point. Okay, see the point once again. It is the smallest identifiable group. Go to the least level. It's like LCM, least common multiple. Everyone knows about it, right? So we need to calculate the factors as much as possible. Correct or not? In that way, only the CGU definition framed. The smallest identifiable group of asset that generate cash flows. It should generate cash flows that are largely independent of the cash flows from other assets or group of assets. That's it. Clear? Everyone clear? Clear or not? Yes. That is called CGU, guys. So next, corporate assets. Corporate assets are the assets other than goodwill that contribute to the future cash flows of both the CGUs and review and other cash generating units. Simple, guys. Corporate assets is nothing but head office assets, guys. Head office, simple, guys. Okay, head office cannot generate any independent cash flows, but it contribute to other assets. Correct or not? It will contribute to other assets. That is called corporate assets. Impairment loss I already discussed. Recoverable amount already discussed. Value news already discussed. So here, future cash flows includes, excludes also we have. So please remember this point. When you are calculating value in use, so you should calculate. You should consider only cash inflows from that asset. Only cash inflows from assets, nothing but projections. And also, if there is any scrap value, if there is any scrap value, that also you need to consider, because scrap value will be realized at the end of the life of the asset, correct? So that also we need to be considered, because it is also cash flow. So for my marathon class, 2 speed is not required. My class always in 2 speed only. Okay, clear? Next, excludes the cash flows from financing activities, income tax receipts and payments, cash flows expected from future restructuring to which entity is not yet committed. So these points are excluded from the cash flows, which means one is cash flows from financing activities and income tax receipts and payments. Please ignore this. And also, cash flows expected from future restructuring to which entity is not yet committed. If the entity is committed, then you can consider. If the entity is not yet committed, so please don't consider that in the cash flows. In future cash flows. That's it. This is the includes and excludes for future cash flows. Everyone clear? Huh? And one more point. Please read this point. An entity shall assess at the end of each reporting period whether any indication that the assets may be impaired. If any such indication exists, the entity required to estimate the recoverable amount of the asset. So see the point, guys. At the end of each reporting period, if there is any indication exists, if there is any indication exists that an asset may be impaired, impaired means value declined. If there is an indication for impairment, then you need to calculate the recoverable amount of the asset, because for without recoverable amount, how can you calculate the impairment loss? So we cannot calculate the impairment loss without recoverable amount, right? See, when impairment loss we need to calculate, guys? When means please tell me. So only when there is an indication exists that the value gets impaired. So only in that situation we need to calculate the recoverable amount, so that we can easily find out the impairment loss by comparing carrying amount and recoverable amount. So irrespective of the conditions, we need to require. I mean, we need to test impairment test for every year, guys. Every year. So how many we have? 3 points. Intangible assets indefinite useful life. Intangible asset not yet available for use. MCQ purpose important. Okay, goodwill acquired in business combination for impairment annually. So for these three things, for these 3 things, we need to test. I think what which test, guys? Impairment test every year, irrespective of the conditions. Can you please repeat? Can you please repeat intangible asset with the indefinite useful life? Intangible asset not yet available for use. Goodwill acquired in business combination for impairment annually. Is it clear? Next, recognition of impairment loss for individual asset. Basically, impairment loss should be transferred to P&L, guys. It should be recognized in P&L unless carried at a revalued amount. What is the meaning of it, guys? What is the meaning of it? Suppose example, if there is any revaluation surplus with nothing but OCI balance exists previously, so after that, if you get any impairment loss, that impairment loss directly don't transfer to P&L. That should be adjusted to revaluation surplus. Similarly, revaluation increase and decrease concept we have discussed in Ind AS 16. Big sentence. Okay, everyone clear or not? So again, I'm saying generally impairment loss should be transferred to P&L, guys. Okay, but unless if the asset carried at revalued amount, if the asset includes any revaluation surplus in previous years, okay, that impairment loss should be adjusted to revaluation surplus to the extent of it. The extent of it. Clear, everyone? Okay. So one more point students will get doubt. Sir, in case of a revaluation surplus, every year we need to transfer to retained earnings. Yes or no? Yes. How many years? At the end of the life of the asset. Till the end of the life of the asset. Correct? Huh? Suppose example, revaluation surplus is 1 lakh. 20,000 already transferred to retained earnings in this year. So the balance how much? 80,000. So now from this 80,000 only, we need to adjust the impairment loss. Suppose example, 20,000 is the impairment loss. So then the balance 60,000 should be divided between the divided for, I mean, remaining useful life of the asset for transferring to retained earnings. Clear? So after adjustment of impairment loss, then the balance should be transferred to retained earnings over the life of the asset. So clear? This is the point. Same point. Next, recognition of impairment loss, CGU as well as the goodwill. Cash generating is the smallest identifiable group of asset. This is already discussed. See, recognition of CGU. How to recognize the CGU? It is not possible to estimate the recoverable amount of individual asset. An entity is required to determine the recoverable amount of CGU to which the asset belongs. See, suppose example, we have three types of assets, guys, A, B, C. For these three assets, I cannot calculate the recoverable amount separately. I cannot calculate the recoverable amount separately. So then I should calculate the recoverable amount as a whole. As a whole, I need to calculate the recoverable amount. After that, after finding the impairment loss, then I should allocate to each asset. Understood or not? Here, please read the point one. Please read the point once again. It is not possible to estimate the recoverable amount of an individual asset, and it is required to determine the recoverable amount of CGU to which the asset belongs. The recoverable amount of asset of or CGU is measured which whether whenever the indication the asset may be impaired. So this is also we already discussed. So how to calculate CGU, guys? Suppose example, carrying amount of PP in CGU. In CGU, okay, we need to calculate first of all. We should consider the carrying amount. Only carrying amounts. Carrying an amount of intangible assets in CGU. Yes. Carrying amount of goodwill allocated to CGU. Carrying amount of corporate asset allocated to CGU. This is the total carrying amount of a CGU. Sir, why I am adding all these things, guys? Why I should add the intangible asset? Why I should add the goodwill? Why I should add the corporate asset? Means, see, guys, corporate asset cannot generate independent cash flows, first of all. So, goodwill also same thing, guys. Okay. So, intangible asset also here, which means I am not able to calculate the recoverable amount for each asset separately. That's why I'm calculating CGU as a whole. These three things we cannot calculate the recoverable amount separately. So that's why I'm calculating recoverable amount of a CGU as a whole. So I'm calculating here. Understood or not? Even clear. So examiner clearly they will mention in the question, guys. Don't worry about it. Don't worry about it. If the asset, any individual asset is not able to generate any cash flows, they will clearly mention in the question, so that you should include in the CGU. Clear for calculating impairment. Everyone, this is step number one is calculation of carrying amount of CGU. Step number two, calculation of a recoverable amount of a CGU. I think it will directly given the question, or you can calculate directly. They will give the fair value less cost to sell as well as the value in use, whichever is higher you should to consider. And impairment loss equal to carrying amount minus recoverable amount. So this impairment loss you need to allocate right now. After calculating impairment loss, the problem is not completed. So you need to allocate the impairment loss to All assets, guys. All assets. So first priority should go to goodwill, guys. Up to the carrying amount of goodwill. Suppose example impairment loss is 10 lakhs. Assume that. So goodwill carrying amount is 3 lakhs. So first of all, please allocate that impairment loss to goodwill. Okay, then goodwill will be adjusted. Correct or not? Yes. So first to goodwill, and the balance impairment loss should be allocated to other assets in pro rata basis or nothing but carrying amount ratio. Okay. So we have a problem also. Suppose example A, B, C. Okay. This is goodwill. Okay. These three we have. These three are assets. Suppose example 20, 20, 30, 40. Assume that 1 is to 1 is to 2 ratio. Okay. So suppose example, if I got impairment loss whatever amount, that should be adjusted to goodwill first of all, and the balance should be adjusted to other assets in 2 is to 2 is to 4 ratio. Nothing but 1 is to 1 is to 2 ratio. You need to allocate the impairment loss to other assets. That is the concept. Clear? So is there any reversal of impairment loss concept is there? Yes, we can reverse the impairment loss. When, sir? When means simple, guys. Suppose example, initially you got impairment loss. After that, the carrying amount. Basically, for impairment loss, what is the condition, guys? If the carrying amount is more than the recoverable amount in latter years, which means suppose example in year 1 you got an impairment loss. In year 3, suppose example the carrying amount is less than recoverable amount. Basically, there is no impairment loss in this situation. But if there is an impairment loss in previous years, then you need to be reverse it. This is the point. The carrying amount is more than, sorry, carrying amount is less than recoverable amount, then you need to reverse the impairment loss. So for that we have a steps, guys. First, calculate the carrying amount of the asset on the date of reversal. Calculate the carrying amount of the asset on the date of reversal. So today, suppose example, you are reversing it. Okay. So calculate the carrying amount of asset on the date of reversal. So basically, when we need to reverse, when we will reverse, guys, when the carrying amount is less than recoverable amount. Okay. So if you want to reverse the impairment loss, first of all, we must have an impairment loss in previous years. Correct or not? Yes. So please remember that point and calculate carrying amount of each asset should be shown after reversal of impairment loss, whichever is lower. What is the points? Recoverable amount of asset on the date of reversal. Okay, not carrying amount. Recoverable amount on the date of reversal and carrying amount of the asset on the date of reversal of impairment loss. If the asset never get impaired, what is the meaning of it, guys? Suppose example, I will take one example, guys. See the carrying amount. Wait, the carrying amount is 100. Okay, and the recoverable amount is 90. Clear? So impairment loss how much? 10. This is the first year one. So what is the entry, guys? Impairment loss to asset account, nothing but PPE account. Impairment loss to PPE 10 rupees. Okay, clear? Everyone clear about this? Okay. So now the revised carrying amount how much? So carrying amount is 100, recoverable amount is 90, impairment loss 10 rupees. So impairment loss 10 should be deducted from carrying amount. Then you will get the revised carrying amount. How much? 90. So 90 is the as of now carrying amount. Correct or not? Yes, recoverable amount will becomes the revised carrying amount. Correct or not? Yes. So coming to second year, the carrying amount is 90. As of now, carrying amount is 90. First year ending, carrying amount is 90. Now, again, I have revalued the asset due to impairment conditions. The recoverable amount is 105. Okay, why 105, guys? Previously, my estimation is 90 only. Recoverable amount means estimation, guys, not exact amount. So my estimation is 90 only. But coming to second year, my estimation went wrong. So now the recoverable amount equal to 105. So estimation gets increased now. Increased. So now tell me, unnecessarily I have already created the impairment loss that is already charged to P&L. Is that correct treatment by seeing the current situation? No, that is not correct. So that's why here there is no impairment loss. First of all, here there is no impairment loss. Yes, carrying amount is less than recoverable amount. There is no impairment loss. But in previous year we have recognized impairment loss. Now the estimation is wrong. Nothing but complete estimation, sir. Impairment loss is nothing but estimation. Provision, nothing but. So now we need to reverse the impairment loss. How much? How much we need to reverse? So step number one. Step number one. On the date of reversal, what is the carrying amount? On the date of reversal, second year ending, the date of reversal carrying amount equal to 90. Assume that there is no depreciation here. I am not giving clear cut example here. Okay, please ignore the depreciation. As of now, the carrying amount is 90 only. Clear. Basically, depreciation will be there. Okay, I'm not discussing the that much example. So we have one more example, but we don't have a lot of time to discuss. But please take the concept from this question. Okay, so carrying amount equal to 90 on the rate of reversal. Next, second point. What is the second point, guys? Please read the point. Recoverable amount of the asset on the rate of reversal. What is the recoverable amount on the rate of reversal? 105. Carrying amount on the rate of reversal if assets were never impaired. What is the meaning of it, guys? If there is no impairment, then what should be the carrying amount as of now after the second year ending? Can you please tell me in second year? Actually, the cost is 100. Okay. In first year, due to impairment loss, the carrying amount becomes 90. Otherwise, the value will become 100 only. So, which means the carrying amount of the set, if there is no impairment, then the carrying amount equal to 100 only, whichever is lower. Assume no depreciation, guys. Assume no depreciation. I'm clearly saying. Okay, now everyone clear about it? Definitely in the given question they will give the depreciation also. Okay, please don't forget that. Okay, but please remember this concept completely. Then easily you can solve any question, guys. Any question easily you can solve. Okay, so recoverable amount on the rate of reversal is 105. Carrying amount of the asset if there is no impairment. After impairment, the carrying amount is 90. Before impairment, 100. So whichever is lower means how much? 100. So step number 1 minus step number 2. Then you will get the reversal of impairment loss. Sorry, step number 2 minus step number 1. So step number 2 how much? 100. Step number 1 how much? 90. Correct, so 100 minus 90 how much, guys? 10 rupees. This is the reversal amount. What is the entry for reversal of impairment loss? Asset value will get increased, right? So PPE account debit to impairment loss reversal account. PPE account debit to impairment loss reversal account, 10 rupees. Now what is the asset value? Just 10 rupees got increased, right? Asset value increased. So now what is the asset value? Tell me, guys. Value will becomes increased or not? Yes, increased. Yeah. And one more point, impairment loss reversal is a gain to the entity. So that's why that should be transferred to P&L. Basically, it should be transferred to P&L. Correct or not? But if when you calculate the impairment loss, basically it should charge you to P&L. If there is any revaluation surplus in previous years, if you adjust that impairment loss to revaluation surplus, then you need to reverse the revaluation surplus here also. That's a the entry will be impairment loss to realized surplus and P&L. So I think students may I think you may not understand this point. I will discuss once again here. See, guys, when you are calculating impairment loss, what is the entry? P&L to impairment loss. Okay, on that time I have already discussed one point. Directly don't transfer to P&L. If there is any revaluation surplus in previous years, that should be adjusted to impairment loss. So then revaluation surplus should be debited. Previously, due to asset revaluation, it's got credited. After that, due to impairment loss, it's got debited. Now, if there is any reversal of impairment loss, again you need to credit the revaluation surplus, whatever the amount you already reversed. That's why I have written the entry like this. I think everyone have a clear clarity about this. Otherwise, you want to, uh, I mean, watch the video once again. Clear? Yeah, we have uh, more example, but we don't have a time, guys. Okay, including depreciation. With depreciation, this question clear. Point, you can take a screenshot. We don't have a lot of time, that's why. Next, coming to questions, guys. An entity has the following asset with relevant data on the reporting data: A, B, C. So carrying amount, fair less cost to sell, value in use, and we have 5 types of assets: A, B, C, D. Clear. Assets C and D were revalued before. So assets C and D already revalued in previously. The carrying amount of the revaluation surplus is 40 and 30. So this is the revaluation surplus value previously. Okay, nice. Asset E falls in the CGU consisting of goodwill and intangible asset. What is the meaning of it? Asset E falls under the CGU. Asset E cannot generate the independent cash flows. We cannot calculate the recoverable amount of asset E. So that's why it was included in CGU. What is this CGU includes, guys, here? One is goodwill, one is asset E, one is intangible asset. Correct. These three included in one CGU. Clear. The fairless cost to sell of the CGU is 180. Clear. And the value is 170. Tell me, guys, for CGU, what is the recoverable amount? What is the recoverable amount for CGU? Fair value less cost to sell or value in use, whichever is higher. How much? 170 or 180? 180. So that is the recoverable amount for CGU. Okay. Now can you please tell me everyone? Easily now you can calculate for A, B, C, D for independent assets. You can calculate the recoverable amount is directly given in the question. Easily you can calculate the impairment loss. Correct? Yeah. So carrying amount is given. So what is the formula for recoverable amount? Fair value less cost to sell or value in whichever is higher. So whichever is higher, guys, here 300, here 400, here 270. Correct? Next asset D 170. Correct? Whichever is higher. So based on this carrying amount and recoverable amount, you can easily calculate the impairment loss. Correct? Yeah. See guys. What's the carrying amounts? 280, 460, 220, 180. What is the carrying amount of CGU? CGU carrying amount means 90, intangible assets 50, goodwill 140, 140 plus 100. How much? 240. Okay. Now tell me guys. Carrying amount is given, recoverable amount is given. Okay. So tell me the difference. Carrying amount is more than recoverable amount or less than? So less than. So there is no impairment loss. Here carrying amount is more than recoverable amount. Yes, we have impairment loss of rupees 60. Here carrying amount is less than recoverable amount. There is no impairment loss. Carrying amount is more than recoverable amount. Yes, we have impairment loss 10. Correct? Understanding or not? Carrying amount should be more than recoverable amount. Then only impairment loss concept will comes into picture. Okay. So coming to CGU 240, 180. Yes, here also 60 is the impairment loss. Everyone clear about this? Yeah. Now everyone please, you need to tell me, in case of a CGU, if you find out any impairment loss, that should be allocated to all individual assets in that CGU. Correct or not? Based on the carrying amounts. But first of all, you need to allocate the goodwill. Sorry, allocate the impairment loss to goodwill first of all. So what is the goodwill carrying amount here? What is the goodwill carrying amount here? How much? 50 lakhs. So out of the 60 first adjust to goodwill 50, and the balance 10 rupees should be adjusted to other assets means which assets we have? Asset E as well as intangible assets. What is the carrying amounts of those two assets? One is 100, second one is how much? 90. So 10 is to 9. 10 is to 9, you need to adjust the impairment loss to, sorry, impairment loss how much? Balance of impairment loss how much? 10. So this 10 should be adjusted to the end intangible asset in this ratio. 10 is to 9. That's why how much guys? 4.74, 5.26. Okay, now this is the way of calculation. Simple calculation. So this is the revised carrying amount. Revised carrying amount means after consideration of impairment loss. Basic question guys, just use your concept, that's it. Clear? Yeah guys, I think everyone clear with the first question. So coming to next question guys, this is similar to that only, but it includes the corporate assets as well. So ABC has a three CGUs. ABC, the carrying amount of the which has on 31st March as follows: ABC 500, 750, 1100, and remaining useful life is 10, 20, 20. So carrying amounts given for three assets, three CGUs, and remaining life also given. Okay. So ABC Limited has two corporate assets having remaining useful life of 20 years. So X and Y, two are corporate assets carrying amount 600 and 200. See the point here, the carrying amount of asset can be allocated to reasonable basis to the individual CGUs. The carrying amount of Y cannot be allocated to reasonable basis to the individual CGUs, which means you need to allocate the CGUs carrying amount to this one only, not this one, because they are clearly saying X corporate asset only can contribute to other assets. Y is not contributing, which means you don't allocate for Y, only you should allocate for X. X related corporate carrying amount only you should be allocated. See guys, why I'm actually this point we haven't discussed. Sir, in case of a corporate asset, it will not generate any cash flows. That's why we need to include this corporate asset in CGU, even in case of a carrying amounts also. Everything. After calculation of impairment loss, then you need to allocate the impairment loss to corporate assets. Same scenario. Recoverable amount is given for ABC and ABC Limited as a whole. Calculate the impairment loss, okay, and the company as a whole. Clear? So simple one, guys. Very simple. Okay. So first of all, calculate the carrying amount, guys. First of all, calculate the carrying amount. So for calculating the impairment loss, so we need carrying amount, recoverable amount, and then impairment loss. Correct. Coming to step number one. See, guys. So we have a three assets A, B, C. Total is 2,350, 500, 750, 1,000, 100. Correct. So first of all, I need to calculate the carrying amount of the asset. So see, in this scenario, we have a corporate asset also, correct? So corporate asset carrying amount also we need to include in the assets, correct or not, for calculating the impairment loss. So that's why. So see, guys. So we have a how much? Just wait. Yeah. So coming to X corporate asset, the value is 600, correct? So this 600 you need to allocate to all the assets A, B, C. In which ratio? Can you please tell me? Anyone? 500 is to 750 is to 1100. Is it okay? Is that correct or not? Yes or no, anyone? No, not correct. Because the life of the assets is different, guys. Useful life is 10 years, 20 years, 20 years. So different useful lives we have. So that's why we cannot allocate in this way. So now we need to calculate the weights for all these three assets. How to calculate the assets? Simply I can calculate the, see, guys, with the product. So product of the weights. So how to calculate the weights? So 10 is to 20 is to 20 means 1 is to 2 is to 2. So now I will multiply this weights with the carrying amount. So how much? 500 into 1, 500. 750 into 2, 1500. 1100 into 2, 2200. This total should be 4200. Now I will calculate the percentage on this total amount. So 500 divided by 4200 into 100, how much? 12%. 1500 by 4200 into 100, 36%. 2200 by 4200 into 100, 52%. These are the weights. In this percentages, we need to allocate the corporate asset X value. How much? 600. 600 into 12%, 72. 600 into 36%, 216. 600 into 52%, 312. The total is 600. Now the total carrying amount of after allocation of a carrying amount of a X, how much? So already 500 is the carrying amount, correct? Yes or no? Is the carrying amount 500 plus 72, total 572. 750 plus 216, 960. 1100 plus 312, 1412. This is the carrying amount after allocation of corporate asset X. So why I need to include this corporate asset X in all the assets? Why I need to allocate this? Because we cannot, because that corporate asset does not generate any cash inflows. Correct or not? So we need to calculate the impairment as a for each assets. So for that purpose, first of all, this X will allocate to ABC. They're clearly saying the corporate asset allocated to ABC, which means all the assets in reasonable basis. So in that basis only I already allocated. After that only I can calculate the recoverable amount. Okay, now. So after that only loss. Okay. So how to calculate the impairment loss? I already have a carrying amount. Yes. Now I want the recoverable amount. So the question is already saying about the recoverable amount, right? 600, 900, 1400. Correct? Yes or no? Yes. The difference is 66 and 12. In this A, asset A, there is no impairment loss. Asset B, 66. Asset C, 12. These are the impairment loss. Now you need to allocate this impairment loss to all the assets. That's it. Clear? Everyone, simple question, guys. Correct or not? Yes or no? Yes. So you can please allocate this impairment loss related to B. And here impairment loss how much? 12. Asset C, 12. Now see the allocation of impairment loss, how to allocate. So now I want to allocate this impairment loss to CGU B. Correct? Yes or no? In this CGU B we have two assets. One is corporate asset and another one is B. Correct? Asset. Individual asset as well as corporate asset. So we need to allocate this 66 into for those two assets. Okay. See, guys. One is corporate asset. How much allocation to be? See guys, 66 into, in which ratio guys? 66 is the impairment loss. Now you need to allocate, correct or not? So in which ratio? Carrying amount ratio. So go to carrying amounts. In case of asset B, CGU B, okay, the total CGU, sorry, total carrying amount is 966. Carrying amount of X is 216. So in this ratio, you need to allocate. So 216 divided by 966. How much, guys? 15. Okay. So out of 66, so 15 allocated to related to X, and other CGUs, how much? 50. The total is 66. Correct? So other CGUs is other generating units is 51, and accelerated how much? 15. Here also same. We have how much impairment loss here? 12. So please allocate in the similar way. So please tell me anyone, what is the impairment? What is the carrying amount of CG? Sorry, corporate asset here. How much you have allocated to C asset, yeah, guys? 312. So 312 divided by 1412 into 12. How much? Correct. So 3 related to X. And the difference how much? Out of 12, 3 already allocated to X. So remaining should be allocated to other CGUs. How much? This is the way of allocation, guys. Please apply your concept clearly. Here, what I am doing is simply I have calculated the carrying amount after corporate asset, after considering of corporate asset and recoverable amount. Then I got the impairment loss. That impairment loss allocated to all other assets. Here we have a two CGUs. We got an impairment loss. One is B, second one is C. Here 66, here 12. So now this 66 should be allocated to, one is corporate asset and second one is other assets. Here also same. One is corporate asset and second one is other assets. Simply I have allocated in the carrying amount ratio. That's it. Clear or not? So now I have calculated the impairment loss of a la- large cash generating unit as a whole. Company as a whole, they are asking. Okay. See the carrying amount. Simple guys, carrying amounts. Just I have taken the carrying amounts X, Y, Z, A, B, C total 3150. So impairment as I already allocated to all other assets, right? So here 51, C 19. So in case of X, how much? X how much, guys? Here C 15 plus 3 how much? 18. So 18. Why there is no impairment loss? Totally 78. See the carrying amount 500, 99, 1091, 582, 200, total 3072. The total. But in the given question, they have given the CGU value, recoverable amount, how much? 3200. 3072 is the 3072 is the carrying amount, recoverable amount is 3200. Here, how much impairment loss, guys? There is no impairment loss, company as a whole. But in case of individual assets, we have an impairment loss. Simple. Everyone clear about this last point, guys? This is company as a whole. So we have total how many assets? A, B, C, X, Y. Okay. So total how much? 3150. Okay. Impairment loss I already calculated. So I adjusted the impairment loss, whatever I already allocated to each asset. So B, C as well as X only have impairment loss I already allocated. So after that, the carrying amount is this one. So the recovery amount is already given in the question. The difference is less than the, I mean, carrying amount is less than the recoverable amount. Then there is no impairment loss. Impairment loss of a large cash generating unit is nil. That's it. This is clear cut. Okay, explanation regarding Ind AS 36. Okay, next topic we're going to discuss Ind AS 20. Okay. Hi guys, good evening to all. So coming to next standard Ind AS 23. So examination point of not that much important, but they may ask one MCQ question or one 5 marks question also they will ask 4 marks or 5 marks. Okay, sometimes 7 marks question. So they will ask. Okay, so pay attention for this. It's a very simple topic. Just you need to spend only 15 to 20 minutes of a time. You will get a complete clarity about this topic. Clear? So first of all, the scope of the borrowing cost. I think what the object of the borrowing cost is. What is it, guys? What is the standard name? First of all, borrowing cost. What is the meaning of borrowing cost? First of all, cost incurred for borrowing of funds. Simply. Okay, suppose example, if you take a loan from a bank, you need to pay the interest, right? So that interest is nothing but borrowing cost. Understood or not? It's like a supporting cost, correct or not? Yeah. See, borrowing cost of the interest and other costs incurred by an enterprise in connection with the borrowing of a funds. Simple example. Okay, sometimes you may incur some brokerage expenses also along with the loan amount. Correct or not? Say yes or no, guys. So that is nothing but a borrowing cost. Basically, here they are going to discuss only about the interest part only. So mainly they will ask a question with the interest only. Interest, the best example for borrowing cost. So if you take a loan from a bank, you need to pay interest to the bank. Okay, that interest should be basically charged to P and L. Correct or not? Interest is an expense that should be charged to P and L basically. But in this standard, as per this standard, that interest should be capitalized. That interest should be capitalized. Capitalized means added to the value of asset. Sir, why, sir? Why? Where is the asset here? Why we need to add the interest portion to the value of the asset? Is there any relation? Yes, guys. Yes. So in that scenario, this concept will come. Basically, whatever you have taken a loan from a bank, that loan should be used for the purpose of qualifying asset. For which purpose, guys? Qualifying asset for acquisition or a purchase or construction of a qualifying asset. If you use that money for the purpose of qualifying asset, then whatever the interest you are paying, that should be capitalized as per Ind AS 23. That's the stand is clearly saying, guys. First of all, what do you mean by qualifying asset? Qualifying asset means basically an asset which takes a substantial period of time, okay, to get ready for its intended use or a sale. What's the point, guys? Qualifying asset is an asset that necessarily takes a substantial period of time. What do you mean by substantial period of time? Basically, will take a 12 months, guys. 12 months. Okay, if it will take 12 months, assume that, suppose example 13 months in our example, okay, to get ready for its intended use or sale. Okay, I want to use the particular asset. Okay, I want to sell it. Okay, before that, it will take some time period, guys. That is nothing but here substantial period. They are using the word. Generally, it will be 12 months. Suppose example, I want to construct a 5-floor building. It takes almost 2 years of a time. Can I say it's a qualifying asset? Yes, qualifying asset. For the if the, for this purpose, if I take a loan from a bank, okay, that loan should be used for this building purpose. Then whatever the interest paying on that should be capitalized as per Ind AS 23. That is the standard, simple standard, guys. Very very simple. Seriously, everyone understood or not? Basically, interest should be transferred to P&L, but as per this standard, that interest should be capitalized. Capitalized means added to the value of asset. Clear? Everyone, suppose example, interest to pay 10,000. What is the entry? Basically, entry. What is the basic entry? Interest to cash. Correct or not? Interest to cash. Sir, no. Yes. But for example, as per Index 23, if that interest should be capitalized as per Index 23, then what is the entry? Then PPE account, nothing but qualifying asset account debit to. For example, if it is for the purpose of building purpose, so then I will take the PPE account debit to cash or bank. This should be capitalized. Capitalized means added to the value of asset. Entry, basic entry, guys. Everyone is clear about this? So I have a few examples, guys. Okay. Yeah. These are the examples. Manufacturing plant, power generation facility. For example, construction of a building, construction of a plant. Generally, it will take more than 1 year. Sir, sometimes if it takes 9 months only, yes, that is also qualifying as it. Okay. Don't worry about it. So because it is taking some time, right? Not immediate ready to use. Correct or not? So that is a qualifying asset. Okay, inventories that require substantial period of time to bring it to a sellable conditions. In case of inventories, also sometimes it will take a substantial period of a time, like wines. Okay, so in that scenario, it will take some time period, right? So that's why it is also qualifying as an investment properties. Obviously, construction of a building, everything comes under what is it, guys? Qualifying examples. So whatever the interest paid on those qualifying assets, that should be capitalized. Okay, clear. For example, sometimes non-qualifying assets also they will give in the question. For example, working capital. Okay, purchase of a tractor, purchase of a tractor or a truck. So truck is already ready to use. So whatever the expenses you have incurred on that particular asset, that should not be capitalized. Means the interest on that portion should not be capitalized because It is not a qualifying asset. So working capital, it is also not a qualifying asset. So that's why whatever the interest we are incurring on these two assets, nothing but these two items, that should be transferred to P&L. For example, basic advance for purchase of a truck. Okay. So for example, you want to purchase the truck. Okay. So for example, if the truck is ready to use, immediately ready to use, okay, it does not take a substantial period of time because it's already ready to use. It is already manufactured. So then it is not a qualifying asset. Whatever the interest portion, that should be transferred to P&L. Okay. Recognition of borrowing cost. If you want to recognize the borrowing cost, so first of all, borrowing cost are the cost directly related to which purpose, guys? Acquisition, construction, production of qualifying asset. Then it should be capitalized. I already discussed about this point. Borrowing cost. What is the borrowing cost, guys? Borrowing cost are the cost capitalized as a part of the qualifying asset, as a part of the cost of qualifying asset, which means it is included in the qualifying asset cost. Yes. When, sir? When it is probable that future economic benefit should be flow to the entity, and cost should be measured reliably. Qualifying asset, first of all, if you want to capitalize the interest, okay, what are the expense you are incurring, that should be incurred on the qualifying asset, first of all. What do you mean by qualifying asset? We already discussed in definition. Okay. Before qualifying asset, it should be an asset, first of all. Correct or not? If it is an asset only, then only it will come under qualifying asset. So, for asset definition recognition criteria, we already discussed in Ind AS 16. Same points we have discussed here also. That's it. Okay. So other borrowing cost should be charged to P&L. Means non-qualifying assets. Whatever the interest you are incurring, that should be transferred to P&L. Okay, period of capitalization. When we need to start the capitalization, when we need to suspend the capitalization, when we need to stop the capitalization. These 3 points are very important, guys. See, guys, first of all, when we need to start the capitalization. So I need to start the capitalization means we have a three conditions, guys. Expenditure on qualifying asset being incurred, borrowing cost should be incurred, activities are in progress. Activities means, suppose example, I want to construct a building. So I have already purchased the bricks and all, cement, everything, sand, everything I already purchased. Okay, workers is working on that, which means they are constructing the building, which means the activities are in progress. Yeah. So if the condition is satisfied, then only we can start the calculation. What are the three conditions, guys? First of all, expenditure should be incurred on the qualifying asset, borrowing cost should be incurred, activities are in progress. Okay. Sometimes, see, guys, which are necessary to make the asset for its intended use or sale. Activities are in progress means, suppose example, workers are just they came to uh, I mean that a particular construction area, and they're just sleeping and going back. Is there any activities in progress? No, there is no activity, so that is not comes under activities in progress. Okay. So first of all, activities are in progress means it's like a physical construction should be going on, as well as sometimes technical and administration work also need to be required before commencement of a physical construction. Suppose example, I want to construct a building. Okay. So on roadside, Hyderabad, SR Nagar roadside. Okay. So for example, I need to get a permission from municipal authorities, local authorities, etc. First of all. So for approval purpose, it was taking 2 to 3 months. Assume that. Okay. So for example, I have taken loan from 1 for 2020. Okay. But I got approval on 1/7/2020. So from when I need to start the calculation, 1 for 2020 or 1/7/2020. So suppose example that delay is, I mean, the delay is necessary for the construction purpose, then you need to capitalize from starting only. Date of loan. If you start from this date, but you got on this date that approval, so you can start the calculation from 1 for 2020. Okay, na guys. So this is the commencement. Next, coming to suspension. Suppose example, no active development or active development is interrupted, which means, suppose example, workers are, I mean, strikes or lockouts they are doing because of non-payment of a labor charges, something, etc. Whatever the reason, they are not giving any hikes proper. I mean, wages are not paying by the build or something. Okay. So in that scenario, suppose example, they are doing some strikes and all. So because of that strike, the construction got interrupted. The active developments got interrupted. So in this scenario, you need to stop the capitalization. Stop means suspend the capitalization. So for that time period, you need to suspend the capitalization. Suppose example, they have worked for 3 months. After that, they have not worked for again 3 months. Next 3 months. So these 3 months you need not capitalize the interest. For these 3 months only, you need to capitalize. That's it. The simple point, guys. So except means suppose example, sometimes the delay is necessary. Sometimes such delay is necessary to get asset ready to use. So in that scenario, or some technical work is going on. So in these scenarios, yes, that is okay. Which means not suspension, which means not delaying the work. It is required for asset to get ready to sorry to get the ready necessary for asset ready to use. Okay, sorry guys. Okay, that necessary is that delay is necessary. In that scenario, don't suspend the calculation. You need to continue the calculation. So next, coming to when we need to stop the calculation, guys. So when the asset is ready to use, the asset is ready to use. So for example, I want to construct three-floor building. So that three-floor building is already ready. So you need to stop the calculation. From that date, you need to charge the interest to P and L. P and L. Clear, everyone. So for example, in the three floors, okay, first floor is completed. Okay, if I am not able to use without construction of these two floors, then i I mean, don't stop the calculation. I need to continue until the completion of three floors. Suppose example, if I am able to use this first floor, other, I mean, irrespective of the second and third floors, then I need to stop the calculation for first floor. I need to continue the calculation for next two floors. I mean, two and third, second and third. Clear? So this is the point, guys. Next, borrowings. First of all, coming to borrowings, basically we need to will take a loan from the bank. Okay, and then you need to pay the interest. Okay, then this concept will come. So first of all, we need to discuss about the borrowings also. Borrowings are two types, guys, which is specific borrowing. Second one is general borrowing. Specific borrowing means a specific purpose. Suppose example, you have taken a loan from particular building, a block building purpose. A particular building purpose, you have taken loan from a bank. That is nothing but specific borrowings. There is no general scenarios. Okay. See, so when enterprise borrow funds specifically for the purpose of obtaining particular means specific qualifying asset. So in that case, the borrowing should be directly identified, readily identified, which means 10%, 5%. The rate of interest is directly you can identify in case of a specific borrowings, because you have taken loan from particular purpose only. They will give some interest rate, 10%, 12%, 8%, something. That is a specific rate. If you use, you must use that amount to this purpose only, this particular asset purpose only. Suppose example, I want to construct a building, okay, a block building, something. So you must use that funds to this a block building only. Don't use for other than this. Okay. So suppose example, I have taken loan from a bank 10 lakhs at the rate of 10%. What is the interest rate, guys? What is the interest amount? 1 lakh is the interest. So this 1 lakh should be capitalized at any cost, because you must incur this 10 lakhs for this building purpose. Okay. So but here what I am doing is, in first 6 months I am using only 5 lakhs only. Okay, after 6 months only I will use the balance 5 lakhs. So that's for that purpose I want to invest this 5 lakhs at a temporary investment. Okay, I want to invest this 5 lakhs as a temporary investment, because initially I'm using 5 lakhs. So the balance 5 lakhs I'm keeping as a temporary investment. So in that scenario I will get some interest, right? Or some income I will get. So that income should be deducted from the total borrowing cost. Don't capitalize total 1 lakh. You need to deduct the interest portion on this 5 lakhs. Whatever the interest you are getting from the other parties. Understood or not? Suppose example, in 5% also I am giving it a 12%. Assume that 12 means 5 lakhs into 12% how much? 60,000. Correct? So this 60,000 should be deducted from the total borrowing cost. Only 40,000 should be capitalized. Is that clear or not, guys? Everyone, is that clear? Actual borrowing cost. As per our example, it is 1 lakh. Income from temporary investment, that is 60,000. So the amount to be capitalized is 40,000. This is the specific borrowings. In case of a specific borrowings, borrowing cost directly identified. That amount must be used for the particular qualifying asset purpose only. If you invested as a temporary investment, part of the amount you invested as temporary investment, then whatever the income on the temporary investment you are getting, that should be deducted from the total borrowing cost. The balance should be capitalized. So coming to general borrowings, we have three steps, guys. If you follow these steps, definitely you will get a. Okay, guys. Coming to general things, yeah. Coming to first one, calculation of capitalization rate, guys. First of all, what do you mean by general borrowings? So whatever the loan you have taken from the bank, that should be used for the general purpose, not any specific particular building purpose. Okay, you have a lot of assets, lot of things. Okay, for that purpose you are using that particular loan. Okay. So, but whatever the loan you have taken, that should be used for the qualifying asset only if you want to capitalize it. Otherwise, you cannot capitalize, correct or not? Even there is no particular qualifying asset. We have a lot of qualifying asset, okay? So, for example, A, B, C, D. One is plant and machinery, manufacturing or a construction of a building, okay? So, manufacturing a plant, okay? So, so we have different types of a qualifying assets. So, for that purpose, you are using that particular loan, okay? If the loan used for specific purpose, it comes under specific borrowings. Okay, which means the loan whichever you have taken from the bank, that should be used for the particular purpose only, specific purpose. But these general borrowings you have taken for different purposes we have. That's why I'm calling it as a general borrowings. So for in this case, you need to calculate the capitalization rate because you need to apply one particular rate, right? Correct or not? Yes. So for that purpose, you need to calculate the capitalization rate. How to calculate the capitalization rate, guys? Simple, guys. Borrowing cost divided by total loan amount into 100. Simple. Average outstanding loan, simply outstanding loan amount. So for that I'm using a different, i mean terminology. See, average borrowing cost incurred during the year divided by aggregate average outstanding borrowings into 100. Then you will get the capitalization rate. Average borrowing cost means, so depends upon the number of months, depends upon the number of months. Okay, so you should be very careful in this calculation. We have one problem also. We'll discuss there. Okay, please remember simply borrowing cost by outstanding borrowings into 100. Nothing but interest by loan amount into 100. Simple logic. Because then you will get the interest percentage, right? Interest by loan amount into 100 means interest percentage you will get in in that same scenario. Borrowing cost, average borrowing cost incurred during the year divided by outstanding borrowings into 100. That's it. That is the basic formula. But we have a lot of discussion we have. So we'll discuss in the problem. Clear? So coming to, what do you mean by average outstanding borrowing? Simple amount of borrowings into number of months outstanding divided by 12. Because sometimes you have taken loan from a bank. So for example, 1 for 10 you have taken loan, some 10 lakhs rupees. Okay, you have taken loan from a bank. So 1/7 2020 or 24. So you have taken 5 lakhs loan. So, see, you need to check the number of months, guys. Here, from starting of the month, starting of the year, nothing but. So, we have a 12 months. So, into 12 by 12. So, for example, 7 means 4, 5, 6, which means 3 months already done. So, you have taken loan on 7th month, which means a 4th month. So, 8 by 8 divided by 12, because that loan will carry for 8 months in that year. Correct or not? So, that is the calculation. Number of outstanding months divided by 12. Clear, guys? So this is the main thing. So what is the amount to be capitalized as per central borrowings? See, guys, what is the formula? This is very important, guys. Whatever expenditure you have incurred on the asset, which asset, guys? Qualifying asset into capitalization rate. That's it. Into capitalization rate. So interest to be capitalized equal to, this is the main formula, guys. Interest to be capital. That is what we require as per this standard, correct? Because we need to calculate the interest on capital. Interest should be capitalized how much amount? Correct. So how much amount should be capitalized equal to, as per general borrowings, expenditure incurred on the asset into capitalization rate. So capitalization rate means we already calculated. What is the borrowing cost? Average borrowing cost divided by average borrowing. Expenditure incurred on the asset also given in the question. Given in the question. So different dates, different amount you are going to incur. So on that you need to calculate this interest. On that you need to apply this capitalization rate. Then you will get the interest amount to be capitalized. So clear, everyone? So I already discussed qualifying and non-qualifying asset. So need to discuss in lecture, which means simple, guys. I already discussed that. So A, B, C, D. So we have four assets, right? So for example, A means it's like a manufacturing a plant. Okay, construction of a building. This is working capital. This is purchase of a truck. Assume that. So it is qualifying, it is qualifying, it is not qualifying, it is not qualifying. Okay. In the given question, they will give about the total interest. Suppose example, total interest equal to 10 lakhs. Total interest equal to 10 lakhs. So total interest amount they will give in the question. Okay. So this 10 lakhs you should be apportioned to all the assets based on the prices. Correct or not? Yeah. Suppose example, this is 20, 50, 10, 20. Okay. This is the expenditure incurred on this assets. Expenditure incurred on the assets is 20 lakhs, 50 lakhs, 10 lakhs, 20 lakhs. The total interest is 10 lakhs. Assume that the total interest is 10 lakhs. So then how much amount should be capitalized? How much amount should be charged to P&L? So 10 lakhs into 20 divided by 20, 70, 80, 100. So 20 by 100. See here 10 lakhs into 50 by 100. How much? 2 lakhs. Here 5 lakhs. Here 10 lakhs into 10 by 100. How much? 1 lakh. Here 2 lakh. This 3 lakh should be charged to P&L. This 7 lakh should be capitalized. This is your answer. Should everyone have a clear clarity about it? It's a basic question. Basic question. Clear? So coming to this is the examination question. Now you will get a clear clarity about this topic. The X Limited began construction of a new building on 1st January 2021. It obtained 1 lakh special loan. Please underline the word in the special loan. Special loan. Okay. So how much, guys? 1 lakh. 1 lakh special loan. How much? What is the rate of interest? 10%. Can you please tell me what is the borrowing cost as per the specific borrowings? Specific borrowing part amount is 1 lakh. Rate of interest is 10%. How much total? 10,000. Called borrowing cost should be capitalized. Okay. Under specific borrowings. So this is separate calculation. Correct. So general borrowings is different. Specific borrowings is different. Specific borrowings borrowing cost is directly we can identify like this. Total how much? 10,000. Correct. See, next I have taken loan from a bank 5 lakhs and 9 lakhs. Assume that the same date 1/1/2021. Assume that 1/1/2021. 11% interest, 13% interest. Okay. The expenditure on the building project as follows. So in this way, they have incurred the expenditure. They have incurred the expenditure the following months. So Jan 2021, which means first. Assume that it is first, first. Okay. So 2 lakhs expenditure incurred, 2 lakh 50 incurred, 4 lakh 50 incurred, 1 lakh 20 incurred. Total how much? 2, 4.5, 9, 10 lakhs 20,000. Correct? Here. Okay. 2 lakhs to 2 lakh 50, 4 lakh 50, 9, 10 lakh 20,000. They have incurred total amount. Clear or not? Yeah. Ignore that part because we don't want this total amount because they have incurred in different timelines. So that's why we need to calculate the based on number of months. Okay. The building was completed on 31st December. First of all, please remember this point, guys. When you calculate the interest to be capitalized, when you calculate the interest to be capitalized, okay, and in that scenario, which means what is the formula for that? Interest to be capital is equal to expenditure incurred on the asset into capitalization rate. In this scenario, don't take total expenditure, guys. In this expenditure also you need to take the period. Period also very important here because the completion date is very important because up to the date of completion only we need to capitalize the interest. So after the completion date we cannot capitalize. That's why this 31st December is very important in this scenario. Okay. So you need to calculate the number of months from the date of taking loan to from the date of expenditure incurred to completion date. Here Jan 1st, I have incurred 2 lakhs of expenditure. So from Jan 1st to 31st December, how many months? 12 months. Yeah, 12 months you need to calculate the average expenditure. Here on April 1st I have taken. So April 1st to 31st December, how much? 9 months. So 9 months only I need to calculate the expenditure. Average expenditure. Here also same. July means 6 months. December means 1 month. So in this scenario, you need to calculate the cumulative expenditure, average expenditure, guys. On that only we need to apply the capitalization rate. See, coming to weighted average accumulated expenses. See, guys, 2 lakhs into 12 by 12, 2 lakh 59 by 12, 4 lakh 50 into 6 by 12, 1 lakh 20 into 1 by 12. So why I need to apply these timelines? Because this in this scenario, okay, that completion date is very important, guys. building completion date is very very important. Please remember, because up to the date of completion only we need to capitalize the interest. So whatever the expenditure incurred, that should be, I mean, before, I mean, which is ready to use, which means before completion only, up to the date of completion only, you need to calculate the interest. That's why, so here the completion date is 31st December. So you need to consider up to the 31st December only from the date of incurring the expenditure. Incur the expenditure. So 1st January to 31st December, 12 months, 9 months, 6 months, 1 month. Total 2 lakhs, 1 lakh 87, 2 lakh 25, 10,000. Total 6 lakh 22,000. This is the total expenditure I have. Everyone clear about this? This is the total expenditure I have incurred. Average expenditure I have incurred is 6,22,500. Yeah. Yeah. See, coming to, sir, where is the specific borrowings? Everyone. In this 6,22,500 includes that specific borrowing amount, because whatever the specific borrowing you have taken, that must be incurred initially. That must be incurred initially. So that 1 lakh must be incurred. You must incur that 1 lakh. So that's why please keep aside that 1 lakh out of the 6,22,500. Keep beside the one. I mean beside the specific borrowing amount. How much? Balance how much? 5,22,500. Yeah. Or otherwise, you can think like this also. You can think like this. For example, initially I must incur the specific borrowing amount, correct? So whatever the expenditure 2 lakhs incurred on Jan 1st, so I want to ignore this 1 lakh. I want to ignore the 1 lakh as specific borrowing I kept up beside. So please remove that 1 lakh out of this 2 lakhs. Okay? Because what is the borrowing cost on special borrowings? 10,000. We already know about it. If you want to keep it as separate, yes, you can take it. Special loan amount. How much? 1 lakh into 10%. How much? 10,000. This is interest on special borrowings. So you need to remove that 1 lakh from the first expenditure. First expenditure. First remove that. So out of this 2 lakhs, remove that 1 lakh. So balance how much, guys? 1 lakh only. Okay. Here the calculation is same. 2 lakh 15 to 9 by 12. Okay. 4 lakh 56 by 12. This is same. Then you will get directly 5 lakh 22,500. Okay. Initial step only. Please remove that special borrowing amount. Why I need to remove, guys? Because that must be incurred initially. Okay. So on that borrowing cost is directly identified already. How much? 10,000. The 10,000 must be capitalized. After, along with that, we need to capitalize interest on general loan also. Correct? General borrowings also we need to capitalize interest. How much? So in this total amount, 5,20,500, we need to apply the capitalization rate, because what is the formula? Interest to be capitalized equal to expenditure incurred on the asset into capitalization rate. Then how to calculate the capitalization rate? Simple, guys. Average borrowing cost divided by average borrowings. Simple. See, I have taken loan on 1st January only. So 5 lakhs into 12 by 12 into 11%. 11% means interest amount. So interest amount how much? 55,000. 5 lakhs into 11% into 12 by 12. Clear? So here also 9 lakhs into 13% into 12 by 12, because there is no specific date. Okay, here which means 1 1. Here also 1 1 1 2021 only. There is no specific dates. If there is a specific dates, then you need to calculate based on that number of months only. Suppose example, if it is on 1 4th, then you should take only 9 months only. Clear? Say, sir, no, guys. Yeah. In this scenario, I got a total 1,72,500. That is the total amount of interest. Then what is the loan amount? So loan amount also, what is the aggregate average outstanding borrowings? How much outstanding borrowings, guys? How to calculate the outstanding borrowings? Tell me, anyone? Simple, guys. Based on the number of months only. So here 5 lakhs into 12 by 12. Here also 9 lakhs into 12 by 12. How much? 5 lakhs plus 9 lakhs, 14 lakhs. 1 lakh 72,000 divided by 14 lakhs. Total 12.285 percentage. Suppose example, if it is on 1 4th 2021, assume that, then you need to take 9 months only. This is called average borrowings. Okay, for loan purpose, average borrowing cost by average borrowings, correct or not? So please be very careful, guys. So in this scenario, the building completion date is not necessary for calculate the capitalization rate. Please remember this point. Building completion date is not required for this situation. Okay, clear, everyone? This is the calculation. For, I mean, this is the question from Ind AS 23. Very important, guys. Very important. I think I have taken 30 minutes of time. This is not, I mean, not required that much. But one more point I want to discuss regarding exchange gain or a loss. Okay. So I will discuss that point just here only. No worries. Hey guys, so I want to discuss about this exchange difference arising from foreign currency. Basically, this is the combination of India's 23 as well as India's 21 foreign exchange. Okay, India's 21. I am will discuss the topic later, but this is a linked point, guys. Linked point means some portion of amount should be treated as per India's 23. Some portion of amount should be treated as per India's 21. Effect of change in foreign exchange rates. Sorry. Okay. See, guys. So in this scenario, basically exchange difference, when the exchange difference will come, guys, basically anyone, then it will arise. Suppose example, if you purchase a goods from US company, US company or from US, okay, so you need to pay money, right? Suppose example, today I want to purchase some goods or an asset from US, okay, so I already make a purchase order, something, I already made an order, but payment is not, I mean, I will do payment after 3 months. Okay, as of now I'm not doing any payment, but as of now the dollar value, suppose example 85 rupees. Okay, after 3 months the dollar value may be increased or decreased, I don't know. Based on that only I need to pay the money, correct or not? So then exchange difference will come or not? Anyone? Yes or no, guys? Cool, guys. Understanding this point. Suppose example, the value of a particular asset is 1 lakh dollars. Each dollar value is 85. Total how much? 85 lakhs. So if I want to purchase right now, okay, how much amount I should pay? 85 lakhs. But after 3 months I am paying. On that day the dollar value equal to, suppose example, 90 rupees. So then how much amount required to pay for that 1 lakh dollars? Because I need to pay in dollars only. For that I need to go to embassy, I mean exchange center, nothing but, so I need to change the currency and then I will pay, correct or not? I should pay after changing the currency only. So I need to pay 1 lakh dollars. So if I go to that exchange particular sorry, exchange office, nothing but, so I need 1 lakh dollars. As of now I need 1 lakh dollars, but how much amount required as of now after 3 months? 90 lakhs of amount should be required, correct or not? With 85 lakhs they will not give that 1 lakh dollars, correct or not? Yes. So I need to pay 90 lakhs, correct or not? I need to pay 90 lakhs to get that 1 lakh dollars, which means on the date of purchase only I already entered the journal entry in my books of accounts as a pp to some ex supplier account, correct or not? Yes or no? Yes, pp to x account, something, x means supplier, assume that. Okay, but I'm doing the payment on after 3 months. After 3 months I'm doing the payment here, 85 lakhs only. Here also 85 lakhs. But coming to the date of a payment, so X account debit to cash or bank. How much I'm paying? I'm paying 90 lakhs. But the how much amount I should pay to guys? 85 lakhs only. Correct or not? 85 lakhs only. Sir, no. Tell me, guys. Yes or no? Yes, 85 lakhs only. Correct or not? Yes. But here, sir, why we are paying 90 lakhs then? Why we are paying that? That 1 lakh is nothing but exchange loss. 1 lakh is nothing but exchange loss to me. Yes or no? So that's why this exchange difference will come, guys. So that exchange difference may be profit or loss, which means gain or a loss. Maybe gain or loss. In this scenario, it is a loss. It may be gain also. Suppose example, if the dollar value becomes 85 to 80, then that 5 lakhs is nothing but a gain to me. Okay. Yes or no? Yes, gain or loss will come. This type. So in this way, the exchange loss or gain will comes into picture. So in this scenario, some portion of amount should be treated as per Ind AS 23. Some portion of amount should be treated as per Ind AS 21. This is the point of saying. See here. See here. First condition. You should. I mean, you will get the exchange loss first. In first scenario, you are getting the exchange loss. So what is the treatment? See guys. So the extent of difference between interest of Indian currency as well as a foreign currency, okay, also should be capitalized as per Ind AS 23. Sir, what is this? I am not understanding. Yeah, I will take a best example for this. Okay, see guys, why this concept comes into picture here. Simple. Basically, whatever the loan you are taking, if you use that loan for the purpose of capitalizing asset, then the interest should be capitalized as per Ind AS 23. Suppose example, if you take a loan from foreign bank, foreign country, okay, so basically the interest rates is very less in foreign countries, very high in Indian countries, correct? Sorry, in India. Sorry, that's why the foreign investors will invest in India only because they're getting a lot of interest. Okay, so that's why, guys. So the interest rate is very less in foreign countries. That's why I have taken a loan from a foreign bank only. Okay, in that scenario, I need to capitalize the less amount of interest, correct or not? Yeah. So, but as per this concept, clearly saying, take the example. Yeah. See, guys, suppose example, I borrow a loan of $1,000, rate of 4% from US. Okay. So on the rate of loan, the dollar value is 40 rupees. Okay. On the date of taking the loan, the dollar value is 40 rupees. Okay. At the year ending, the dollar value equal to 50 rupees. Okay. Suppose example, if we take a loan from a bank, Indian bank, so the interest rate is 12%. That's why I have taken loan from foreign bank. Clear? See, okay. Clear or not? Okay. Why this scenario, guys? Basically, the interest rate is less. Okay, the interest portion is very less only. So which means less amount should be capitalized here. Correct or not? They want to capitalize the less amount of interest. In that, for that purpose, they have taken loan from foreign bank. But as per Ind AS 23, yes, 23, they're not leaving this situation. See, guys, suppose example, what they are saying, interest on loan from foreign bank, which means in foreign currency, how much interest you need to pay basically. So basically, interest should be paid at the end of the year only. Okay, at the end of the year, you need to pay the interest. So on that date, you need to consider the dollar value, correct or not? On that day, the dollar value is 50 rupees. So how much amount of loan you have taken? $1,000. So $1,000 into, okay, how much interest? 4% interest you need to pay. So 1,000 into 4%, how much? 1,000 into 4%, which means 4, 4 rupees, nothing but $4. Correct? Basically $4. Okay, but on the date, the dollar value is 50 rupees. $4 into 50, how much? Means, sorry, 40 into 50, not 4, 40. 1,000 into 4% means $40. 40 into 50, how much? Per dollar, 50 rupees, right? So 2,000 amount should be the interest on foreign currency. In foreign currency, the interest on loan is 2,000. Correct or not? So 1,000 into 50 into 4%. If you take a loan from Indian bank, there is no dollar values on that day. Rupee value is rupee only. So I have taken loan from a bank is $1,000, which means 1,000 into on which date I will take the loan. Okay, on first date. So which means the date of the loan. I mean on the date of taking the loan, the dollar value is 40 rupees, which means how much amount required to take that 40,000 loan? 40,000 amount only. So 40,000 is the interest, sorry, loan amount. On that I need to apply the interest rate. How much? 12% rate. So 40,000 into 12%, how much? 4,800. As per Indian currency, the interest amount should be 4,800, but as per foreign currency it is 2,000 only. Correct. So suppose example, if you got an exchange loss here, yes, I got an exchange loss only. How I got exchange loss? Because how much in exchange loss, guys? Can you anyone tell me, please? How much exchange loss? So exchange loss amount is 10 rupees, guys. 10 rupees. So 40 from 40 to 50. So I need to pay extra amount. Correct or not? I need to pay extra amount. How much? $1,000 into 10 rupees. 10 rupees. $1,000 into 10 rupees, which means how much? 10,000 is exchange loss. 10,000 is the exchange loss. So this is the scenario. So you should get exchange loss first case. On that exchange loss, basically exchange loss should be transferred to P&L as per Ind AS 21. But if you got a exchange loss in this scenario, see the point, guys. Important. Difference between the Indian currency and foreign currency. How much amount of interest should be there, that should be capitalized out of that exchange loss. Yeah, the exchange loss is 10,000. As per India's 23, how much amount should be capitalized, guys? So, as per Indian currency, 4,800. Foreign currency, 2,000. See, one more point. The interest on foreign currency, 2,000 should be capitalized. It should be capitalized as per India's 23. So basically, you need to capitalize 4,800, but you are capitalizing 2,000 only. That's why they have introduced this concept. If you got an exchange loss, out of that exchange loss, difference between Indian currency and foreign currency should be capitalized. How much? 2,800. So which means already 2,000 capitalized as per Index 23 plus this amount 2,800 also we are capitalizing, which means total 4,800 is capitalizing. Yes or no? Yes. This is the concept they want to convey, which means the total amount of interest. If you take a loan from Indian bank, how much amount you are going to capitalize, that amount should be capitalized. Okay. In this scenario, the exchange loss amount is more than that. So there is no issue here. Correct or not? Yes, the exchange loss is 10,000. As per Index 23. So difference between Indian currency and foreign currency, how much? 2,800. This should be capitalized. So they will ask one question: how much total amount should be capitalized as per Index 23 in this scenario? How much? 2,000 already capitalized, which means foreign currency loan, how much interest amount? 2,000 plus extra 2,800. How much total? 4,800 should be the capitalized amount. Total capitalized amount, how much? 4,800. This is the concept, guys. Please be very clear in this scenario. So you will get confused. So we are capitalizing here 2,800. We are focusing on here only. We will ignore this point. This 2,000 we are ignoring basically. So gone. MCQ 2 marks gone. The total amount should be capitalized how much? 4,800, not 2,000. Sir, in all scenarios, the total amount should be 4,800 as per index, which means it is similar to Indian currency interest only. No, no, because suppose example here the exchange loss is assume that it is 2,000. Assume that it is 2,000 only. Then what we need to do here? Here, then even if you got 2,800, you need to capitalize only 2,000 only, not 2,800. Because we don't have money. First of all, we don't have that much loss. Right? We need to capitalize up to the 2,000 only. Of 2,000. Okay, here the value of exchange loss is 10,000. That's why we can capitalize the 2,800. So then what is the balance amount treatment? Out of 10,000, 2,800 we are capitalizing, which means the balance amount how much? How much? 7,200. That should be charged to P&L as per Index 20, the concept. The scenario for exchange loss. If you got exchange gain, what is the treatment? Guys, for example, if you got an exchange gain initially, if you got any exchange gain initially, please don't consider it as per Index 23. Ignore that. Treat it as per Index 21 only. But subsequent to exchange loss, which means initially in first year I got exchange loss, in second year I got exchange gain, then we have a special treatment. For example, in last year I got 30,000 exchange loss. How much? 30,000 exchange loss. Assume that. This is the basic example. Okay, in current year, I got 10,000 exchange gain. Okay, 10,000 exchange gain. Clear? Everyone clear or not? Yeah. See here, suppose example. Like, see example 2. You will get a full clarity here. Don't want to discuss, but in CQ purpose, I am to discuss this point also. See, continue with the first example. First running, what is the dollar value? Secondly, running the dollar value is 48 because previously we got exchange loss of 10,000. Correct? Out of the 2,800 is capitalized. The balance 7,200 transferred to P&L as per Index 21. Clear? That is clear. So now coming to second scenario in the same example. Now the dollar value will get decreased, which means we are getting exchange gain in this scenario. Exchange gain. How much? 1000 into 2. 2000. Correct? Now the exchange gain is 2000. Then what I need to do? What's the treatment, guys? Anyone? Can you please try? Just a minute. Okay. Hello. Sorry. Voice issue. Oh. Yeah. See, guess now I got exchange gain of rupees 2000. But already I got a. I mean, I already adjusted 2800. I already capitalized. Actually, previously I got exchange loss 30. Sorry, not 30. Sorry, 10,000 is the exchange loss. Out of that, how much I have capitalized? 2,800 I have capitalized. So 2,800 already capitalized. Now I got 2,000 exchange gain. Out of loss only I have capitalized, correct? Now I got exchange gain. So what is the treatment, guys? Anyone? You can adjust this exchange gain to the extent of exchange loss. How much you have capitalized previously? How much you have capitalized from exchange loss? From exchange loss, I have capitalized only 2,800. Please, students, please don't confuse. We have not capitalized 4,800 completely from exchange loss. From exchange loss, we have capitalized only 2,800 only. So for that amount only, we need to adjust right now. So 2,800 already capitalized. Now I got 2,000 as a exchange gain. Then the difference, which means 2,800 minus 2,000, which means the it should be decreased from the asset value. Exchange gain, which what is the meaning of exchange gain here? We are adjusting to asset value because 2,800 capitalized means added to asset value. So you need to adjust to that capitalized amount, which means you need to deduct from the asset value. How much? 2,000. So how much maximum amount I can deduct from this capitalized amount? The maximum amount I can reverse. How much, guys? 2,800. Even if I got 3,000 exchange gain, I should deduct only 2,800 only because I have capitalized 2,800 only. That's it. The balance 800 will continue. Means it is included in asset value. For the example, the asset value is 10 lakhs. We have capitalized 2,800 already. So the total asset value is 10 lakh 2,800. Now I need to deduct the 2,000. How much? 10 lakh 800. This is the asset value. Clear. Everyone have full clear about this topic. So I have discussed almost 1 hour time because I don't want to discuss, but I have discussed it. Please don't worry, guys. Okay. Thank you. So we'll discuss. I mean, we'll go to the next topic. Ind AS 10. Okay. Click on like. Please click on like, guys. I think everyone like this video. That's it. Okay. And also subscribe the channel. Okay, guys. Yeah. So in this problem, I already discussed, but I haven't shown you. So this is the total capitalized 74,180. Okay. 5 lakh 2,500 into capitalization rate, 1 lakh in 10%, 10,000. Total 74,189. I think I forgot a point. Okay. Clear? So specific borrowings, separate interest, non-specific borrowings, separate capitalization rate I have applied. 74,189. Total amount to be capital is equal to 74,180. Is it clear, everyone? Everyone have a full clarity about this? Okay. Go to next topic. Yeah, okay, guys. So coming to next standard in is 102 share based payments. Clear? Everyone. Yeah. So first of all, what do you mean by share based payment, guys? Simple, guys. It's a transaction in which the entity receives goods or services. Okay, I am the entity. I am receiving goods or services. In instead of that, for that purpose, I need to pay some consideration, right? So instead of paying cash, I'm issuing a equity instruments, nothing but equity shares I'm issuing to them. Okay. So can I say it's a share based repayment transaction? Yes, that is covered under the definition. And also I need to pay cash only, but the cash is paying based on the share price. Based on the share price only I'm paying the cash. Yes, that is also comes under share based repayment transaction only. Yeah, guys, I think in our childhood you have listened about heard about this topic, ESOP. ESOP means employee stock option plan. So basically, uh, entity will give an options to the employees. Okay, option means it's right, not an obligation. Correct? Yeah. So they will access the, I mean, that options whatever the company had provided. Correct or not? Yeah. I think. Yeah. I want to discuss one more point. Share based payments includes ESOP, but share based payment completely equal to not equal to ESOP, which means share based payments is a wider word. ESOP is a I mean, it's a part of it. It's a part of it. It includes ESOP. Share-based payments includes ESOP. That's it. Okay, clear. It includes a lot of things, but one of them is ESOP. Okay, because why I'm saying this point, that is already you have already learned in your CA inter level, correct? I think semi inter it is not there, but at least you should know about the basic thing. Still, I will give a basic clarity about the ESOP first of all before going to topic. Yeah. See guys, simple topic. I will discuss in 5 to 10 minutes only. Just pay attention. Very important here. Yeah. Coming to ESOP, employee stock option plan. Basically, company will company will grant some options to employees. So, for example, on 1/4/2024, company granted some options to employees. Okay, they will give an option, nothing but they are giving an option to employees. Okay, granted means giving an offer. Simply, yeah, they are giving an offer. Company giving an offer. You need to think company point of view only, not employees point of view. Okay, so company you are giving some offer to employees. Okay, on which date? 1/4/2024. Suppose example, the condition you have kept for the employees is you need to stay for the 3 years in the organization. So which means employees should be remain in the organization, should remain in the organization for a period of 3 years. Then only they can exercise that option. Okay, so otherwise they cannot exercise. Clear. So for example, it was March 25, 26, 27. Correct? Clear. 3 years. If they worked for in organization for a period of these 3 years, then only they will get an option to exercise the options. Which options? Employee stock options. Clear. So employee will get an option after the end of the third year only. Clear or not? Yes. So basically, when the options giving to employees, the company will give at a discounted price only. Basically, if the market price is 100, the company will provide to employees at 70 rupees only. Assume that. So the difference 30 rupees is the loss to the entity. Correct or not? Yes, that 30 rupees is loss. So we can say here this loss is nothing but employee benefit expense. This expense we are incurring for the benefit of employees, for the benefit of employees. That's why they're keeping one account name is nothing but employee benefit expense. So what is the loss to the entity? 30 rupees. So this 30 rupees we can call here as a intrinsic value. Intrinsic value. The market price of the share is 100 rupees. Assume that the market price of the share equal to 100. The 70 rupees is nothing but issue price. Issue price. Okay. So employees can exercise the options at 70 rupees. Nothing but they can purchase at 70 rupees only, which is nothing but issue price. The difference 30 rupees is nothing but intrinsic value that is lost to the entity. For that 30 rupees, we need to recognize the expense, employee benefit expense. There or not? This is what we are already we already know about this topic clearly. Correct or not? Yes. So basically, whatever the expense we are going to incur at the end of the third year, so that has to be what we need to do, guys. Has to be apportioned to all these 3 years. All these 3 years, which means, suppose example, initially my expectation the number of employees is 100. Okay, so at the end of the first year, 90 employees may be in the organization, may remain in the organization. 10 employees may left out of the organization in the first year. That is my expectation. In second year, 10 more employees may leave the organization. In third year ending also, 10 more employees also may leave the organization. So, but I don't know how many employees may leave in the third year. But I know just at the end of the first year, I know about so 10 employees already left the organization. Yes, 10 employees already left. So my expectation in future in next 2 years, so 10 more employees may leave from the organization. So total my expectation, how many employees, guys? 10 already left. So my expectation is 10 employees may leave in the next 2 years. So my expectation is 80 employees only remain in the organization. Correct or not? So for the first year, you need to calculate the expenditure. I mean the loss for 80 employees only, because you need to book the expense for how many employees? How many employees? Yes, 80 employees only, because 20 employees. Your expectation is 20 employees will leave the organization. So whoever the employees are leaving the organization, we are not even which means which is not required to book the expense for those 20 employees. Correct or not? So when the company will get lost, when the employees exercise the options, when the employees exercise the options, when they exist in the organization. So my expectation is 20 employees already leaving the organization. Then why should I book the expense for those 20 employees also? Not required. So I need to book the expense for 80 employees only. That is my expectation in the first year. Coming to second year. So already 10 employees left in first year. Second year also 15 employees already left, or 10 employees. Assume the 10 employees only left. So second year ending 10 employees already left. First year already 10 employees left. Second year ending also 10 employees left. Total 20 employees already left. So in third year, my expectation is 5 more employees may leave the organization. So now for how many employees I need to book the expense? 20, sorry, 70 or 75. Sorry, 80 or 75. Anyone? Anyone guys? 75, correct? Yes, because first year 10 already left, so no need to book the expense. Second year ending also 10 employees already left the organization, so no need to book the expense. In third year, which means my expectation in third year, 5 employees may leave the organization. My expectation is 5 employees may leave the organization. Total 25 employees not required to book the expense. So balance 75 employees only you need to book the expense at the end of the second year. Correct or not? Yes. Sir, no. In the similar scenario, at the end of the third year, overall 25 employees already left. Sorry, 20 employees already left. Actually left I mean, actually at the end of the third year, suppose example, 6 employees left out of the organization. 6 employees. Total how many employees? 26 employees left out of the organization. So balance 74 employees only. I need to book the expense. But you already booked the expense for 75. You need to reverse that one employee expense. Correct or not? That's it. See, I will discuss with a small example, then you will get a full clarity. Clear? So, for example, market price equal to 100, Q price equal to 70, intrinsic value equal to 30. This is loss. Number of employees total 100. Number of options, for example, 100 per each employee. Clear? 100 for each employee. So, now calculation of employee benefit expense. How to calculate, guys? The pro forma just you need to follow. So as per my example, 3 years is nothing but vesting period, guys. Whatever the conditions I'm giving to employees, that that period is nothing but vesting period. So vesting period how many years? 3 years. Okay, got to explain here. Next, after the 3 years, employees will get the right to exercise the options, which means I have given 1 year to the employees. This 1 year is nothing but exercise period. Means this 3 years is nothing but vesting period. This 1 year I have given the employees. I have given the time to employees to exercise the options. This 1 year is nothing but exercise period. Clear? Okay. So coming to employee benefit expense particulars, year one, year two, year three. Okay, number of employees. How much? 100, 100, 100. Options 100, 100, 100. Okay, clear or not? First I'm discussing the basic example. Assume that 100 employees will be remain in the organization for 3 years. Next, intrinsic value, which means loss. How much? 30 rupees. Atta. Vesting period how many years? 3 years. 3 years. Atta. See, now the total first of all you need to get the total estimated expense. Total estimated employee benefit. How much? 100 employees, 100 options. Each option lost 30 rupees. For how many years? 100 into 100 into 30. How many years? For how many years? 3 years, guys. So I am taking 100 employees, 100 options into loss. How much? 30. Total how much? 10,000 into that. 3 lakhs. Yeah. This 3 lakhs is for 3 years, not for each year. Just total loss is 3 lakhs. Then how can you book the expense 3 lakhs per each year? So you need to book the expense for 1 year only. Because you are in the first year right now. Yeah. So that's why 1 divided by 3. 5 into 1 by, clear or not? Even you can write it as a cost up to date. Total employee benefit expense cost up to date. Up to date means cumulative. First year means how much 1 by 3. Coming to second year, how much? 100 into 100 options into 30 into 2 by 3. Because cumulative of 2 years. That's why I have written it as the cost up to date. How much? Here 1 lakh, here 2 lakh. Here again 100 into 100 into 100 employees into 100 options into 30 into 3 by 3. 3 years total 3 lakh. So at the end of the 3 years, total expense you have booked is 3 lakhs. But how much expense you need to book for each year? So expense during the year, during the current year, how much? First year 1 lakh only. Second year, this is cumulative expense. So 1 lakh already booked in first year. So how much expense you need to book in second year? 1 lakh. 2 lakhs minus 1 lakh. Correct? 2 lakhs is the total expense, guys. Minus 1 lakh already booked in first year. So balance how much? 1 lakh should be booked in the second year. Coming to third year, how much? The total expense is 3 lakhs. But I already booked in first year 1 lakh, second year 1 lakh. So balance how much? 1 lakh. That 1 lakh should be booked in the third year. 3 lakhs minus 2 lakhs. This is the way of calculation. So in this example, I have taken 100 employees in all the scenarios. It may be 90, 70, 60, whatever. Based on the number of employees, you need to calculate the total estimated expense as well as expenses during the year. Everyone, everyone must have a full clarity about this topic. Otherwise, we cannot go forward. That's it. Everyone clear about this? So why this 1 by 3, why this 2 by 3, why this 3 by 3 means a cumulative expense. First year, that's why 1 by 3. Second year means 2 years. 2 by 3 means 2 years expense. 2 years expense is 2 lakhs. What is the expense for second year? 1 lakh is already booked from this 2 lakhs. So balance 1 lakh should be booked in the second year. 3 by 3 means cumulative of 3 years expense. 3 years expense is 3 lakhs. But first year already 1 lakh booked. Second year already 1 lakh booked. So balance how much? 1 lakh should be booked in the third year. The basic example, guys. If you have a proper clarity about this, then easily you can material because missing notes is needed. Time to give the normal. We'll discuss. Okay, guys. So everyone already know about the share based repayment, right? So see, guys, these are the definitions. I think get the point. Intrinsic value means market price minus exercise price. Correct? 100 minus 70, how much? 30. That is called intrinsic value. Please remember the point. It is excess of the market price of the share under ESOS under over the exercise price of the option, including upfront payment if any. Including upfront payment is if there is any upfront payment that is also included in that. Okay. See, Ind AS 102 permits the use of fair value only while accounting share-based payments. Ind AS 102 permits only fair value, guys. You need to consider the fair value only. In all the scenarios, there is no market price, there is no uh, like exercise price, there is no different price they are not giving, they are giving just a fair value. So you need to consider at a fair value only. You need to book the expense at a fair. The intrinsic value is only relevant at the time of settlement of cash settle plans before lapsing. The intrinsic value will be relevant only in which scenario, guys? Cash settle plans before lapsing. Cash settle plans before lapsing. We'll see the point later. Have a problem. No worries. Clear? We have three different types of a plans, guys. What are the plans? Equity settled, cash settled, share based payment with cash alternative. Means equity with cash alternative, share based payment transaction. Have three different types of payments, guys. One is equity settle, second one is cash settle, third one is equity with cash alternative. Cash alternative means we have cash option as well as equity optional. So coming to equity settle, see, guys, awards given to employees or non-employees. If it is given to employees, so just directly measure at fair value of equity granted. So they will give directly in the question the fair value. You need to consider the fair value only. In case of employees, previously I have discussed about ESOP discussion, but it is not about the ESOP. Okay, if you purchase any goods or services or asset from the employees or non-employees, whatever, you need to pay the consideration. Instead of that, you are giving a shares. Okay, so at which value you need to measure that? So at fair value of equity granted in case of employees, but in case of non-employees, we measure at fair value of goods received only, unless not available. So you need to consider the fair value of goods received, goods or services received. If not available, if it is not available, then take the fair value of equity instrument. That's it. In case of a non-employees, in case of a non-employees, please remember. Clear? Everyone. So coming to entries, guys. In case of a first employee benefit expense, what is the entry? Employee benefit expense account debit to. So see the point, vesting period. During the vesting period, we need to same point, guys. Same vesting period means same only here also. They will put some condition. Company will give some conditions. You need to satisfy that. That's it. That is the vesting period. Okay. So basically, employee benefit expense will be transferred to, initially it will be transferred to share based payment reserve account, guys. Which account? Reserve account in case of equity settled. Because it is an equity, right? That's why it will be transferred to share based payment reserve account, SBPR account. Expense is a nominal account, so that should be transferred to P&L. So P&L to employee benefit expense. This is during vesting period, guys. Vesting period, which means 3 years in our example. Then after exercise, what is the entries, guys? After exercise means employees will purchase that. So we are getting the money, correct or not? We will get some money. Yeah. So that's why during exercise period, what is the entry, guys? Bank account debit, share based payment, reserve account. Basically, up to the 3 years, whatever the amount we have booked in our books as an expense, which means loss, which is transferred to share based payment reserve account, which means credit account. So that we need to be reverse in this scenario. So bank account debit, share based payment reserve account debit too, because we need to issue the equity. We need to issue the equity, correct or not? Yeah. So that's why. So bank account debit, share based payment reserve account debit to equity share, capital to securities premium. That's it. By security premium, if it is if it is more than the face value, then the difference is nothing but what is that? Security premium account. Everyone have a clear clarity about this? Tell me, guys. Everyone. So see, please don't forget this bank account debit. This is excess date entry, guys. Bank account debit, share based payment reserve account. Why I am debiting this share based payment reserve account? Because reserve account should get closed. So for that I need to issue the shares. Correct or not? Because I need to issue the shares for that. Because it is equity settled. Equity settled means I need to issue the shares. That way too, equity share capital to securities premium. That okay. If lapse, then share based payment reserve account should be transferred to P&L account. Share based payment shown under other equity. So please remember this point, guys. If lapse means employees don't want to take that options, means they don't want that. In that scenario, then lapse, then share based payment reserve account should be transferred to P&L, which means they are not exercising. If they're exercising, then they will pay some money. If they're not exercising, then you need to transfer the reserve account to P&L account directly. Basically, share based payment reserve account shown under other equity head. In balance sheet, we have other equity head is there. Under that only will disclose the share based payment. So fair value on the date of a grant should be taken for the above calculation. No revaluation. So there is no revaluation in case of equity settle, guys. You need to take the fair value on grant date only. Fair value on grant date only. Please remember this point in case of equity settled. This revaluation concept will comes in cash settled, not in equity settled. Please remember that point. Okay. Immediately I will discuss one else. The coming to problem number, KBS Limited granted to its employee share options with a fair value 5 lakhs. Total how much value? 5 lakhs on 1st April 2020. Okay. If it remain the organization up to 31st March 2020, which means 3 years. To whom? Employees. What is the fair value? 5 lakhs. So you need to consider it fair value, 5 lakhs only. Yeah. So ABC expected 91% employees to remain in the employment at the end of the first year, 2021 ending. So in first year ending, my expectation is 91% employees stay in the organization. Second year ending, 89 employees. Third year ending, 82 employees. Okay. All of them exercise their options on 31st March 2023, which means at the end of the third year, everyone has exercised. No one lapsed. Nothing lapsed. Correct? Yeah. In this scenario, what are the entries? Anyone? First of all, you need to find out what is the employee benefit expense. How to calculate that? First of all, what is the total benefit expense, guys? 5 lakhs already given in the question. Very good. So how many years? Yeah, vesting period is 3 years. Correct? 3-1. So how much percentage of employees best, I mean, remain in the organization? In first year, 91%, second year, 89, third year, 82. So which means in first year ending, I need to book the expense for 91 employees on 91% employees only, not for not 100% employees. In second year ending, I need to book expense for 89 employees, 89% employees only. In third year ending, 82% of employees only, I need to book the expense. Correct or not? Yes or no? Yeah. In the same scenario, 5 lakhs into 91%, how much? 1 lakh 51,000. Sorry. 5 lakhs into 91% into 1 by 3. For 1 year, right? 1 into 1 by 3, how much? 1 lakh 51,000. See? Yeah. 5 lakhs into 9 by 1% into 1 by 3. This is cost up to date, guys. Coming to second year, 5 lakhs into 89%. Second year ending, my expectation is 89% only will remain in the organization. So into 89% into 2 by 3 means for 2 years. The expense what we are getting here is for 2 years. Coming to third year, 5 lakhs into 8 divided, sorry, 82% into 3 by 3. 82% means my expectation is only 82% remain in the organization. So that's why I need to book expense for 82% only. Correct? So that's why 5 lakhs into 82% into 3 by 3. Please don't confuse here. What are the values you got here? 1 lakh 51,667, 2 lakh 96,667, 4 lakh 10,000. These are the cumulative expense, which means cost up to date. Nothing but expense up to date. So can you please tell me expense during the year, which means current year expense? First year expense will not change. Same 151,667. Tell me anyone second year expense. How to calculate second year expense? 2 years expense minus first year expense already booked. 2 years expense how much? 296,667 minus 151,667. How much? How much, guys? Even for expense up to, first of all, you should get the value right. 5 lakhs into 89% into 2 by 3. Correct? 5 lakhs into 89% into 2 by 3. You will get 296,667. That is 2 years expense. That is okay. So I want second year expense. How to calculate that? So please deduct from this 2 years expense minus first year expense. 1 lakh 45,000. In third year, how much? Third year. Total 3 years expense should be 4 lakh 10,000 based on 82% employees. 4 lakh 10,000 should be the total expense should be booked. Correct or not? Yes. Out of this 4 lakh 10,000, how much amount you already booked? How much amount you already booked means, see, in first year I already booked 151,667. In second year I already booked 1 lakh 45,000. So balance amount only should be booked in the third year. Recognized in the third year, correct or not? So total 4 lakh 10,000 minus 1 lakh 51,667 minus 1 lakh 45,000. Then the difference is 1 lakh 13,333. Third year expense be booked, recognized in the books of accounts. Booked means recognizing in the books of accounts. Don't get confused. So the same entries, guys. This is the first year expense, this is the second year expense, this is the third year expense. So employee benefit expense to share based payment reserve, employee benefit expense to share based payment reserve, employee benefit expense to share based payment reserve. Same amount. One, two. So in last year, so nothing we are getting right. Correct or not? Yeah. How much amount already there in the share based payment reserve account? Total amount. Total amount in the share based payment reserve account, how much? So total all this you will get 4 lakh 10,000 only. For that purpose, you need to issue the share capital. Nothing but issue of shares. Then entry share based payment reserve account debit to share capital account. How much? 4 lakh 10,000. Assume that the face value is 10 rupees. Here there is no specification about the face value and the market value, right? So that's why treat it as a total equity share capital 4 lakh 10,000. Share based payment is balance includes how much balance in the share based payment here? 1 lakh 5 double 1 lakh 51,667, 1 lakh 45, 1 lakh 33,330. Total this total amount 4 lakh 10,000. Yeah, sir, no. So for that purpose, you need to issue the shares. Put share. That very simple topic. Everyone, you have a full clarity about this. Coming to second topic. Okay, hi guys. So we are done with the first method, which is equity settle. Now coming to second method, guys. So I think everyone is clear about the first method, right? So coming to second method, cash settle share based payment, which means the payment should be in the form of cash only, but it should be based on the price of the share. Okay, price of the share. Clear. So based on the share price only, we are paying the cash. Okay. So in this scenario, what happened, guys? So we already received goods or services. Okay. For that, we need to pay cash. Okay. Based on the share price, we are paying based on the share price. So yes, we can say it is a share based payment. So students don't think like that, don't think like this, which means if you are paying cash, so where is the shares here? So it is not a share based payment. So please don't think like that, guys. We are paying the cash only, but based on the share price. That's why it's a share based payment. Clear? I think everyone have a clear about this. Ready? Yeah. So in this scenario, until the liability is settled, basically cash is a financial liability, guys. First point, cash is a financial liability. So obligation to deliver the cash is a financial liability, correct? As per Ind AS 32. So we have an obligation which is nothing but it's a liability, correct? So we need to recognize at a fair value only. So fair value of the liability. But in this scenario, until the liability is settled, we need to remeasure the fair value until the date of settlement. See here, until the liability is settled, and remeasure the fair value of the liability at the end of each reporting period and at the date of settlement with any changes in fair value recognized in profit and loss account. Profit or loss for the period. Clear? Everyone have a clear about this point? See guys, simple. In this cash settled share based repayment, we need to measure at fair value only. Okay. So that fair value should be remeasured at the end of the every reporting period. Okay, until the date of settlement. Simple. Okay. So simple guys. So in this case, if no vesting period, entity should recognize on grant date fair value. So which means see guys, vesting period may or may not be there, guys, sometimes. So vesting period means the employees need to satisfy the conditions, correct or not? So for fulfilling the conditions, their company will give some time period. That is nothing but vesting period. Okay, after completion of vesting period, company will give some time to exercise that particular options, whatever rights or something. Basically, that is nothing but exercise period because they want to exercise in that period only. So they should exercise in that during that period only. After that, they cannot exercise. It should lapse. Clear. So if in the given question, if there is no vesting period, actually we have one question, guys. If there is no vesting period, what is the meaning of vesting period, guys? For fulfilling the conditions, for fulfilling the conditions, which means for future services. Okay. Suppose example, today you have joined, you need to work for 3 years, then I will give the uh, something shares, something options or shares, whatever. Okay, this is the condition I have kept. You need to work for 3 years. Okay, so this is for future services we are going to give, but sometimes past services also we can give this shares or options or share appreciation rights, whatever. Means already they have worked. So till you have, I mean, you have worked from last 1 or 2 years. That's why I'm giving these shares. Yeah, you can access within this 1 year or 2 years. Yes, it is possible. Like that also, the question will come. It is possible scenario, correct or not? Yeah. So that's why in this scenario, if there is no vesting period, if there is no vesting period, which means they will vest immediately. So from that date, you can access anytime, like 1 year, 2 years, 3 years. Yes, it's depends upon the question. I mean, depends upon the company policy basically. Okay, we are discussing complete examination point of view. That's why. Okay. So if there is a vesting period, as usual, whatever we have done in equity method, same here also. But we need to remeasure at fair value at the end of each reporting period. That is the most important point in cash settle. Basically, in case of a cash settle share based payment, company will issue the share appreciation rights. Share appreciation rights. So company will give the rights to the employees basically. Okay, so every year employee benefit expense will be transferred. In case of equity settle, every year employee benefit expense will be transferred to share based payment reserve account. But in this scenario, share based payment liability account. Liability means why liability? Because we are paying the cash only, correct? So it's a liability only. Obligation to deliver the cash. It's nothing but financial liability. So that's why I should transfer that money to share based payment liability account. Ultimately, share capital will be issued to employees or non-employees to the extent of face value. If any extra, that should be transferred to securities premium. That's the basic point everyone knows about it. Obligation to pay cash is a financial liability. Until the liability settled, the entity shall remeasure the fair value of the liability at the end of each reporting period, and then the date of settlement with any changes in fair value recognized in P&L. Same point I already discussed. Correct? So basically, this remeasurement concept comes from Ind AS 32 only. In case of a financial liability, so we need to remeasure in that scenario also. There also we need to remeasure the fair value at the end of each reporting period. Same case applied here also because it is also financial liability. We need to settle the cash only. That's why everyone have a clear clarity. So when we solve the problem, you will get a full clarity, guys. Okay, just wait. I think we are done with the first method, right? Coming to second, cash settled share based payment. Correct? Cash settled share based payment. In this first point, you need to remember basically in this scenario, company will give share appreciation rate. So directly, the question will not say about the cash payment, cash settlement, etc. So they will say directly, company is giving a share appreciation rights. Share appreciation rights, which means it is nothing but cash settled. Assume that it is a cash settled only because they will pay in cash only based on the share price. Because share appreciation, right? So that's why they will pay cash only. So it is also cash based, cash settled share based payment. That's it. If you see the word in the question, yes, it is nothing but cash settled. Clear? So in case of a cash settle, we need to remeasure the fair value. Remeasure at a fair value at the end of each reporting period. Clear? Correct? So every year liability. So employee benefit expense will be transferred to share based payment liability account. Correct? Not reserve account. In case of equity settle, we need to transfer to share based payment reserve account. But in this scenario, we need to transfer to share based payment liability account. Clear? Equity settle, in case of equity settle, share based payment reserve account. In this scenario, share based payment liability account. Clear? So I will show the entries also, guys. Don't worry. I have to give in my question in marathon material also, but unexpectedly that will show here only. My material is is the second method, guys. So journal entries. Coming to journal entries, basically employee benefit expense will be transferred to share based payment liability account. So employee benefit expense to share based payment liability account. So employee benefit expense is a nominal account that should be transferred to P&L account. That's for P&L employee benefit expense. During the excess period, what is the entry? Share based payment reserve account debit to, what is that, guys? So not reserve, guys. Share based payment liability. Sorry, share based payment liability account debit to bank. So we need to settle, right? Share based payment liability to cash or bank. If lapsed, then SBPL account should be transferred to P&L. If lapsed means if the employees are not going to exercise, then it should be transferred to P&L. So fair value end of each balance sheet should be taken. Share based payment liability shown under current or non-current liability. So everyone knows about the condition, right? So from the reporting period, we need to consider 12 months basically. That is nothing but current. More than that, non-current liability. Correct or not? Yeah. So even after the vesting period, if there are changes in the fair value, they need to account for the unexpired options The difference in fair value would be shown as employee benefit expense. So with the special point, guys, even after the vesting period, if there are changes in the fair value, yes, if they need to account for unexpired options. What do you mean by unexpired options? What do you mean by unexpired options? The difference in fair value would be shown as employee benefit expense. First of all, what do you mean by unexpired options? Unexpired options means which is not get lapsed. Okay, still it is going on, which means employees, suppose example 10 employees, still, I mean, suppose example the condition is employee should stay in the organization for 3 years. Okay, my expectation is 10 employees will be in the organization. Yes, actually 100 employees we have, but 90 employees going to leave. So 10 employees only I'm expecting to stay in the organization. So I need to book the expense for 10 employees only. That is nothing but the options related to those employees is nothing but unexpired options. Clear? Yeah. If there is no vesting period, we already discussed this point. Clear? Let me go to question. Everyone, if you want to take a screenshot, yes, you can take it. Sorry for not incorporating in my marathon book that theory, everyone. Everything clear? Yeah, coming to problem number two. Exchange had issued 10,000 share appreciation rights that vest immediately. Vest immediately. What is the meaning of it? What is the meaning of vest immediately? Which means there is no vesting period. Immediately it was vesting. They are not giving any time. So to its employees on 1st April 2020, the SARs will be settled in cash. They're clearly saying that SARs will be okay, SARs settled in cash. Using an option pricing model at the date of estimate, the fair value of SAR is 95. The fair value of SAR is given in the question is 95. That is okay. Okay. In case of a vesting, in case of there is no vesting period, so you need to consider a fair value of SAR initially. Please remember that on the grant date. Okay. So SCR is estimate exercise at any up to 31st March 2023. So this share appreciation rights can be exercised any time up to 31st March 2023, which means on 1st April 2020 vest immediately, which means see, today only they are offering you without any vesting period. If you want access, yes, you can access the next 3 years. This is 20, right? Sorry, 20. So it is 23, 21, 22, 23. So we have 3 years. 2021, 21, 22, 2023. So they are giving company giving a 3 years of a time to exercise the options. Correct? At the end of the vesting period on 31st March 2021, it is expected that 95% employees will exercise that option. 92 employees at the exercise at the end of the second year. 89 employees at the end of the third year. Fair values at each and reporting period is given as follows. How much? 112, 109, 114. Okay, clear? Here the employees are choosing the cash option only. Cash option, obviously. To say here, because it's a share appreciation rate. So obviously, what is that, guys? Cash settle share based payment. Same scenario, guys. First particulars, year one, year two, year three. These are the exercise periods, not vesting period. Okay. So I have discussed one point in the theory. Even after the vesting period, if the fair value gets changes, okay, we need to consider for the unexpected options or not. Yes. See the point. So how many share appreciation rates? 10,000, 10,000, 10,000, 10,000. So this is on 1/4/2020. On this date only, their employees have a right to vest it. Correct or not? Yeah. So that's why we need to recognize on this date only. If there is no vesting period, you need to recognize at this date only. Don't forget about this point, guys. Don't forget about this. You need to recognize on this date because day one only the liability is getting erased. Correct? Yeah. So fair value of SR is 95. It was changing from 95 to 112, 109, 114. Expect options. Initially, my expectation is 100% employees will stay in the organization. So that's 100%. But at the end of the first year, 95 only. At the end of second year, 92. At the end of third year, 89% only employees will stay in the organization. So I need to calculate the expense. Employee benefit expense equal to how much, guys? 10,000 into 95. 9 lakh 50. Yeah. 10,000 into 95, how much? 9 lakh 50. Yes or no, guys? Yeah. This is the expense initially you need to book in your books of accounts. You need to recognize in your books of accounts how much? 9 lakh 50 on day one. On day one, your liability is 9 lakh 50 only. But coming to first year ending, you need to remeasure the fair value. So I remeasure the fair value at 112, which means how much amount increase, guys? So 10,000 into 112 to 95 percentage. 10,000 into 112 into 95% is how much? 10 lakh 64,000. Basically, initially I have recognized 9 lakh 50 expense already. Again, can I recognize in my books as 10 lakh 64? No, it is a cumulative amount. Correct? Inclusive of this amount. So 9 lakh 50 already recognized. So the balance amount is 1 lakh 14,000. That should be recognized in the first year ending. Clear? Coming to second year ending, my expectation is 92% employees. The fair value is 109. So 10,000 into 109 into 92% is how much? 1 lakh 2,800. But how much I already recognized, guys? I already recognized 10 lakh 64,000. But as of now, the expense here, my estimate expense is 10 lakh 2,800 only, which means I already recognized more than the existing amount. How much more than, guys? 61,200. 10 lakh 64,000 minus 10 lakh 2,800. The difference is 61,200 should be reversed. Why should I reverse, guys? Because I already recognized much amount, more amount than the current amount. My current estimation is 10 lakh 2,800 only, but I already recognized 10 lakh 64,000. Sir, how 10 lakh 64? Sir, 9 lakh 50 already recognized, 1 lakh 40 recognized at the end of the first year. So total 10 lakh 64,000 only. So that has to be, that is more than the current expected amount. So that's why I need to reverse the expense, because it is completely based on expectations only. Correct? Yeah. Coming to third year, 10,000 into 114 into 89%, how much? 10 lakh 14,600. But up to the second year ending, I already recognized 10 lakh 2,800. But as of now, it was increased to 10 lakh 14,600, which means the difference amount should be recognized at the end of the third year as an employee benefit expense. That's it. I think everyone have a clarity about this point. Even I am very quick about this question, but everyone should catch the point. Main point, guys. Simple. Nothing difficult in this scenario, guys. Don't worry. ఫాస్ట్ అయిందా? స్ట్రెస్‌లో వెళ్ళిపోయామా? క్యాచ్ చేసారా లేదా? మ్యారథాన్ కదా! మ్యారథాన్ అంటే ఆ మాత్రం ఉంటదా? యాహ్! ఓకే కార్తీక్. క్లియరా? క్లియరా? సో, I will give one more clarity slowly. Listen the point. I think students feels that the is very quick, very fast. Sorry guys. ఓకే. సరే. చూడమ్మా సింపుల్. బేసికల్లీ ఇన్ కేస్ ఆఫ్ a cash settle, please remember these points. Vesting period is there or not? If there is vesting period, you need to recognize at the end of the first year. At first year fair value, first year ending fair value is there. Second year, third year, same. At the end of the fair values, you need to recognize one by one. Clear? The first year, suppose example, we already recognized 10 lakhs. Second year cumulative amount is 9 lakh only, so 1 lakh should be reversed. Third year cumulative is again 12 lakhs. So I already recognized how much? 9 lakhs only, not 10 lakhs, because I already 1 lakh reduced. So as of now, my booking expense is 9 lakhs only. Now the total expectation is 12 lakhs, which means 3 lakhs additional. So that should be recognized now. That is the expense for the third year. This is the scenario, guys. Correct? Yes or no? Yeah. In case of a non-vesting period, you need to recognize on day one only. Day one. What the day one given in the question? So please take the day one as along with the first year ending, second year ending, third year ending. Mostly they will give 3 years only. So initially you recognize some amount. Here you will get some amount, which means if please check whether the which amount is more than that. If this X amount is more than this amount, then you need to recognize in first year ending extra expense. Correct? Yes or no, guys? This is the basic point. Clear? Don't want to discuss this bloody question. Simple question. Okay. Coming to third point, share based payment transaction with cash alternative. This is called what is it, guys? Third method. So which in this scenario, so employees as well as the company also have a right to choose the option. Basically, if the employees have an option, okay, either they will take a cash option or an equity option. Okay, whatever. So we need to recognize both as well. So that's why the heading name is share based payment transaction with cash alternative, which means it includes equity also. Equity plus cash alternative. Both are included. Then we can say it's a third method, guys. Third method. Clear? So in this scenario, when counterpart has a choice of a settlement, so counterpart in the means employees have a choice of settlement, the instruments will be treated as a compound instrument, guys. Compound instrument means it includes the equity and debt components, and it will be recognized as follows. Clear? Compound instrument means which includes both debt and equity option. Okay, guys. So coming to third one, share-based payment transaction with the cash alternate. Already done with the introduction about this, right? Yeah. In this case, when the counterparty has a choice of settlement, I already discussed about it. The instrument will be treated as an compound instrument. Compound instrument means which includes both debt and equity components. Correct? So then, how to account these equity and debt components? So that's we need to know. So coming to coming to with employees. So majorly they will ask the questions relating to employees only. Okay, I think this question they haven't asked till now, so we can expect this question by this attempt. Expect. So the entity shall measure the fair value of the debt component and then measure the fair value of the equity component. So first of all, we need to measure the fair value of the debt component and then measure the fair value of equity component. Clear? First of all, we need to find out the equity component here. So how to find out everything I will discuss in the solution. So taking into account that the counterparty must forfeit the right to receive cash in order to receive the equity instrument. So in this scenario, we need to consider. So see, guys, here we have two options, which means employee can accept the equity or cash, whatever may be. Okay, so at the end of the, the vesting period, so he will decide. Okay, he will decide after that. See, taking into account the counterparty must forfeit the right to receive cash in order to receive the equity instruments, which means if he wants to receive the equity instruments, he needs to, which means cannot, company does not have any liability to pay the cash. Correct? Yes, but until that date, we need to account in both the things. Both the things. See, the fair value of a compound instrument is the sum of the fair values of the two components. So, fair value of the compound instrument means sum of the fair values of two components. So, if the final settlement is made in equity instrument, the liability will be transferred to equity, directly to equity. Clear? So, at the end of the final settlement, so during the settlement time only, we will get to know about in which way we are going to settle. The employee have an option to that. So, whether it is equity option, it may be cash option also. Okay, if the final settlement is an equity instrument, then the liability will be transferred to equity. So liability means share based repayment liability will be there, right? So cash component, so which means cash component means liability component, guys. Cash component means liability component. Equity means equity only. Okay, if the final settlement in cash, the payment shall be applied to the liability in full, and the equity component previously recognized shall remain in within equity, so that remains in equity only. Okay, whatever the share based payment liability is there, okay, for that we need to pay the cash, share based payment liability to cash. By electing the receive on cash and settlement, the counterparty forfeit the right to receive the equity instruments. If he wants to receive the cash, so then he has to forfeit the equity instruments. If he wants to receive it through equity instrument, then he has to forfeit the cash settlement. Correct? Vice versa. Clear or not? So I think students will understand only when we have solved the problem, guys. Coming to problem number, I will discuss a small example regarding this. See, guys, what will happen here in case of a share-based repayment with cash alternate? In this scenario, we need to treat it as a compound instrument because it includes both debt and equity component. Correct? Yes or no? So in this scenario, basically, the company will offer like this. If the employee wants, so employee, do you want 1500 shares for equity settlement? If you want to cash, I will pay cash equal to 1000 shares only. If you want cash, I will pay only 1000 shares equivalent cash only. This is the condition like this in these scenarios. Okay, so company will offer like this. If you want 1500 shares, yes, you can take it. Otherwise, if you want to cash only, cash settlement, then I will pay the cash equivalent to 1000 shares. Clear? Yes or no? Yeah. So like the conditions will be there. Condition will be there. Clear? See, definitely in this scenario, we are issuing a 1500 shares, but we are issuing the cash for 1000 shares only. We are giving the cash for 1000 shares only. Definitely they're having some difference here. Obviously they're having some difference or not. Yes, that is nothing but a equity component. See how to calculate, sir? I will show you the example also. On January, ABS Limited gives you option to KMP. KMP means employees only. Okay, see the guys. See here. Take either equivalent to 1000 shares or 1500 shares. We have, so company offered like this. If you want to cash, so you can take the cash equal to 1000 shares. If you want the shares, here I will give 1500 shares. So further, the minimum service requirement is 2 years, and the share must be kept for 3 years, which is the locking period. The shares must be held by the employees for 3 years. Okay, and the requirement is 2 years. Minimum he has to serve for 2 years. If these conditions are satisfied, okay, so then we will give either 1500 shares or cash equivalent to 1000 shares. This is the condition. Okay, so why they have given the share alternative fair value with restrictions and grant date fair value on 31st December, fair value on 31st December 2022. The employees exercise the cash option at the end of the 2002 pass the journal entry. So end of the 2022, employee exercise the cash option. Okay, we need to pay cash, not equity. Okay, so pass the journal entries. So in this scenario, we have a, it is like a compound instruct or not. So then first of all you need to find out what is the equity component here, how to find out the equity component for this concept. Complete clarity. Okay, you want to complete clarity about this compound instrument and all everything. So we need to cover this Windows 10 and 32 and 109. So our after we have 115 and 116, I will discuss this topic. Then you will get to know about the concept. I mean, clear clarity about this compound instrument. Have a lot of discussion there. Okay, that's very important for examination point of view. Definitely, will get one question from Ind AS 109 relating to compound instrument. Here, okay. So yeah, I will remember this point there also. Don't worry, guys. Okay. See here. First of all, I need to find out the fair value of equity component. This is the first step, guys. Step number one, you need to find out the equity component. How to find out the equity component means equity component means difference between the equity alternative and cash alternative. That is nothing but equity component. So cash alternative 1,13,000. How do we get this cash alternative, guys? See here, for cash we need to consider the grand date fair value. So grand date fair value is 113. Okay. So how many shares, guys? If you want to pay the cash related to 1000 shares only. Correct? Equivalent to 1000 shares only. 1000 into 113, how much? So 1,13,000 you need to pay cash if for cash alternative. Correct? This is for cash alternative. If you issue the shares, then what is the value? So we need to issue 1500 shares. At which price, guys? Here alternative fair value with restrictions. We have restrictions here. Obviously, we have restrictions or not. We need to hold it for 3 years. Lock in bid also there. So we need to consider the share value. Sorry, share price of a fair value only. We need to consider share alternative fair value with restrictions. What is the restricted price? 102. We have some restrictions here. Yes, we need to consider the share price only. Okay. So how much, guys? 1500 into 102, 1,53,000. So 1,53,000 if you want to issue the shares. If you want to give the shares, you need to issue for the value how much? 1,53,000. If you want to pay the cash, 1,13,000. The balance how much? 40,000. That is called equity component, guys. Because the liability component is 1,13,000. Correct? Liability component is 1,13,000 only. Total value is 1,53. Then the balance is nothing but equity component. Correct? So this 1,53,000 includes cash component, that is 1,13,000. Then the difference is 40,000. That is called equity component, guys. So we need to account this. We need to account this after debt component. What is the debt component here? 1000 shares we need to issue. Correct? So for debt, what is the debt component? Means cash component. You need to account as per share appreciation rate. Second method. How to value? How to calculate that? How to present that, guys? So simply we need to remeasure at every year fair value. Correct? Yeah. So here we have a vesting period of 2 years. We need to serve for 2 years. Employees need to serve for 2 years. So we have a vesting period also. So that's why. So you need to consider the year ending values. How much, guys? Directly first ending value 120. How many shares, guys? 1000 shares. Because it is cash option, not 1500, guys. Not 1500, only 1000 only we need to consider. Why 1000, guys? Because it is a cash. I'm doing treatment for cash component, liability component. So liabilities for 1000 shares only. That's why 1000 into 120 into 1 by 2. How much, guys? 60,000. So for second year, 1000 into 120, sorry, 132 into 2 by 2. Correct? So every year we need to remeasure. So then what is the value? 1000 into 132 into 2 by 2. How much, guys? 1 lakh 32,000. So 1 lakh 32,000. Out of that, we already recognize the 60,000. And the balance, how much? 72,000. We need to recognize that. For cash component, guys, this is for cash component. Very simple, guys. Very simple. Because we have a 2 years of a vesting period. So we need to adjust that, apportion that to 2 years. So 1000 into 120 into 1 by 2, how much? 60,000 here. 1 lakh 32,000 minus 60. Why I am reducing the 60? Because I already recognize the 60,000. So that's why I need to book the expense for 72,000. That's it. This is for cash component. But we already found out the equity component, right? For that also we need to apportion. Correct or not? Yes or no? We need to book the expense for that part also. Yes. So for equity component we have 40. So 40 into 1 by 2, 20,000, 20,000 for each year. 2020. So the total expense booked for each year is 60 plus 20, 80,000, 72 plus 20, 92,000. This is the total expense we need to book in our books of account. Okay. I think everyone have a full clarity about this topic. Clear or not? Clear? Any doubts? Everyone? Any doubts? Clear? Sir, why you are doing like this? What is the requirement? Why you are reducing from this one? Which everything you will get to know in Ind AS 109. Simple, guys. See, this is the cash alternate. Please use your common sense. Cash alternate is 1 lakh 13,000. That is the liability component. So we already have a liability component. The total liabilities, total value is 1 lakh 53. This is your total liability actually. But the difference is nothing but 40,000. Yes. Yes or no? It's a basic thing only. Not a rocket science, right? Here the cash alternate to ultimate settlement. So that's why share based payment liability to bank. First entry, see guys, please don't forget this entry. The employee benefit expense account debit to share based payment reserve account, share based payment liability account. Reserve account how much? 20. Liability account how much? 60. Second year also same. 20, 72. Correct? Now liability account how much balance we have? Liability 60,000, liability 72. The total 1 lakh 32,000. So for that we need to pay cash. That's it. Share based payment liability account debit to cash or bank. Please don't touch that reserve account. It should remain in equity only. Reserve means equity. Clear? Everyone? Everyone have clarity about this? Yes. Yeah. Next, coming to problem number 4, guys. Very important for examination point of view. So, grant a performance condition in which length of the vesting period varies. At the beginning of the year one, executive grants 200 shares to each of 400 employees. Conditional about the employees. So, I want to discuss one point here. Please, year one, year two. Just conceptual knowledge I'm giving, not about the problematic knowledge. Okay, we need to focus on the concept. Suppose example, we need to book the expense. I think I already discussed this. So basically we need to book the expense in our books of accounts, company books of accounts. Okay, so suppose example, we have a total 100 employees initially. How many employees? Total 100 employees initially. So in starting of the year, in our company we have 100 employees. So at the end of the year, okay, I need to book the expense. Okay, so at the end of the year, year one ending, my expectation is, not expectation, really. So out of 100 employees, 20 employees left out of the organization. They already left out of the organization. How many employees remaining? 80 employees. So for in my books of accounts, for how many employees I need to book the expense? 100 employees or 80 employees? 80 employees only, because 20 employees already left out of the organization. I don't have any liability in future, because they will not exercise the options. They will not exercise the shares. They will not take the shares. They will not purchase the shares in future. So I don't have any liability. So I need to book the expense for 80 employees only. Correct or not? Yes. So this is completely based on estimation. Correct or not? So as per prudence concept, expected losses should be recognized immediately, but not profits. Correct? So initially I have 100 employees. Okay. So 100 employees. In first year, 20 employees already left. So in next year, okay, 10 more employees may leave out of the organization. That is my expectation. If I am expecting the number of employees is 10, you need to book the expense for 80 employees or 70 employees. 70 employees only, because I am expecting that. Why you need to book the expense without incurring in future? There is no proof that Correct or not? Because 10 more employees may leave it out of the organization second year. That is my expectation. Why should I book the expense for that employees also? The 10 employees also, why should I incur the expense? Why should I book the expense? That is not required. Correct? So that's why I don't want to book the expense for those 10 employees also, because I am expecting 10 employees also will go out of the organization. To balance how much? For 70 employees only, I need to book the expense for first year ending. Okay. So suppose example, in this example only, in second year 10 more employees will leave out of the organization. In third year also, I'm expecting right now, based on the proof, based on the situation. Okay, I'm expecting 10 more employees leave out of the organization in third year. So then balance how much? 60. Clear? So for 60 employees only, I need to book the expense. Okay. So in examiner, sometimes they will give the question like this: initially 100 employees. So first year 20 employees left, and he will give the question like this: 3 year period, 3 year period. Please find out this. Please remember the word 3 year period. 3 year means total 3 years. 25 employees out of the organization. This is my expectation. Okay, in 3 year period, my expecting is 25 employees leave out of the organization. What is the meaning of it? In first year, already 20 employees left. They have given in the question clearly. Clearly, they have given in the question 20 employees. Another wording they have given in the question 3 year period. During the 3 year period, 25 employees may leave out of the organization. What is the meaning of it? So, the meaning of this sentence is totally 25 employees only will leave out of the organization. That is my expectation. That includes this 20. That includes this 20. Please don't do any mistake. Less. Please don't do like this. 20 minus 25, total 45 minus 55 is the number of employees. Please don't do like this. So here answer should be minus 25 only. For 75 employees, you need to book the expense. Okay, now clear, everyone. So please remember this point also. And one more. So first year 20 employees left. Second year expectation is 10. Total how much book employees we need to book the expense? 70. In second year 20 already left in first year. 100 minus 20. Okay. So actual employees left out of the organization in second year is 8 only. In third year, I'm expecting 10 more employees will leave out of the organization. 10 more employees, sorry, not 12, 12. Assume that 12 more employees will leave out of the organization at the end of the third year. That's my expectation. So for that also, you need to, don't need, sorry, no need to book the expense for those employees also. Balance how much? 100 minus 20, 80, 80 minus 20, for 60 employees only. I need to book the expense at the end of the second year. In third year, really 20 already left in first year, that is actual. 8 already left in second year, that is also actual. In third year, only 5 employees left out of the organization. Expectation may go strong also, correct? So 13 plus 20, 33. So 100 minus 33, how much? 67. So for 67 employees, I need to book the expense. Correct or not? So based on this, you need to do some adjustment. Like expense should be maybe recognized more in second year, sometimes, sometimes less in second year, sometimes more in first year also. So based on that, you need to reversing or recognizing in your books. Depends upon the question. Me discuss the question number 4. Questions we have, guys. Going to discuss 5 questions. This is very important, and next question is very very important. Yeah. At the beginning of the year, one grants 200 shares to each of its employees, conditional upon the employees remaining in the organization company during the vesting period. The shares will vest at the end of the first year. Earnings increased by more than 15% at the end of the year 2. If the earnings increased by more than an average of 12% per year over the 2 year period, at the end of the year 3, the entire earnings increased by more than average of 10% over the 3 year period. The shares have fair value 40 at the start of the year 1. No dividends need to be considered. I'm not understanding this question. So please tell me clearly. Yes. Guys, don't worry. See, please make a small chart for this. 1, 3. Please read the question carefully. The earnings increase by more than 15%. The shares will vest at the end of the year 1. So it is completely depends upon the conditions. Guys. Basically, conditions are of two types. Basically, So types of a condition, we have vesting conditions, in that performance conditions, correct? Vesting conditions and non-vesting condition, we have two types of conditions basically. Okay, so in that performance condition, that market related as well as a non-market related, and second one is service related. So we have service related vesting conditions. Next, performance related vesting conditions also there. This is performance related. This is performance related. Okay, now see, the shares will vest at the end of the year one if the entity's earnings increased by more than 15%. Please remember that word. More than 15% earnings increased, then only shares will vest at the end of the year one. Depends upon the performance. Coming to the second one. At the end of the year two, if the entity's earnings increased by more than an average of 12% per year over the 2 years period, which means second year percentage is not 12%, not should be 12%. It was saying clearly that average of 2 years, you need to calculate the average of first 2 years, and that average should be more than 12%. Because in first year average and the first average is nothing but we have only 1%, right? So there is no average for that. In second year we have two values, so that's why average of 2 years should be more than 12%. Next, if the earnings increase by more than, yeah, at the end of the year three, if the earnings increase by more than average of 10% per over the 3 years period, what is the meaning of it? So average of 3 years, you need to calculate that should be more than 10%. This is the condition, guys, for vesting purpose. Okay, what is the meaning of vesting? First of all, vesting means entitlement, guys. Entitled to exercise that. Okay, clear. Yeah, by the end of the year, when the entire earnings have increased by 13%, so they are giving the actual values. So first year value is 13%, earnings increased by. Next, the entity expects of sorry, 32 employees left out of the organization. In first year, 32 employees left out of the organization. How many employees total we have? 400 employees. Okay, in first year, third year, 400 employees totally. Okay, example I'm writing. This is not the presentation. I will show you the presentation. In first year, 32 employees already left. Thank you so much, guys. And the NT expects a further 30 will leave during the year two. So my expectation is in year two, 30 more employees will leave the organization. So why should I book the expense for those 30 employees? Not required. So balance how much? 30 plus 62. 62 means 400 minus 62. 338. Okay, very good. Actual expected. Next, coming to question. By the end of the year, to the earnings increased by 11%. Only 27 employees left. Only 27 employees left. That is actual. So this is 11% only they are giving in the question. They have given as 11%. Second year earnings increased by 11% only. But number of employees actually left is 27. But in first year my expectation is 30. But in actually the second year employees is only 27 only. So 32 already left in first year. Now 27 employees in second year. This is actual only. So please read the point. Expected in third year also will be there. The NT expects a further 25 employees to leave during the year 3. So NT at the end of the year 2 only they are expecting 25 employees will leave out of the organization. Okay, balance 32, 7, 39, 9, 84, 84. 84 means 31, 6. 400 minus 84. 31, 6. Okay, clear. Next, coming to third year. At the end of the year 3, 22 employees left. The company earnings increased by how much? 9%, resulting in average increase of 10% per year. Yes, correct. We need to check that also. So third year percentage is 9%. How many employees left, guys, in third year? Everyone. 22 employees. So 32 in first year, 27 in second year, 22 in third year. These are the actuals. Please calculate 32 to 27, 59, 9 to 61, 71, 81. Correct? 71. Okay, 81. How much, guys? 81 means 319. Correct? Yeah, 319. So for these employees only we need to book the expense. This is, guys, this is the way of calculation of number of employees. If you do mistake in this, part, then everything will went. See guys, and one more thing. Anyone please tell me if we reached our performance in first year or not? Yes or no? No, because in first year actually is 13%, but it should be more than 15. Okay. In second year we reached or not? In second year, our target is more than 12%, but we reached or not? So we need to calculate the average. So 13 plus 11 divided by 2. How much? 12 only. Correct. But it should be more than 12. Don't confuse. That is more than 12, not 12. So here also not satisfied. Coming to third year, average should be more than 10. So how to calculate that? 13 plus 11 plus 9 divided by 3. How much? 24 plus 9, 33 divided by 3. How much? 10% or 11%. Yeah, this 11% is more than 10 only now. This 11 is more than 10 only now. Yes, we achieved in third year. Our performance achieved in third year. Correct or not, guys? Even clear or not? See, and one more point I want to ask you. Sir, in this we have a vesting period. Clear? Vesting period, we are clearly seeing that vesting period. How many years? In the depends upon the question, it is 3 years only. Okay. So I will ask one question. Suppose example, if you fail in EMA final exam in first attempt, then what is your expectation? Your expectation should be pass in second attempt or third attempt. Everyone will think they want to complete in second attempt only. Correct? Yes. Performance also same. Performance also same. If you are not able to give your performance in first year, so your expectation is you will be able to give in second year. That is your expectation. Yes, obviously. No one wants to write the third attempt directly, right? Without giving second attempt. Definitely, we must have a hope. Correct or not? Yeah. So that's why in first year, basically, if you see the question, the vesting period should be 3 years, right? The vesting period should be 3 years. But coming to this performance scenario, vesting period is not 3 years, guys. First year, my expectation, I already, I mean, my performance is not good. My performance percentage is 15%, but I achieved 13%. I'm not achieved my performance in first year, earnings in first year. But my expectation is I may earn in second year. That's why for first year, the vesting period should be 2 years. Basically, we will write like this 1 by 3, 2 by 3, 3 by 3. Correct? So don't do like that. Don't do that mistake in this, you guys. So I have not achieved in first year, which means I may achieve in second year. That's my expectation. If I am not achieved in second year, and then my expectation should be in third attempt, third year. Correct? Yeah. That's why in first year the vesting period is 2 years only. In second year, you have not achieved in second year, which means you may achieve in third year. So for second year, the vesting period should be 3 years. Sir, what about the third year? 4 years. 4 years. Sir, if you not achieve your performance, then the vesting period should be 4 years only. But you achieved the performance. You achieved the earnings. What is the earnings percentage here? 10%, but you got 11% average of 3 years. So you got achieved. You passed. You qualified in CMA. Then why should you write exam in next attempt? Not required. If you fail in the third attempt, then you will go and write the fourth attempt. Correct? But you already qualified in third attempt. Then why should I write? Correct? Sir, no, yes, this is the logic here, guys. So many students don't know about very simple part only. Yeah, now I want to book the expense. The number of shares equal to 200, 200, 200. Yeah, sorry. Yeah, number of employees is 200. Sorry, 400. Number of shares is 200. Employees left to 32. So I already discussed how much 338, 316, 319. I already calculated, right? So we need to book the expense for those employees only. So 200 into 400 into how much employees? How many employees? 338 into fair value. Fair value is already given in the question. How much? 40 into 40 into 1 by 2. Because in first year I have not achieved my performance, my earnings. So I may achieve in second year. So that's why 1 by 2. Because in first year, you can write one more line here. Testing period equal to here, here. So please write one more line, add one more line, vesting period equal to 233, not 333, 233. Okay. So if you not achieve in third year, then it should be 4. If you not achieve in fourth year, and it should be 5. Correct? Yes. So 330 to 200 into 40 into 1 by 2. How much? 13 lakh 52,000. That is the first year expense. That should not be changed. Yes. Coming to second year, 316 into 200 into 40 into 2 by 3. Correct? 40 into 2 by 3. 2 by 3 by 2 by 3, guys. So this is the cumulative expense for 2 years. Cumulative expense for 2 years. So this is the total expense for 2 years. Out of this, I already recognized 13 lakh 52,000 in first year. So then balance should be recognized in second year. Correct? How much? 3 lakh 33,000, 333. Coming to third year, 39 employees into 200 into 40 into 3 by 3, which means a cumulative of 3 years expense. The 3 years expense is 25 lakh 20,000. But I already recognized how much? 16 lakh 85,000, 333. Total expense, how much I already recognized? 16 lakh 85, 333 or not? Yes. Want to add this? You will get this answer only, right? Guys, correct? So then balance how much? 25 lakh 20,000 minus 16 lakh 85,000, 333. Then balance 8 lakh 66,000, 667. That is the expense for the third year. Okay, expense for first year, second year, third year. Clear, everyone. I think everyone have a proper clarity about this. Proper clarity should be there also. Obviously, I have given a complete conceptual clarity here. Correct. Thank you so much, guys. Coming to last and final problem. This is very, very important for examination point of view. Students will do definitely mistake in this question. So please be careful about this question, guys. Before that, please tell me P equal to what is the formula? MPS by EPS, correct? P equal to MPS by EPS. So MPS equal to P into EPS, correct? P into EPS. Here or not? MPS equal to MPS equal to P into EPS. Okay. Next, EPS equal to MPS by PE. Yes, it's possible. So you should know about this thing. Clear? Yeah. Hi guys, yeah, coming to problem number 5. So this question is very important, guys. So if the examiner will ask the question from Ind AS 102, so majorly they will he will ask the question from this type of a question only. I mean, he will ask this question only. This type of a question, not this question. Okay. So before going to this question, we need to think about one thing. Yes, yes, yes. What is that? Sometimes students will get confused about the fair value of option as well as the fair value of a share. Okay, sometimes entity basically entity, I mean, company will issue the offer the options to employees, but sometimes in question they will give the fair value of option, sometimes they will give the fair value of a share. Okay, so please don't forget about this, guys. Sometimes students will get confused in these scenarios. Okay, coming to fair value of option, you can take the fair value of option as it is. Okay, as it is you can take the fair value of option. But coming to fair value of a share, suppose example in the given question, they have given the market price 100 rupees. Okay, exercise price 70 rupees. Okay, so then the difference between these two prices is nothing but intrinsic value, right? That is nothing but 30 rupees. For this only we need to book the expense, correct or not? Yes. So sometimes they will not directly given the market price. Okay, initially they will give the market price and the exercise price also, but after that they will give at the end of the year one the fair value is something 120. At the end of the year two the fair value is 130. At the end of the year three the fair value is 120 something 110. Sorry, market value, not a fair value. I will discuss about the fair value later. So market value. Okay, so they have given the market value like this. So what should we do right now, guys? Please think yourself. This is the market price, correct? So you know about the exercise price that will not change, correct or not? So then the difference between these two is nothing but intrinsic value, correct? Yes. So coming to first year, please don't consider the employee benefit expense as a 30 rupees, because don't consider this market price. We need to consider the market price at the end of the each years. Okay, if the question is nothing talking about that, then you can take this. Otherwise, you can take like this only, guys. Market price minus exercise price. So 120 minus 70, 50. 130 minus 70, 60. 110 minus 70, 40. These are the intrinsic prices. At these prices only you need to book the expense, guys. Please remember this point. If the examiner will ask the question like this, you need to do like this only. Okay, ఇలా ఇస్తే ఇలానే చేయాలి. Okay, so I think everyone understood the reason why we are doing like this, correct? Yes or no? So sometimes they will use the fair value also, guys. Fair value also. So please don't take fair value directly, guys. Which means they will give clearly fair value of share. Fair value of share. So in that scenario also you should do like this only. You do like this only. So I think December 2022 question. Okay, I have discussed in my YouTube channel. I think it was discussed in almost 1.5 2 years back only. I will upload in my Telegram channel. Please don't forget about it. Okay, please watch that question also. Okay, that is similar to fifth question, but it's little bit different, guys. Must watch that question. December 22 exam question. I already discussed in my YouTube channel. Please go and watch there. Okay, I will upload in Telegram channel. Or otherwise, you can search with December 22 question Ind AS 102 CS High Kumar. You can search like that, you will get the question. Right? And one more point before solving this question, P ratio. What is the formula for P ratio? MPS by EPS. Correct? MPS by EPS. Then what do you mean by MPS? How to calculate the MPS? Basically, PE ratio equal to MPS by EPS. So MPS equal to P into EPS. Correct? P into EPS. So you want this formula also in this question. That's the basic, guys. SFM, everything you already did this point. Correct? Yeah. Next, on 1/4/2017, Om Limited grants 50 options to each of its 2,100 employees at 70 rupees with market price is 110. So they're clearly saying that okay, when they're giving the exercise price as well as the market price, that means they're giving the share value, not the option value. Okay, the vesting price on 31st March 2020, excess date is 21. Okay, I mean 3 years. Correct? 17 to 20, how many years? 3 years is the vesting period. Correct? Yes, 1 year is the excess period. At the end of the year, when the company found that 100 employees had left and estimate expect annual forfeiture, please underline this word, guys. So my expectation is annual forfeiture rate at 10 percentage, which means annual means every year. So current year already 100 employees left. My expectation in next year is 10%, and expectation another third year is 10%. That is the meaning of it. Not overall 10%. This is every year 10%, guys. Annual means every year. Second year 10%, third year 10%. Correct? Everyone, please must have a clarity about this. Everyone should have a clarity about this point. Annual forfeiture means every year 10 percentage. Suppose example, yeah, total how many employees? 2,100. In first year, how many employees had left, guys? In first year, how many employees left? Year one, two, three. Okay. So total 2,100 employees, correct? Say star no. Total 2,100 employees. Okay, employees calculation I'm doing. In first year, already 100 employees left. Balance how many? 2,000. So 2,000 employees are there. So out of that, second year, 10% employees are forfeited, which means cancel. So they don't want the options, right? So that's why how many employees will going to West? I mean, how many employees require this? 2,000 into 90%, because 10% forfeited means 90% only pending. So for that only we need to book the expense. How much? 1,800. This is for second year. Coming to third year also we need to recognize in first year only, because my expectation in second year is 10% they will leave. Okay, they forfeited. In third year also I'm expecting current year only. First year ending only I'm expecting about second and third year. So that's why I need to book the expense overally. Means so out of 1,800, 10% is forfeited in the third year. That is my expectation. So that's why only 90% is the pending. There is nothing but how much? 1620 employees. You need to book the expense for 1620. So I will not write the calculation like this. Basically, in exam, you can write directly like this, guys. For year one, calculation of employee benefit expense. You start the question like this. So year one, so total. What is it, guys? Number of employees, how much? 2,100 minus 100. Correct? Already 100 is left in first year. Out of that, 90 percentage will vest in second year. Out of that 90% third year. This is the calculation. The number of employees. This is the number of employees calculation. How much? 1620, yeah? Correct or not? Say guys, please tell me. Yes or no? Yes, guys. 1620. How many options, guys? Per employee? How many options? Options 50. Correct? Yeah. The options into price. Price. How to find out this price, guys? Intrinsic value. We need to find out the intrinsic value. How to get the intrinsic value? Coming to first year. Earning per share is 26 and price earning ratio is 5, which means EPS given, PE ratio given. What is the expected answer? MPS. What should be the MPS? So MPS equal to EPS into PE. How much? 130. 26 into 5, how much? 130. So 130 is the market price. 130 is the market price. But as of the excess price is how much? Excess price is 70 only, guys. Then 60 you need to book the expense. Correct? Or no? You can write the working note like this. Calculation of MPS per each year. For each year. Okay. I don't want to waste my time by writing. Neatly writing. Okay. Please don't worry about it. Yeah. Particulars. Year one, year two, year three. Okay. EPS 26, PE 5, 7.5. P how much? E 4. Third year 18, 5. 4, 5, 4, 18. Correct? So these are the values given in the question. You need to find out the MPS. How to calculate? 26 into 5. 27.5 into 4. 27 4s are 2 4s are 80. 7 4s are 28. 108 to 110. Correct? 18 5s are 90. This is the MPS. What is the excess price? 70, 70. Balance 40, 20. This is the intrinsic. At this price, you need to calculate the employee benefit expense. First year 60 into yeah, 31 lira into this is for first year, right? Vesting period is 3 years. So 1 by, can you please calculate everyone? How much, guys? 16 lakh 20. This is the first year expense. Yeah. Coming to second year. So 2100 out of 100 already left out of the organization. Only 2000 is pending. Coming to the company found that actual annual forfeiture for the second year is 4%. So they decided, at the end of the second year, they already know about the annual forfeiture. How much? 4%. How much? The balance after first year ending, in coming to second year, already we have only 2000 employees. Out of that 4%, how much? 4% means how much? 80, yeah? Correct or not? 2100 minus 100 minus how many employees, guys? 80. Correct or not? Yes or no? Yes. How much? 2000 minus 80. 19, 20. Into. Sir, why you are writing like this? Can you write like this also? Into 96 percentage. Yes, that is also correct. You want, you can calculate. You can calculate, yes. Calculate percentage. Ah, so if you want write like that only, yes, you want to write into 96 percentage. Into. Why 96 percentage? Because 4% already left. That's why I'm writing separately. Because I need to know how many employees get lefted. Correct? So that's why I'm writing as a 80 into my expected forfeiture in next year is re-estimate the expected annual forfeiture at the rate of 5%. 5% means into 95% into into. Correct? How much? Please tell me. 24 in 20 into 50 options into what is the intrinsic value, guys? Second year 40. So into 40 into 1 by 3 or 2 by 3? 2 by 3. 2 by 3 means 2 years expense. Out of that, you need to deduct the first year expense. Correct? What is the first year expense? In like 20. Please calculate the balance. Clear? Everyone, clear? Any doubts? Any doubts? Here 96% means 4% already left. 4% means how much? How many employees? 80 employees. Please remember this for the third year. Year 3. Same guys. Out of 2100 already left in first year. Second year 80 already left. The balance how much? 1920 into what third year? How much? How much the person is given in the third year? At the end of the third year, the company annual forfeiture was at a 10 percentage. How much? 10%, which means 90%. Into what is the number of options? 50. Into what is the price? 20. Price 20, huh? Minus, minus. We need to deduct the 2 years expenses. Correct? Yeah. What is the 2 years expense? One is in like 20,000. One is 8 lakh 12. Please calculate. 1000 minus 2. Much? Please tell me the how many employees here? 1920 into 90% 17. 28 employees are left. Balance. Balance. Remain into how much? 17 lakh 28,000. 17 lakh 28,000 minus lakh 20,000 minus 8 lakh 12,000. How much balance? Minus 7 lakh 4. Minus 7 lakh. Please remember. Minus 7 lakh 4,000. Means we need to reverse the expense. Correct? Yes. Ultimately, how many employees are going to vest as per your given? I mean, as per your calculation at the end of the third year. So, as per my expectation, at the end of the third year, only 1728 employees will only remain in the organization to vest the options. Correct? Sir, no. Go to question. Only 1700 employees exercised their options at the end of 31st March 2021. The face value of equity share is 10 rupees. What is the meaning of it, guys? What is the meaning of it? So at the end of the third year, we have 1728 employees, but only 1700 employees only going to vest the exercise the options. So the balance 28 got forfeited. Correct? The balance 28 got forfeited. Then you need to tell me the fourth option. What is the question? Calculate the value of options forfeited. How many options we are going to forfeit, guys? Anyone? That is nothing but 28,000. How to calculate this 28, guys? See, guys, out of 70, 28, 1700 employees are exercising. So, balance how many employees we have? 28 into how many options? 50 options. Correct? The options into latest. What is the latest intrinsic value? I mean, which is already recognized in 1728. 1728, we already recognized at 20 rupees intrinsic value. So that should be forfeited, right? Into 28. This should be the value of options forfeited. These are the three value answers. I mean, fair value at the end of first year, second year, third year. Clear? This is the way of calculation, guys. Definitely, it will be helpful to you. Okay, this type of a question also we have in our YouTube channel. Go to December 2022 question. I will upload in my Telegram channel. So CSEMA challengers, correct? So we have almost 2500 students are there in that channel, but the channel is not active. I know that. Yeah, I want to keep more efforts from. I'm trying to. I will try to keep more efforts as well as the Telegram channel. Thank you. So go to next. Okay, guys, coming to standard Ind AS 113. So, fair value measurement. Okay, so examination point of view, not that much important, but examiner will ask, he already asked one question, he asked three attempts, so that's why I'm discussing this. So, this time I'm expecting a question from this topic. Okay, so that's why I'm discussing, but I don't know, I'm not exactly, but I'm expecting this. Okay, yeah, objective to define the fair value, to set the framework for measurement of a fair value, to specify the requirement of a disclosure of fair value measurement. Okay, so this is the basic objectives. Examination point if not that much important, just can give us a single reading, that's it. So what do you mean by fair value, guys? First of all, yeah, fair value means, so basically this standard, this index is applicable to the, which means this index determines the calculation of asset or liabilities యొక్క fair value, nothing but fair value of asset or a liability required by many indies. So in many indies we will use the word fair value, right? asset or liability. In that case, you need to calculate. First of all, you should know the fair value. How you are getting as per this standard. Ind AS 113. But in some scenarios, we have some exceptions also. That is not as per Ind AS 103. Sorry, 113. So those are the examples. Okay, non-applicable. Ind AS 113, not applicable. So fair value. What is the definition of fair value? Fair value is the price that would be the received to sell an asset or to pay to transfer the liability. That is nothing but exit price. Guys, what is the meaning of receive to sell an asset? So, for example, you sold an asset to other party will receive some money, right? That is nothing but you can say it's a fair value. So the amount you are going to receive nothing but fair value or pay to transfer the liability. Suppose example you are the bond holder. Okay, so nothing. So not you are the bond holder. You have issued bonds to the bond holders. So you need to pay principal as well as interest to the bond holders. Now you are transferring your liability to third party. So now third party will pay that. So now your liability is transferring to some other person. So in that scenario, also you need to calculate the price. That is nothing but fair value. Okay. So in an orderly transaction, the transaction should be very uh, consentful. Nothing but it should not be forced, guys. Transaction should not be forced between the parties. Parties nothing but market participants. You can say market participants. Market participants is nothing but buyer and sellers. So who must have knowledge, who must have a characteristics like knowledgeable, independent, okay, willing to enter into the market, sorry, contract or a transaction, nothing but. So these type of a characteristics should have to that particular market participant, okay, at a specified date. So both buyers and sellers are the nothing but independent. At a specified date is nothing but measurement date. At a measurement date, this is the definition for fair value. So to measure the fair value, basically we have two types of markets, guys. Two types of a preference. Two preferences we have. Okay. So see, guys, it is assumed that the transaction should sell an asset or sorry, to sell the asset or transfer the liability takes place. We have two types of a preferences. Two preferences. First preference, principal market. If there is a principal market or not. Okay. Go through that option. Your first preference should be the principal market. Go to the principal market. You can check that. Okay. Otherwise, secondly, you can go to the most advantageous market. First of all, go to the principal market. If there is a principal market, first of all, what do you mean by principal market? Means, guys, it is the market in which the particular asset or liability is transacted in highest volume of a highest volume of a highest level of activities. Nothing but highest volume with the highest level of activities. Okay, when compared with any other in the market. So you should consider only highest volume with the highest level of activities where it is going on. That is nothing but principal market, guys. Principal market. In principal, when there is a principal market, how to calculate the fair value, guys? Simple, guys. Price of asset or liability will be given in the question. So minus transportation cost. What is that, guys? Transportation cost. So the transportation cost also given in the question. Just you need to be deduct from this price of the asset or a liability. This is the calculation of fair value under, I mean, first preference. If there is no principal market for that asset or liability, then you need to go to the most advantageous market. So you have they will give different types of market A, market B. Okay, they will give the values. Market A, market B values will be given in the question. So which value, which market you should consider? When we have two markets, which market you should consider? When there is no principal market, basically you should go to the most advantageous market. So we have most advantageous market. To find out the most advantageous market, we have two types of markets in our assumption. Okay, so two or more also, no worries in that. Okay, so then how to calculate, how to find out which is most advantageous, guys? Simple, guys. So this is the uh, basic formula is nothing but it's a calculation, simple calculation. So price of asset or liability, okay, price of asset or liability minus transportation cost minus transaction cost. Okay, so you will get some value. So for example, this is market A. So price of asset is 100, transportation cost 20, transaction cost 20, 60 should be the value of net amount received or paid is nothing but 60. Correct? This is as per market A. Coming to market B. So this is 120, this is 20, this is 30, which means 70 is the value. Okay, market B value is net amount is 70. So whichever is higher should be considered here. So you can take the market A, market B values. So market A, price of asset or liability minus transportation cost minus transaction cost. You will get some value. Same for market B also. Compare with both the things, whichever is higher should be taken. That market have a most advantage. That market should be the most advantageous market. Understood or not? Which market have a higher value? You are getting that market should be the most advantageous market. You should find out the fair value as per that market only. For find out the fair value, this is the formula. Same. Price of asset or liability minus transportation cost. Then you will get the fair value. But price of the asset or liability should be taken as per which market? Which market have most advantages? Market is advantages. So that market fair price of asset or liability should be taken into consideration. That's it. This is the question they're asking. They have asked in last few attempts. I mean, three attempts back. I think so. The question will be this is the question, guys. Yeah, easily you can solve this, guys. Perfect. In market A, see, guys, the price that would be received is 26. Market A, market B. Simply, I can answer this. Okay. So market A 26. Next transaction cost is 3. Next transportation cost is transaction cost to transportation cost. Okay. Coming to market B, the value is 25. Okay. Transaction cost in the market would be 1. Okay. Transportation cost is 2. Total 20. Here 21. Correct. 26 minus 2 minus 3. How much? 21. Here 25 minus 1 minus 2. How much? 20. Okay. So this is the basic calculation. Why I have calculated this for most advantageous market, correct? So when this concept will comes into picture when there is no principal market. So coming to question, you are required to calculate fair value of the asset if the market A is the principal market. If market A is the principal market, please consider market A only. Correct? Yeah, market A value. What is the value? 26 is the price of asset or liability minus only transportation cost. How much? What is the transportation cost, guys? That is nothing but 2. Yeah, 24 should be the fair value in first scenario. Sir, when there is a principal market, why should you go to the second market? Not required. So we have a market A is the principal market. So I have considered the fair value as per that market only. Coming to second scenario, if there none of the market is principal market, so both markets are not a principal markets, then you need to find out the most advantageous market. So how to find out based on this calculation? Price of asset or liability minus transaction cost minus transportation cost. Okay, you can calculate for both the things. You will get which market have a more value or larger value. That market should be the most advantageous market. In this scenario, we got 22 here, we got 21 here. So market B is the most advantageous market. So how to calculate the fair value, guys? As per market B, what is the price? 25. 25 minus transportation cost, how much? 2 rupees. Nothing but 23. This is the fair value. Simple, guys. This is a simple calculation. Okay? That is what they are asking about. I think everyone have a clarity about this. So solve it. Even simple, guys. First scenario, second scenario. Principal market, there is no principal market. So fair value equal to 26 minus transportation cost is 2. So 24 is the fair value. Coming to second case, there is no principal market. So you need to find out the most advantageous market. For that, what is the calculation? 26 minus 2 minus 3. Correct? Transportation cost you should deduct. Transaction cost you should deduct. So then you will get 21. In this case, 25, 2, 1. How much? 22. Correct? So in this, which have a more value, guys? Market B have a more value. So that's why this is the most advantageous market. You need to find out the fair value as per this market only. So for the what is the calculation for fair value? 25 price of the asset or liability minus transportation cost. Nothing but 2. So 23 is the fair value as per second answer. That simple way of calculation. Okay. Yeah. More thing. To determine the price of asset or liability for fair value measurement. So price of the asset or liability should be determined by using the following inputs in priority. Fair value hierarchy is nothing but level 1 inputs, level 2 inputs, level 3 inputs. So this is important for theory purpose. So we have a level 1 inputs is nothing but observable inputs. Okay, observable inputs, which means quoted market price of asset or liability is available in the market. In stock exchange, the market price will be quoted. Okay, that is nothing but observable inputs. So coming to level 2, observable inputs, but with some adjustment. Simple case, market price of the similar asset or liability, because there's direct asset or liability is not available, then you should consider the similar asset or liability with some adjustments. That comes under level 2. Level 3 is nothing but unobservable inputs. We cannot identify it. So that's why completely based on estimations. So the price is based on assumptions and forecast of the entity. That is nothing but fair value, sorry, present value of forecasted future cash flows. Okay. If the quoted market price of asset is not available, then you should apply the following valuation techniques. Nothing but market approach, comparable companies method, as well as the net asset, sorry, income approach also. Income approach as well as the cost approach. So these are the approaches basically. Okay. Coming to first one. Yeah. I don't want to discuss all these things. Examination point of I'll discuss. See, the thing is, yeah, income approach. Simple. Present value of projected free cash flows using appropriate discount factor as follows. So simple guess, present value of projected cash flows minus market value of debt plus surplus plus fair value of surplus assets. Then you will get some value divided by number of shares. You will get the fair value per share. Simple assets will be added. Nothing but reserves assets or something will be added. Liabilities will get deducted. Simple benefit amount should be added. Simple guys. So market value of cash flows, okay, cash inflows add. So minus debt, debt should be deducted. So surplus you are getting, so add. And fair value of surplus assets also. Surplus assets means is beneficial, right? So that's a have it. Then you will get some value divided by number of shares. You will get the price per share, value of equity per share. Okay. So I think this is more than enough, guys. So similar case we have the problem number two. So I am expecting a question, this question or another question also we have, that is in my regular class, but I am not able to discuss here. This is important as per my expectation. Okay. So in the process of determining the valuation of KK Limited, the company by two approaches they are following up: market approach as well as the income approach. Okay. Sorry. Yeah. So we have two approaches here as per market approach and income approach. So they select the highest and final value. Here, the based upon the discussion with your partner, you have been requested to assign the equal weights. So please underline this word equal weights. We need to give the equal weights. So the valuation as per different approach is already given in the question. See, the market approach value is some value, income approach value 3235 something. Correct? Okay. Yeah. See, now they are clearly saying that based on the discussion with your partner, you have been requested as an equal weights to both the approaches. So equal weights means into zero point 0.5 into zero point 0.5, half of equal. Correct? So you will get some value. What is the value? 5268. 5268 into zero point 0.5. How much? 2634. Next, 3235.2 into zero point 0.5. 161.6. Okay. So I'm ignoring the decimals. Okay, next, debt. Basically, debt should be deducted, right? So you can add these two plus debt should be deducted and surplus cash should be added and fair value of surplus assets only. So that also we need to be fair value of assets and surplus assets and liabilities. So surplus is nothing but added. So if it is deficit, then you can deduct. Surplus means you need to add it. So then you will get some value. Correct? How much? 460.204 something divided by number of shares. So all these are in crores. So this is 8 crores 52 lakhs 84,000. Sorry, 8 crores 52 lakhs 84,223. Okay. So that's why first of all we need to convert into crores, or we need to convert this into shares. The shares into crores. I think by 8.52 crores. So divided by 8.52. You will get some value 376 here. So that is the equity value of KK Limited. Okay. Again I'm saying mark as per market approach. We have a solution. Yeah. Similar question is not there, but we have similar. Same question is not there. Same market approach, different approaches we have equal weight. So that's why I have taken the average of these two. Okay. Next, minus debt obligation, cash should be added, and fair value of assets and liability should be added. Okay, now so divided by number of shares. Similar way you can calculate. You will get some value that is nothing but equity value per share. That's it. Simple guys, this is more than enough for your exam. But coming to theory, just please give a single reading about this fair value hierarchy as well as the fair value techniques. What valuation techniques? Clear? I think everyone have a clear clarity about this in S11. Thank you.